of their products and their product cycles. And so we've liked this name, as you know, for a long time, and we're long-term shareholders. And what's happened with NVIDIA is that they've transformed. Their history is, of course, as a gaming company, and the technology and what they've been able.
And what happens, they don't build them, right? Am I correct? They have other people put these things together? Farming out? What happened to Boeing? Idiot.
Is this ability to keep innovating and pushing on the product cycles. They have to extend into new areas. They have to take significant risk. But if they can do that successfully most of the time, it drives strong revenue and free cash flow growth.
So where do you expect the stock is headed?
I think the stock can head substantially higher, Becky, over the next 1 to 2 years. I can't give you a specific price target.
No, you can't.
What I will say is that you have a data center business approaching $100 billion that I think can sustain healthy double-digit growth over the next few years. Sure, the quarters will be lumpy. There are, of course, cyclical dynamics that impact NVIDIA like others. But if they're able to do that, I think over time, this can create significant additional shareholder value from current levels.
You say that you also see value in a lot of these other tech stocks, even if it's not going to be quite the same as what you've seen in NVIDIA, but you're citing Alphabet, Amazon, Apple, Cisco, Microsoft, Motorola, and Qualcomm. Let's run pretty quickly through some of these. Alphabet, what's your take?
Sure. We're seeing them capitalize on generative AI. We've seen in the last couple of weeks that they're transforming search. They're creating more value for users on one side, advertisers on the other, and I think their cloud platform's underappreciated. Amazon, they're continuing to redefine the consumer experience. AWS, their cloud platform, remains healthy. With Microsoft, you're seeing continued strong growth in Azure, their platform. If I look at some other names, Motorola Solutions is an example. They're a leader in public safety, and they have very strong growth prospects in areas like video. Think about the command center and 911 centers. A lot of them can't receive text and video. That whole area needs to get revolutionized and transformed and modernized. Qualcomm, they're a key enabler of intelligence, connectivity, and security in low-power environments. Think about factories, cars. All of that will get connected, and Qualcomm really sits at the heart of that transformation. And Cisco is a contrarian name that we continue to like. I think they're making good progress on embracing the cloud, transitioning to more software, more recurring revenue, and we think the earnings over the next 2 to 3 years will be better than the market thinks.
I don't think you mentioned Apple. I know you like
Apple,
this stuff,
yes.
but it has struggled.
I will absolutely. What we're going to see in the next few weeks, and I think more so, Becky, in September, is that they're going to infuse more artificial intelligence or generative AI into the device. I think they'll begin to change the user experience, make the device even more valuable. The key here, if we step back, is that sure, the smartphone market is difficult. I expect concerns on China. But the install base is continuing to grow, and you're seeing customers continue to mix to better and better devices, more Pro and Pro Max. So you put the device business along with services, Mac, iPad, and I think wearables will do well over the next 12 to 18 months. And so that, in my view, will lead to better revenue growth later this year into 2025. So we continue to like Apple, and of course, their ecosystem, which we monitor closely, remains vibrant in my view.
Hey, Dan, in the distant past, let's say 6 months ago, the technology stocks used to be pretty closely tied to what we thought the Fed was going to do. Every time we thought the Fed was going to cut rates, those tech stocks would take off. When we thought the Fed was less likely to do it, they'd come back to earth. But that seems to have separated to some extent, where people are looking at this and saying there's going to be a lot of money that flows into AI regardless of what happens with the Fed. Is that how you see things?
Becky, I look closely at the innovation and the growth. Even with the Fed having raised rates significantly, even were they to raise rates a little bit more, these companies have sufficient capital, they generate strong free cash, and so they're able to invest. In the case of Alphabet or Amazon, tens and tens of billions a year annually in CapEx and R&D. So some of their end markets, clearly the consumer is being impacted. But what I think the market is seeing is that in the second half of this decade, you're going to have a much more powerful set of growth drivers, which will lead to much stronger earnings and free cash flow. And that is what I think the market will focus on over the next several months and into next year.
Great, Dan. Thanks for your time today.
Meantime, it is just about 7 a.m. right now on the East Coast, and you are watching Squawk Box right here on CNBC on this Friday morning. I'm Andrew Ross Sorkin along with Becky Quick. Joe is off today. Got a bunch of big stories to tell you about. The first, Elon Musk speaking out at the Viva Tech conference in Paris yesterday. He said he doesn't support President Biden's recent announcement on a tariff on Chinese-made electric vehicles. Separately, reports this morning that SpaceX is now in early talks to sell shares at a price that would value the space startup at roughly $200 billion. That's up from an $88 billion valuation just 6 months ago. And the SEC is clearing the way for a batch of new ETFs that deal directly in Ethereum, with trading expected to begin later this year, though through products offered by BlackRock, Fidelity, ARK Invest, and more. And we're going to have a lot more on this story with former SEC Chair Jay Clayton in just a few minutes. And a landmark deal that could forever change college athletics. The NCAA and its 5 power conferences have agreed to pay college athletes as part of a massive antitrust settlement. The award will include $2.7 billion in back pay damages to athletes dating back to 2016. And it also paves the way for a revenue sharing plan that will allow each school from the 5 major conferences to pay up to $20 million per year to players.
Let's get a check on the futures on this Friday morning. Right now, Dow futures up by about 26 points. S&P futures up by 12. The NASDAQ up by 47. Some advances, but pretty modest advances looking at yesterday's gains. Remember, yesterday the Dow saw its biggest drop in about a year. It was a decline of 600 points. Let's get right over to Dom Chu. He's got a look at this morning's pre-market movers. And Dom, it's been a bit of an up and down week this week.
It certainly has been. And we're going to start with that massive drop in the Dow yesterday and a big reason why. And that is shaky starts for Boeing yesterday. The aerospace and industrial giant is up, just you can see there, fractionally 0.2%, a little over 12,000 shares of trading volume. But that followed a 7.5% drop yesterday, and that drop was triggered by comments made by Boeing Chief Financial Officer Brian West at the Wolfe Research Global Transportation and Industrials Conference. West said he now expects negative free cash flow for the year after forecasting positive free cash flow in the low single digits billions just about a month ago. He also added that deliveries of new planes will not improve sequentially in the second quarter from the first quarter. So those comments really drove a lot of the downside for not just Boeing, but the Dow overall. And then you got shares of Workday. Those shares are down over 12% right now, just around 20,000 shares of volume. This is the provider of cloud-based human resources and finance platforms for businesses. It actually reported better than expected quarterly profits and revenues. But in what has been the case for much of this earnings season, the forecast was key, and the forecast was not positively received. Its subscription revenue guidance fell short of estimates, and that's part of the reason why you're seeing shares down 12%. And we're going to end with a check on the most important stock of the week, the season, perhaps even the year, or even longer. That's NVIDIA. The shares right now up fractionally, now up about 1%, following just about 250,000 shares of volume, following up a massive move in yesterday's session to record highs. Again, the chip giant, the most valuable chip company in the world, and it has been for quite some time, maybe just doesn't show any signs of slowing momentum right now. So, Becky, we'll see whether or not this cools off at any point in the near future. I'll send things back over to you.
Yeah, it's a battle that we've been watching, Dom. Thank you, and we will see you in just a little bit. We do have a couple more stocks to watch this morning. Shares of Ross Stores are higher. Earnings and revenue both beating expectations, although same-store sales did fall short of expectations. The company raising its full-year profit forecast and reiterating its guidance for comp sales, and you can see that stock right now up by about 8%.
Meantime, Starwood Capital tightening limits on shareholders' ability to pull money from its real estate income trust, a $10 billion investment vehicle. Redemption requests had been mounting, but CEO Barry Sternlicht had urged investors to wait for the real estate market to rebound and not force the sale of properties at the company's many assets and what he thinks are low prices right now. Starwood will cut its management fees while the tighter controls are in place, which firm expects to be 6 to 12 months from now. Starwood's decision could set off similar moves by other REITs as investors lose patience waiting for the Fed to cut rates and real estate to rebound. They are in a very tough position here because they have now taken out loans to pay people back. They're basically stretched to the absolute limit. We talked about the Blackstone real estate fund, BREIT. They put up gates at one point, but they're in a much better position today. This is now the fund that's, I hate to say it, but in trouble. And I think that there's a real question mark if there is a rush for the gates, and it sounds like there is. The only way that this ends well, if it can end well, would be for them to be able to sell some of these assets and it not turn out to be a fire sale, which I think is almost impossible.
And by the way, Blackstone and this REIT, the Starwood one, are the two biggest REITs out there. They're number one and number two.
Yes, these are the two biggest what are called semi-liquid REITs. There's a whole, obviously, bunch of regular REITs, and obviously, not everybody can be invested in these funds, so it's not just like a public thing that anyone can go do. When we come back, the SEC taking initial steps towards allowing spot Ether ETFs. Former SEC Chair Jay Clayton joins us next to discuss that and much more. And then the decision that paves the way to paying college athletes. Former TD Ameritrade CEO Joe Muglia, who is head football coach at Coastal Carolina, weighing in on that and more. We'll talk about this later in the hour. We're coming right back. Welcome back to Squawk Box. The SEC has approved a rule that could pave the way for spot Ether ETFs. Joining us right now to discuss this and more, Jay Clayton, a former SEC chairman, a CNBC contributor, and I think both of us, along with Becky, were scratching our heads a little bit about what we're seeing in terms of what's really being approved and what's not really being approved and how this could even work?
Yeah, so let's just, there's two pieces.
Lay it out.
There's two pieces of approval for one of these types of products. There's the listing approval, which is what happened yesterday, and then there's the approval of the product itself, which is still pending. What's that is called the registration statement. That we need to find out. Let me say this product is eligible for listing, but it will not actually be trading until that registration statement
So it's
is
okay
approved.
in theory?
So it's a step in the direction.
But does it mean it's inevitable?
I think it means it's inevitable. We went through this same process with the Bitcoin product,
Right.
where almost all of the questions were decided. The question that was decided yesterday, to speak technically, is that the market is efficacious enough for this product to be listed on the exchange.
Okay, but let me ask you a question.
That was what was
as
decided.
you
But
know-
but there are other questions out there.
Oh, well, let's talk about those questions. But as you know, Gary Gensler and the SEC went kicking and screaming to allow the Bitcoin ETF, and only did so because a judge effectively said you have to. This is different. So what is different this time?
What is different this time is there was a settled issue of whether the underlier, Bitcoin, here the underlier is Ethereum, was a security or not, or transactions in Bitcoin were securities transactions. The SEC has not definitively said, up till now, and they still haven't definitively said, that underlying transactions in Ethereum are not securities transactions.
Is part of this because of what Congress just did this week to pass this first crypto bill and basically say it's going to be the CFTC that is overseeing all of this? Is this them putting another chip on the table saying, wait a second, we want to claim our legal framework for this?
My view for a long time in this program is that progress, development, whatever you want to call it in the space, was always going to be incremental. What did they do this week in Congress or over the last couple of weeks? They made more clarity around custody and the cost of providing custody services for digital assets because they weren't happy with the way the SEC had done it. Now with this bill, they're saying, look, we want a path for products like Ethereum, other digital assets, to be able to trade like securities. And whether they're classified as commodities or whether they're classified as securities, we, Congress, want to see that path. And that's what you're seeing playing out.
Would you allow this yourself? You didn't when you were the head of the SEC.
Right. The question that was a problem for me, and I've said this many times before, was the market efficacious enough? Was that spot market for Bitcoin, spot market
Right.
for Ethereum? And it's developed, remarkably over time, where people are very confident that trading is,
Do you think you might have been able to get your head around it
I mean, I
if
can get.
you were in the position today?
Yeah, I can get my head around it, and I'm interested to see what the conditions will be for the Ethereum exchange-traded product when it actually gets there. What is it that you have to show to prove that Ethereum is not a security, or if it is a
Right.
security, how it works?
But part of the thing, and we used to talk about it, we used to use this analogy about Broadway tickets.
Yep.
You remember?
Yeah.
You want to tell the audience
Okay.
about Broadway tickets? Because I don't know if that piece of it's changed at all.
All right. Well. This is how you tell the difference between something that is a security and then becomes a commodity. Picture a play.
Yep.
Play
on
hasn't
Broadway.
started. I come to you guys and I say, you know what? I'm going to put this on. I'm going to get a great composer. I'm going to get a great producer, great actor. I'm going to get a venue. Tell you what, give me your money, and I'll give you tickets for that play when it's on.
Right.
You're making an investment. You're buying a security. Those tickets represent a security transaction. You're hoping that my efforts deliver a great return to you. 6 years later, the play is a huge success. Somebody walks up to the box office, buys the same ticket to the same show. That's just a ticket. It's a commodity. It's not an investment in the future of the show. That's how something that is used to build out a network, using a token to build out a network and say, if this network gets built out, your token's going to be worth a lot of money, is a security.
Right.
And then when the network's built out, the token is just for use on the network.
Okay, I want to switch gears.
Make sense?
For me, it makes sense, and I think it's actually a great analogy, so thank you. There are people who debate that analogy with you, by the way. You've seen that probably out there. I want to switch gears because Becky and I were debating an article, I believe in the New York Times last week, called, it was about how the 401ks have been a great failure for America, and that we are now in a retirement crisis in large part because 401ks have not delivered on the promise that they were supposed to, and what we should do about it now. First of all, do you agree with that premise that the 401k has actually been a failure?
I don't agree that it's been a failure. I agree that it's no longer adequate for what we have in society. We have had a lot of changes since 401ks came into place. People now move jobs. It's very difficult to take your 401k with you when you're moving jobs. And when you're entering a new job, if you know you're only going to be there a couple of years, you're like, why do I even bother setting this up? It's, you know, it's a pain in the neck. Yeah, that is a problem. Also, people are living much longer. So is it the right tool for today? No, another reason it's not the right tool for today is you're kind of limited, very limited in your investments. So you go back to my tenure at the SEC, one of the things that I feel was unfinished business was fixing this. Now, it requires the Department of Labor and the SEC, but we need to fix it.
But how much of the problem, the underlying problem, is that we have put the burden on the savings component, on the individual, as opposed to either the institution they work for or some kind of, maybe it's a regulatory issue, but effectively a forced savings program, because we have too many Americans who have not saved early when they should have been saving, for the same reason you just said they're going to be in the job for 2 or 3 years. They don't, the match is what it is. They want as much cash to take home as possible, so maybe they're not going to put all the money in that they should. We create all sorts of incentives, but people don't do it. And then they hit the age of 62, 65 years old. They look in the bank account and they say, what am I supposed to do?
I would do something. I would take a success. Australia is a huge success.
Yep, that's what we were talking about.
So basically look at it like this. Forced contributions into your 401k from your employer. Pick a number, 3, 4, 5% of your salary, whatever it is. And then the products that are in there, they should look like a well-managed pension fund, not just everybody levered to 6 stocks in the S&P 500. And it should stay in there. If we got people started that way at age 25,
but what
we
you
would
guys are
solve the
both
problem.
missing is the idea that a lot of people don't even work for a company. If you've got contractors, there's the gig work situation.
You're right.
You can't say every employer has to do this, because it's just going to push more companies to say, okay, I'm going to have more contractors and less employees, because this is a huge burden.
I think, Becky, I think you're right. But let's start with something small, like 2, 3, 4%. That's how they started.
Look, why don't you start with something simple, like you have to opt out of the program rather than opt into it? That's what happened with Dow Jones when I worked there. It was a great thing. When I was 21, I would not have been saving money because I was literally scrimping to get by on everything, but they forced the issue. They met it with matching.
I would go for mandatory. I would go for mandatory.
That's what we're talking about. We're talking about a mandatory system across the country.
Where you can't opt out.
Where you can't opt out, and you'd have to do it, and part of your income. This is what we're talking about, forced savings in Australia. I'm with Larry Fink. I think you and I are on the same page.
We need to do it. People are living into the 80s and 90s, and we're going to have a retirement crisis.
You already have a situation where people at the bottom rungs, the lower rungs, feel like they can't get by. They can't pay their groceries every week. Now you're going to tell them that, oh, by the way, we're going to take 10% more away from you. Or you're going to tell their employer that if they don't put X amount into your paycheck every time, that they can't have them as employees. I think you ignore the unintended consequences. Are there problems with this? Yes, but do you start with more education and more?
But the unintended consequence is that we, as a country, have a social security crisis.
Okay, so
we have a retirement crisis, and people who can't, who feel that they can't buy, an extra, certain things when they're younger, clearly can't handle any of the costs when they're older.
I'm not saying to change Social Security, but if 25 years ago we had taken 25% of Social Security contributions and done this,
right, and that's a different
we would
story.
not have a retirement crisis.
That's a problem that Congress has dealt with, where they squandered these things. I mean, we can't even get the people who are supposed to be leading the country to get on board with this.
Like
this is going to be rolled out.
There can't be a more bipartisan issue than retirement security. We need to move on this, and we need to make people's 401ks look like well-managed pension funds. And
I think making them portable would go a huge step. Like make it connected to the person, not connected necessarily to the employer.
Exactly.
Be able to take and move it with you everywhere you go. I think there's a lot of things that could be done before you say everybody's got to.
Well, let's start. Look, I'm an incrementalist. Let's get going.
Things that could actually happen today.
Right.
Yes.
Start
But
moving
by
on.
the way, a lot of that could be done on a voluntary basis, and frankly, the BlackRocks of the world and the Fidelities of the world and the Vanguards could actually do that.
Yeah.
And just like this, we wouldn't have to have. We don't even need Washington to do this. They could say they could do this. And by the way, part of it is employers.
Right.
The Department of Labor, the SEC could get together and facilitate this with very little friction.
Okay.
Jay Clayton, we solved retirement on a Friday morning ahead of, you know, Memorial Weekend. Appreciate it. Nice to see you. Thanks.
All right, when we come back, Indivior, is that the name of it? Indivior?
Indivior.
Okay, Indivior provides life-transforming treatments to those suffering from opioid addiction and mental illness. The company's CEO will join us to talk treatments, regulations, and their upcoming listing on the NASDAQ. And later, former TD Ameritrade CEO and former head football coach of Coastal Carolina, Joe Moglio, will join us for a wide-ranging interview. Squawk Box will be right back.
Time now for today's Aflac trivia question. In what year was the nation's first Memorial Day? The answer when Squawk Box returns. Now. And now the answer to today's Aflac trivia question. In what year was the nation's first Memorial Day? The answer, 1868. It was officially recognized as a federal holiday in 1971.
Squawk Box, we are watching shares of Gildan Activewear. The company's entire 12-person board resigned effective immediately. This is quite the corporate soap opera. They handed control to 8 board nominees from activist Brown and West. The move restored the former CEO, Glenn Chamity, to the company that he founded. Chamity had been ousted by the board in December. It's the second mass resignation that the boardroom has undergone. Earlier this year, 5 directors stepped down as part of a board, quote, refreshment. Gildan is a supplier for major U.S. retailers and companies, including Amazon and Target. And so this just sounds like another sort of as the world turns over there.
All right, the king is ready to take on the clown. Burger King is preparing to offer a $5 value meal that includes a choice of sandwich along with nuggets, fries, and a drink. That matches the reported offering from McDonald's, but the Burger King promotion is expected to launch before McDonald's promotion kicks off on June 25th. Sources told CNBC that Coca-Cola actually kicked in from marketing funds to make the McDonald's deal more appealing to the company's franchisees. And if you're looking at those shares, yeah, it's been a little bit of a rough year to date for both those companies.
Coming up after this, we got an interesting story for you. This is the CEO of specialty pharmaceutical company Educator. They're going to be joining us, talking about treatments for opioid addiction and so many other things. Check out the futures right now after the Dow posted its worst session since March of last year. But after a big week, Squawk Box returns after this. Welcome back to Squawk Box. Our next guest company is known as the largest addiction treatment company in the United States. I want to welcome Educator CEO Mark Crossley. The company is announcing their primary share listing is moving to the NASDAQ, where we're sitting here right now. Nice to see you.
Yes, great to be back. Thanks for having me.
Let's talk about what this company does. For those who don't know, we talk about addiction. Opioid addiction is the primary piece of this company at this point, but you're looking at all sorts of addictions.
Absolutely, Andrew. I mean, we were founded to help people suffering with opioid use disorder and have had a series of innovations in medication. Our blockbuster drug, Sublocade, is out on the market. It's a once-monthly opioid use disorder. We've recently expanded across the continuum of care. We have a rescue medication that's out there specifically designated for high-powered synthetic opioids called Opvee. It's a different active called nalmefene, and we have a pipeline to deal with other areas of addiction.
When do people take that?
People take that once they've been in an accidental overdose for opioids.
So, and what does that drug cost?
That drug is $72.
So it's not an incredible, crazy number.
No, it's not. And I think what you see out there is the idea when you're rescuing someone that's overdosed from opioids is the speed at which you rescue them is key. And the nalmefene molecule is unique because it's incredibly fast acting. and very high powered. So it gets people back very fast. So when you get that respiratory back, you prevent brain damage and quality of life issues later on from having a lack of oxygen.
What are you seeing in terms of just usage?
Yeah, we're in the very early stages. We just launched in September, and the way the rules work is you have to do a bunch of policy work to be able to shift from the current paradigm of treatment, which is naloxone-based products, to allow for all FDA-approved products. So we're in that process. We've changed standing orders across a number of states. The funding is in line that comes out of the government to now be for all FDA approved. And we've got some early adopters, and the early results have been very positive. You know, on average, 1 dose per save has been happening in the early adopters versus when this current standard of care is 3 to 5.
Where do you think we are in the opioid addiction crisis in this country?
I'd like to say that we're making a headway, but the statistics are just still in a rough spot. I think for the first year we saw opioid overdose deaths drop. They're down about 2 to 3% over the last year, but there's still 85,000 a year. It's the single largest cause of death for people 18 to 45. When you look at people that are addicted to opioids, you only have a little bit less than 2 in 10 people are actually accessing treatment. So, you know, awareness, reduction of stigma, breaking down barriers is really key for these treatments. And then having treatments that work, you know, helping with their choices and
And are you seeing it across the country? I mean, just spread across the country? Are there regional pockets where you think it's much more concentrated?
We're seeing this as a universal issue, and I think one of the things that's a positive in this space and where we're going to progress is it is bipartisan. So it's on both sides of the aisle. Folks have this with all of their constituents, and they're trying to find ways to solve it.
So here's a semi-political question. If, in fact, somehow we were able to grapple with the opioid crisis in this country, that would be bad for your company.
Oh, listen, I think if you were to crack it, this is going to be a multi-year sort of solution. And for us, the idea is you get people in treatment, you help them stay in recovery and regain their life.
Right. One of the things you're looking at, though, which, by the way, is not going away, so maybe a burgeoning business for you, is thinking about cannabis and the addiction market, or the addiction of cannabis. There's a big debate about whether cannabis unto itself is addictive at all, though. So how are you playing this, if you will?
Well, it's in cannabis, alcohol, what I tend to refer to as the normalized areas of addiction. You know, people believe they're safe, they're legal in many states, and the U.S. government's looking to take it from Schedule 1 to Schedule 3. But when used in excess, it causes issues and it causes addiction. I think we can all say we know people that use alcohol in excess and they need help to get off of that. There aren't pharmacological interventions. Well, we're seeing the same thing happening in cannabis. 20 years ago, THC levels 3 to 6%. Today, on average, over 20%. And then you've got high doses like tinctures, gummies, they're over 70%. Those high THC levels are incredibly addictive. They cause psychosis, mental things. They lead to schizophrenia when you have heavy usage all day long. So for the people that recreationally are using it...
Legalization a good move then?
Well, I think, again, it has to do with how you're using this.
But if THC levels have gone up, even while we're supposedly regulating this and trying to make a better control of it, I mean, you can't walk down the streets of New York City without getting a contact high.
No, I totally agree, and I think this is where it comes to how is the drug going to be used as it's legalized, if it's used.
And so what are you working on as it relates to this?
Yeah, so we have a phase 2B asset. It's to help with cannabis use disorder. It works on the same receptor as the cannabis. It's a specific signaling, so when THC enters the bloodstream, goes to that receptor, it blocks the receptor and prevents the high. Right. So that we'll look to bring that into phase 3, assuming the results come out positive in Q3, in next year in 2025.
Which means what, though? Like, you have to take this to say, okay, I'm not going to get the contact high, and then eventually I stop taking it? Or...
That's exactly it, Becky, what you do.
But then if I want to get the high, I'm going to stop taking your drug.
Well, the thing is, what you have now is you have a number of people coming forward with this, going to their physicians saying, I am addicted to cannabis. I'm using it heavily many days a week, and I can't stop.
But is it a shot that you give me and it lasts, or is it something that I have to personally take myself every day?
It's an oral doses every day.
Let me ask you a separate question. We talk virtually every day, if not every hour, about GLP-1 medications, typically for weight loss.
Yes.
But a lot of people are now talking about their impact on addiction.
Yes.
And on curbing addictive behavior, on folks who are taking it who don't want to drink alcohol, who don't necessarily want to take drugs. What do you make of the success of these drugs, and does that represent competition to you ultimately? I don't know if it would have any impact on opioid addictions or things like that, but maybe it would.
Yeah, we're seeing some of those early signs or signals, but there's a lot more research I think that has to be done on how optimal it is for those who've been specifically designed for diabetes and weight loss, and you're getting some additional signals. The brain is complex, and so as you hit a receptor, it can influence others. We picked the specific molecules that we're using, the mechanisms of action, because we think they're optimized for opioid use disorder, cannabis use disorder, and alcohol use disorder.
But you don't think there's going to be a one-size-fits-all that's actually just going to cut down on sort of addictive behavior, those folks who want to have a little bit more discipline in their life than they do?
Maybe if it's someone that's looking for a little more discipline in alcohol use, but for people that have moderate to severe alcohol use disorder, I don't know that you'd first go to a GLP-1.
Okay, Mark, thank you. Appreciate it. Great to see you.
Thank you for having me. Great to see you again.
When we come back, we are going to talk possible price cuts, the odds of a recession, and what it could mean for the markets. And later, in the United States, suing to split up Ticketmaster and Live Nation. We will speak to the DOJ's Principal Deputy Assistant Attorney General for the Antitrust Division about the case. Squawk Box will be right back.
Now.
Well, the futures this morning are not as bright as they had been a little bit ago. The Dow is basically flat right now after being up about 25 or 30 points earlier. S&P futures are still up by about 10. The NASDAQ up by about 40. This comes a day after the Dow suffered its worst session in more than a year yesterday. So for more on what's moving the markets right now, we want to bring in Mimi Duff. She is managing director and advisor at GenTrust. And Mimi, what do you think? Yesterday, the concern was that we may not see a rate cut till the very end of this year, if at all, and the market is kind of rethinking what that might mean. How do you feel about it?
Yeah, I think if nothing else, we can see that things can change quickly. In the beginning of the year, we were priced for 6. Now here we are closing in on the middle of the year. And to your point, 1 hike, and it looks like December in terms of what's priced in. I think going forward, it does seem like we're going to be in a period of interest rate divergence between the U.S. Fed and some of the other central banks that are more further along the path of inflation fighting.
It sounds like, okay, that's a concern. Yesterday we did see a big drop for all 3 of the major averages, but relative to what they've done for this year, the market has really taken this in stride, and I think part of that has to be because the earnings keep coming in and keep coming in impressively strong.
That's right. Earnings beats were very solid in this first quarter. And I agree entirely. The equity market has done its job well this year, despite having a bad day yesterday.
So what do you think kind of happens from here, especially when you get into the holiday season with a lot of people, the summer holiday season with a lot of people leaving and taking off for the beaches and elsewhere? Is this a situation where you expect more volatility, or are people feeling pretty comfortable with where the markets are?
We are, especially second half of the year as you're approaching the elections, we are looking for more volatility. We've taken some chips off the table on the equity side. We think fixed income will perform better in a range of outcomes. If we see more of the same, you should be able to earn the yield, and we think that those yields will be well supported. On the other side, if the economy deteriorates, we think they'll perform well too. So we've taken some chips off the equity table to allocate into an overweight in fixed income.
So you've got a neutral stance when it comes to real assets, though?
Yeah, we're fairly neutral. I mean, look, I think that we're actually slightly underweight, but we continue to like uranium. That's traded very well over the past years. We don't have strong conviction in that sector is how I would frame it.
Okay, what do you think in terms of a recession? Because this is getting kicked around too. You think we head into a recession this year at all?
Well, we definitely over the coming year, I can't speak to 24 but over the coming year, we have higher than the market's percentage chance of entering recession. Given that so many consumers were able to refinance houses at very low interest rates, and on the credit side, very same situation, this rate cycle seems to be taking longer for these high interest rates to grip. So it's very difficult to time when the economy will slow, but we do have higher recession odds than the market is placing.
Okay, Mimi, thank you. Have a great weekend.
Thank you.
Coming up in just a moment, we're going to talk about this. The amateur era of college sports is now officially over. A landmark new deal setting up revenue sharing for universities to pay athletes directly. Former Coastal Carolina football coach and TD Ameritrade CEO Joe Mobley is going to join us next to discuss it all. Plus, record travel expected for Memorial Day weekend. What you'll be paying at the pump to get away, and expectations for the summer travel season all straight ahead. Road Warriors, come on back. We'll be talking about all of it right here on Squawk Box in just a moment.
and get today.
The NCAA has approved a $2.8 billion settlement that will allow, for the first time ever, some players to be paid directly by their schools for playing sports. The agreement allows D1 schools to pay student athletes up to $20 million a year. A final agreement is expected to take months to finalize. For more on this, we want to bring in Joe Moglia. He is former TD Ameritrade CEO and chairman, and he's now the Coastal Carolina University Chair of Athletics and Executive Advisor to the President. Of course, he was the coach there, too. Joe, thanks for being here.
Happy to be here, Ben.
All right, I know you've been saying for a while that something had to happen, but now I look at this and I think, oh my gosh, this seems like there's going to be a whole lot more noise before we figure out and see how things settle.
I think you're 100% right of that. I think first of all, with regard to the settlement lasts until 2034. I think if any of us were doing a settlement, $2.8 billion, we would like that to be the end of our liability. But there are still countersuits out there that are not part of this. So the NCAA liability continues to exist. So why would you do a $2.8 billion deal if you're still going to have liability? And the answer is the Power 5 conferences of the NCAA are concerned that if they don't do that deal, the actual liability could be $20 billion. And if it's $20 billion, that raises the issue with potentially the NCAA go bankrupt. That raises the issue, is the NCAA too big to fail? There are all sorts of issues associated with this. And a lot of the actual issues, structurally and philosophically, haven't been solved.
And by the way, just to explain what that liability is for, this is for athletes who say that they were prevented from earning money going back to 2016 because the NCAA would not allow them to be paid for their performance on things.
That's good.
What is so strange in this is that now you're going to be able to pay players, and there are caps on some of these things. There are some players, it's going to make crazy decisions for who gets paid, who doesn't. And I think maybe the bigger question is what it means for other sports, sports that aren't going to be able to pay their athletes. That money is going to pay for the programs that are the big money makers, other stuff that used to rely on the money that was coming from the programs or from the NCAA. They're in big trouble. What's the rest of the...
They are in trouble. The Power 5 conferences had a chance to vote on this. The NCAA technically represented the rest of the conferences, with another 90 conferences. But they didn't really have a seat at the table. So the smaller conferences are not happy with that. And there's a real concern that they're not going to be treated fairly. There's real concerns that institutions may have to get rid of certain sports. There are major, major issues that are associated with that. The one thing, though, that we don't talk about too much is how much, all the noise for the last 3 years about what's happening here with paying the players in NIL. How much talk have you heard about academics? How much have you heard about eligibility? Okay, so I think we all know the stat: 75% of the NBA players and NFL players that have retired after 5 years, they go broke. Okay, that's NBA and NFL players. What kind of financial literacy is part of the life of a 18, 19, 20, 21-year-old kid? To what extent might they be taken advantage of with regard to the agents? To what extent do academics really, really matter with regard to all this? And those are significant, significant questions that are not being addressed. So philosophically, you even have you have an argument. I think, maybe not an argument, but you have an existentialist argument for why universities exist and the part of sports within those universities. Then over here you have
athletics supporting
athletics, athletics part of that. And then over here you have pure-based capitalism where money's involved, etc. Can the two exist together? Now I think they can, but not the way we're set up now. I think
So how would you do it?
I would have two distinct groups. Now there are details behind this that we can spend a little time on as well. But the simple version is you have a group that is professional, period, end of story. That's capitalism. You have a group that is amateur, period. That can be taken care of by the NCAA.
Wait a minute, you mean different sports, or?
No, I mean, well, it could be different sports.
Like everybody on football is going to have to be a pro, or?
No, but for Power 5 football, for example, would definitely be part of this. But to keep it simple, Division I, let's say, is professional.
Okay.
So they've got to break away from the NCAA. They've got to have expert outside executive management leadership. I mentioned before in here that if the NFL modeled themselves after college athletics, they'd go out of business. So bring people in from the NFL, model yourself after the pros, have collective bargaining, have salary caps. It's professional athletics within college.
This is so sad as a fan.
No, but it's where we are. It's where we are. Okay, now Division II and Division III, it's a little bit more sophisticated than this. That would be amateur. The amateurs, Division II and Division III, stay with the NCAA. They stay with the NCAA, they're amateurs. They do not get paid. None of those schools pay their players. None of the schools. They can't get NIL deals, et cetera, et cetera. if they want an NIL deal, a kid, he's got to be good enough to be recruited by the professional group. Now, the professional group, it won't be all of Division I, but it'd be the Power 5 schools.
What you're talking about, though, what you're talking about is basically taking and creating a mid-tier between college and the pros that didn't exist before.
It's almost like a AAA,
right, a minor league
team, no?
Right now, though, we have chaos within this. There are still structural issues. How are you still going to handle the portal? How are you going to handle transfer?
So basically, what you're saying is NIL screwed all of this up. And
no, it can't blame on NIL. The players deserve to get paid. I think what the issues were when this first happened, this is the most significant thing that happened in the history of college sports, period. And when this was announced over 3 years ago, the NCAA abdicated their responsibility on this. That's why, to me, that's a horrific example of leadership. I've been 5 decades in the world of football coaching, athletics, education, as well as the business world. And I've not seen a greater example of the lack of leadership than what I saw when this happened then. Then college athletics was supposed to come and fill in the void 6 months later with their own transition group, which hasn't happened yet. So this is what they're coming up with now.
Is this just going to accelerate the move from students, even though they can get paid now? Is there any view that this will just accelerate them to go to the pros immediately?
I think it's all a matter of money, right? It's a simple matter of money. So if I get paid $5 million by being the quarterback at Ohio State, and I'm going to get $1 million by going to the NFL, I'll probably stay. Right? If I could get $10 million going to the NFL, I will probably leave. So that becomes more a matter of money than it would anything else.
It just seems like such a convoluted, complicated process in setting up. Like where, and an admission. I mean, it's been a long time coming. A lot of these athletes have been abused over the years, and that's
and I agree with all that.
Either.
Right. I literally agree. I mean, I certainly agree with all that. I think, Phil, when this happened, again, there's no structure, no guideline. We talked about it before. You put your name on a portal. And by the way, there's 565,000 college athletes today. Last year, only 17% of Division I athletes got NIL money, and the average was 3,500. 90% of all college athletes are not going to get a dime out of this.
Well, how is this going to change the economics of education, though? Because money that was ostensibly going to subsidize either other athletics at the school and or hopefully some form of academics at these schools, I assume is now going to have to get funneled to the players.
Yes, yes. So if we do it this way, we have a professional group, right? If it's capitalism, well, there's got to be profitability associated with that, right? So the individual players are going to make some money. The university should be making some money as well. If they're not, they're not going to be able to.
But there's going to be a lower amount of
sports. How are you going to have a guy blocking for a quarterback who's making $5 million who's there on scholarship? At some point, go ahead.
Yeah, but that responsibility would be the responsibility of the coach, and that's his job or her job to make sure, whether it's football, it'll be his job to make sure that that offensive lineman understands what his role is.
Coaches are already like, forget it. The portal has made my job impossible because I'm losing my entire team every year if I don't pay them the money.
College coaches do not like this, right? We hate this as college coaches, but this is what we've inherited. And college coaches, just like in the business world, we've got to be able to adapt and adjust to this. The way we used to recruit 5 years ago is totally different than the way we recruit now. Back then it was, are you a fit for our school? How do you feel about our majors, our graduate programs, and our teachers, et cetera, et cetera? Now it's literally, if you talk to many coaches that I know, the first thing that comes out of a player's mouth or his family's mouth is like, what kind of NIL opportunity am I going to get?
Okay, so a win for the athletes. Who's the loser in this?
Well, right now, I think the 500,000 plus college athletes that are not going to get a dime are the losers. The smaller schools are the losers. The lack of revenue sports potentially are the losers. That's why that's got to be figured out yet. And I keep hearing about the money. I don't hear about financial literacy. I don't hear about eligibility. Right. I don't hear about the small schools. I don't hear about graduation.
And it's a shame. The money. Okay, go to the pros if that's what you were going to do. Don't come to the college levels. Let us have this be.
But most of the guys are not going to be good enough to get to the pros. Right. So this will be their opportunity to wind up making some money. And again, remember, I'm not opposed to the athletes getting paid. I am totally opposed to the lack of structure, the lack of organization, the lack of discipline that surround this. Again, so what's the purpose of a university? What's the purpose of athletics within the university? And you've got pure professional athletics over here as part of university life. But they're two separate worlds. They're separate worlds. That's why I think the only way it works is to have ultimately a major separation.
Joe, thank you so much. I
Thank
still
you,
don't
Becky.
understand all of it. I think we need more information, but I understand it better than I did. Thank you.
Thanks, Becky. Thanks, Andrew.
Thank you. Coming up when we return, travel trends and gas prices. If you're a road warrior this weekend or maybe this summer, everything you need to know. And then later, the DOJ's big case against Live Nation and Ticketmaster. We're going to speak with the DOJ's Principal Deputy Assistant Attorney General about that case. We're coming right back. Big hour ahead.
You're trying to solve. It is 8 a.m. on the East Coast, and you are watching Squawk Box right here on CNBC. I'm Becky Quick along with Andrew Ross Sorkin. Joe is off today. Among today's top stories, the SEC approving a rule change that could pave the way for ETFs that buy and hold the cryptocurrency Ether. That decision comes about 6 months after the SEC greenlit a slate of spot Bitcoin ETFs. Facebook parent Meta Platforms considering charging users for a more advanced version of its AI assistant. That's according to the information. No details yet on how much a service like that would cost. And Novo Nordisk reporting positive results from a study of diabetes drug Ozempic. According to late-stage data, Ozempic helps slow the worsening of kidney dysfunction in patients with type 2 diabetes. It also lowered the risk of kidney failure, heart problems, stroke, and death.
Take a look at the futures on this Friday morning, about an hour and a half before we're set to open. Dow up about 26, 27 points. You look at the NASDAQ up about 55 points, and the S&P 500 up about 14 points. We'll show you treasuries as well. The 10-year 4.483, the 2-year now at 4.942, just under 5 there. And want to get straight over to Mike Santoli, who has relocated from the NASDAQ. Thanks for hanging out with us earlier this week. Back now at the New York Stock Exchange.
And you've relocated from Central Paris. Andrew, good to have you back.
So we're sort of trying to find our footing here in terms of the indexes. Had a minor jolt, I would call it, yesterday. Very strong open, print an intraday high in the S&P 500 in the morning. Everyone maybe thought NVIDIA was going to have some coattails and get the overall market up, but Treasury yields higher. That's been a problem for the broadening out of this market. So here you see we're only a percent or so from closing highs at this point. 52.50 is a kind of an interesting area. It is the former high, and we kind of jumped off of there in mid-May. You could probably go down another, 120 points from here, and you're still at the 50-day average. So nothing too unusual or outsized about this pullback, but it definitely showed you that we do still have to keep an eye on Treasury yields and whether inflation's friendly or not. Now take a look at the S&P 500 relative to its equal weight version. This has been a fixation for months right now, and you see equal weighted S&P right here, which kind of sort of adjusts for the strength of the mega cap growth stocks. Has done fine and kept pace over this period up until recently, and now it's kind of faltered a little bit. A lot of consumer cyclicals in other areas have softened up, they've corrected. So you see equal weight is back to levels we were trading at in early March, whereas you've had a lot more air underneath the market cap weighted version, which of course owes to that kind of defensive attributes of the big growth stocks and just NVIDIA's outright strength. Speaking of NVIDIA's outright strength, I point to this relationship quite a bit, as you know, NVIDIA versus Bitcoin. This goes back to the middle of last year, and it's pretty much riding a similar wave of enthusiasm and energy, even if it's not specifically linked. But you see NVIDIA with these reports yesterday of those numbers really separating itself, at least for the moment. We'll see if there's any follow-through in either direction there, Andrew. Okay, Mike, thank you for that. Appreciate it. Have a great weekend if we don't see you before then. Meantime, some new data coming from Gas Buddy showing 76% of Americans plan to take to the road between Memorial Day and Labor Day. That's up 18% from last year. Joining us now to talk about the latest travel trends and how it impacts energy markets, Patrick DeHaan, head of petroleum analysis at Gas Buddy. Good morning to you. What do you think? What are we going to be seeing? Is sticker shock or not?
Oh, thankfully, Andrew, not a whole lot of sticker shock. Prices up modestly, just 6 cents from last year. It's interesting to watch the trends, though. TSA predicting and already seeing some record number of travelers via air. Our week-to-date gasoline demand data showing that week-to-date through Thursday, compared to last year, gasoline demand down about 7.7%. So it looks like 2024 might be skewing towards air travel, not necessarily on the road. Certainly, there'll still be millions of Americans out there. They'll be paying about $3.61 a gallon. That's down from $3.69. The good news, Andrew, for anyone hitting the road this summer is we expect progressive decreases between Memorial Day, July 4, and then Labor Day. Of course, there are the typical caveats. Mother Nature, hurricane season is a big wild card. And we have seen a rash of minor refinery issues in the Great Lakes. That is going to be something that could bother motorists this summer. If there are refinery outages, that could temporarily drive prices up locally.
All right. It's a very interesting issue because people talk about gas prices as sort of a billboard for inflation, and it's a political issue, especially in an election year where you see the price of gasoline on the corner of every other block that you go to. How quickly do you think it does come down? And if you were to handicap the possibilities where you said in some local markets it may go up, we're going to see that and where?
Well, I watch it from the West Coast. California is an extremely tight market. Really, all it takes is one minor issue on the West Coast to really derail California and potentially Arizona. Arizona has their own blend, or the Great Lakes. We've seen some of that tightness emerge there. Now, with gasoline being released from the Northeast Gasoline Reserve, that could push prices down a little bit in your neck of the woods there in the Northeast. Areas like New Jersey, New York, Boston, Maine may get a little bit of a tailwind from that in the form of falling prices here over the next 4 weeks. But I think for the rest of us, the national average should modestly decrease, maybe 5 to 10 cents between now and July 4. So not a huge drop. But I think that could accelerate, especially as we get into August. Again, the big wild card is hurricanes. There's a pretty significant risk this year that something could develop in the Gulf of Mexico. Of course, that's where North America's largest refining hub is, right. A particularly sensitive area. But by the election, if the seasonality goes per normal, we could see the national average falling below $3 in November or December.
How much do you think this surge in travel demand, you're talking about up 18% this summer, is actually a function of the price Meaning we kept saying we were living in this YOLO world where people were, you know, every summer, more people were going out hitting the road. And you kept thinking, is there a ceiling here?
Well, yeah, I think to your point, it's talking out of both sides of our mouth. At one point, Americans are griping about the price of gasoline, but as the numbers show, it's not going to really hold anyone back. I mean, we get 3 or 4 good months a year, at least for us here in the northern half of the country, for most of the country. Summer's not everlasting, and so Americans really don't care what gasoline prices are. Having said that, we're still going to see a lot of complaining about gas prices being above average, but if you do the long-term inflation-adjusted numbers, this gas price paid today is not necessarily significantly out of that norm. Americans are getting paid more, and so adjusting for inflation, gas prices are nowhere near record levels.
Patrick, I want to thank you for joining us this morning. Have a great weekend.
Thanks, Andrew.
You don't hit too much traffic if you do hit the road.
I appreciate that. Take care.
When we come back, we will speak with a New York State senator who is looking to bolster kids' online protections. But to get his way, he will have to get by a reported 7-figure opposition campaign from big tech. Stay tuned. You're watching Squawk Box, and this is CNBC.
Welcome back to Squawk Box. Take a look at the futures right now. Dow up about 17 points. The NASDAQ about 45 points. The S&P 500 up about 11 points.
Our next guest is a New York State legislator who has sponsored 2 child online safety bills, but he is running into opposition from one of the most well-funded industries out there. Joining us right now to talk about his battle against big tech is New York State Senator Andrew Gennardis. The Safe for Kids Act that he sponsored aims to curb addictive features of social media, while the New York Child Data Protection Act looks to restrict sites from collecting and selling kids' information. And Senator, welcome. Thank you for being here.
Thanks so much for having me, Betsy. Good morning.
So let's talk a little bit about what is happening here and what these two bills that you've proposed would actually do.
Yeah, so the two bills that we're proposing that we're actively negotiating right now would really aim to protect kids' well-being and their mental health on social media, as well as their personal data. The Safe for Kids Act would limit the ability of social media apps to use addictive algorithms or predictive algorithms in curating content to show kids that they are not signing up to see, that is actually addicting them to stay on their phones longer and longer and longer, which is leading to significant mental health issues. The rates of depression, anxiety, hospital admissions for self-harm, suicidal ideations. You pick the age demographic amongst teenagers and young kids. The rates of these incidences are either doubling, tripling, or quadrupling in some instances. And it's a real problem. And it's not just Andrew Gennardis saying that. This is the U.S. Surgeon General, the chief public health officer in the country, saying that social media last year in an advisory is not sufficiently safe for kids. So we want to restrict the ability of these algorithms to prey on the insecurities and vulnerabilities of young users as a default. And then the parallel bill, the Child Data Privacy the Protection Act, would limit internet companies' ability to collect personal data from children just to monetize it and to sell them more ads. And the reason these two go hand in hand is because the addictive algorithms serve to keep kids' eyes glued on the screens longer, so that the internet companies can make more ad revenue off of these children. And in 2022, the most recent year we have the data for, big tech companies made $11 billion just in ad sales to kids. Now, I'm of the view, I have two young kids myself, that kids' personal privacy and kids' data and their mental health should not be for sale.
Right. Let me ask you this, and I agree with you in many respects in that I have kids and we all, and even myself, I feel addicted in so many ways. However, as I'm reading through some of the proposals around these algorithms that you're trying to block, it raises a different question for me, which is that, some of these algorithms, while they're not working as well as we'd like them to, and maybe they're working against us in certain cases, they also do filter out hate, and they do filter out harassment to some extent. They don't do it as much as we'd like, clearly. But depending on how this bill is written, it seems to me that you could actually be preventing some of that from even happening at all.
Yeah, so that's actually something we've heard a lot from the tech companies, because they don't want us to touch algorithms whatsoever. The reality is the algorithm functions at its core like a formula, and it takes a bunch of inputs and then it produces an output. These companies are well able to set up this formula to screen for hate content, for bad content, while still giving children the ability to find whatever content they want on their own without having to feed them content they don't sign up to see at all. These algorithms really function like heat-seeking missiles. They are designed intentionally, and this is based on their own documents from litigation going on right now against Meta, for example, that when they designed these algorithms, they've actually studied slot machines in casinos and the psychological effects of slot machines and the addictive nature of just one more pull, just one more pull, one more coin,
I'm not
one more
disagreeing.
video.
I think there's a total dopamine hit issue.
Exactly.
And by the way, even Elon Musk was saying this yesterday, that he thinks that social media, and he owns X, is bad
That's exactly
for kids.
right. And by the way, Andrew, we're not restricting content in any way, so you can still search for your friends, still search for your family, still follow the Taylor Swift fan page, still Cover Project page. We're not restricting your ability to access content whatsoever, just how the companies can show you the content that you're not
But I think there's a
signing
very
to see.
specific issue that clearly the tech companies are, and maybe they're pushing back on you as it relates to this, is, look, the algorithms are working, they just don't work as well as you want. And the question is, do you believe that they're purposely not working as well as you want, or that they actually just don't? And I imagine it's somewhere in between.
I think you're right. It is somewhere in between. The algorithms can be tweaked in a way to filter out the hate content. That's different from designing the algorithm in a way to intentionally addict someone and to keep them on a screen longer and longer and longer. Look, the average teenager today spends at least 4 hours on social media a day. That's not just because they're bored at home. That's because the apps are intentionally manipulating them and keeping their eyes glued on these screens longer and longer and longer. And that's just the average.
Andrew, you've got some pretty big charges, though. You say that the tech companies are funding a whisper campaign to try and convince your fellow legislators not to go along with this, that they're coming up with excuses that you don't buy.
Yeah, no, it's more than just an allegation. It's true. Because of the lobbying disclosures that they have to fill out in New York, we see that the big tech companies have spent nearly $1 million hiring an army of lobbyists to patrol the halls of Albany and to whisper in people's ears saying, hey, we want to keep kids safe, but we can do it on our terms. I think the public record has shown very clearly, just look at the congressional hearings earlier this year, that if we leave it up to the companies themselves, they are wholly not up to the job because it's not in their financial interest to take the most far-reaching measures that'll protect kids. They have an enormous financial stake in continuing the status quo. And so they're whispering in people's ears, they're saying, don't do it this way, don't do it that way, and we see it for what it is.
The argument that they make is, or one of many arguments they make, is that it would be this mismatch of rules if you're in New York and you travel to New Jersey or Connecticut, that the rules are going to be hard to follow in different states. But I think there is some logic to having states come up with pretty tough legislation anyway, because eventually it would mean that these companies would push for federal legislation so that they don't have the mismatch of states. I mean, we've seen it before. Amazon used to not pay sales tax on a state-by-state locality or a local jurisdiction until every state started doing something differently, every local jurisdiction started doing something, and then they were in favor of federal rules that would actually force them to pay sales tax.
Yeah, that's right. And look, the last time Congress passed comprehensive legislation to protect kids online was 1998. We were all still getting America Online discs sent to us in the mail maybe 2 or 3 times a week back then. The internet has changed 1,000 times over. There's no reason why our federal law should still be dated from the last century. Ever since we introduced the Safe for Kids Act and the Child Data Protection Act, California has introduced identical legislation, so has West Virginia and Virginia. And so I think to your point, if we're successful here, we can start a national model that'll spread across the country and then by default become the national standard while we still wait for Congress to get its act together.
Thank you for your time. I mean, this is going to be interesting to watch. New York State Senator Andrew Gennardis, we appreciate it.
Thank you, guys.
Okay, coming up after this Memorial Day travel surge, airports expected to be jammed this holiday weekend. After the break, we are going to get the lay of the land, or rather the state of the skies. And later this hour, we're going to speak with a top Department of Justice official on the government's big antitrust case that it just brought this week against Ticketmaster parent Live Nation and its effort to break it up. Stay tuned. You're watching Squawk Box on CNBC. rules.
Welcome back to Squawk Box, everybody. As people are hitting the roads for this holiday weekend, we want to take a look at what's been happening with energy prices. If you check out WTI crude this morning, hitting its lowest level since late February, 76.78. It's down close to 5% just this week.
Meantime, AAA is saying this will be the busiest Memorial Day weekend for air travelers in close to 20 years. 3.5 million passengers expected to fly this holiday weekend, up 5% from last year, 9% from before the pandemic. And just in time, Southwest fares are now appearing on Google Flights. Joining us now on all of this, David Vernon, Bernstein Senior Research Analyst. Here we are. The summer is upon us. I thought the YOLO situation was never gonna stop at some point. There was a ceiling to it. We were just talking about it in the context of driving, and it doesn't seem to be over.
People want to travel. After the pandemic and after dealing with a couple years being locked away, travel demand remains really, really strong. I also think there's something up to the idea that the changes in work-life balance, remote work is adding a little bit to extra demand. And as you mentioned, travel demand this summer should be up 6-7% relative to last year.
Are we still seeing a shift in terms of the timing? You know, there was a moment, sort of post-pandemic, where the hot day used to be Friday afternoon, Sunday night, and then it moved from Thursday night, up to Thursday night, and back even on Monday night. So are we seeing any switch in that kind of traffic?
Yeah, there's definitely a change in terms of the cadence of when the most in-demand flights are. The airlines have all started to adjust their schedules, trying to kind of position themselves to stop running peak flights Monday morning, maybe stretching it out a little bit during the week. So we are still seeing how those travel demand patterns are changing, and I don't think we're at any sort of the new normal yet. I still think the airlines are kind of adjusting to it. So they're going to have some better opportunities, I think, to yield manage going forward as they get a better understanding of exactly when and how people want to travel in this new environment.
We got Southwest up on the screen. I'm curious, of the airlines as stocks, as investments, what do you like today? What don't you like today?
So we have a strong preference for the legacy major airlines, Delta, United, American. The discounters, and particularly the ultra-low-cost carriers that have been operating with a movie theater ticket model kind of for a while, where they give you a very low price and then add in a bunch of bag fees, that entire low end of the market has been massively disrupted. And that's also had some negative implications for Southwest as one of the bigger discounters. The major airlines, Delta, United, and American, have figured out how to put a basic product out in the marketplace that competes in the discount aisle, that allows them then to protect their fares at the upper end of the ladder, and they've essentially flooded the market with discount capacity. That's putting a lot of pressure on the lower cost operators, and in fact, when you look at how the industry's been performing over the last couple of years, the margins of the legacy airlines are much better than any of the discounters, and that's a fairly new phenomenon and a direct result of the changes in the way they're bringing their products to market.
What are you seeing on pricing? And by the way, how much of all of this is being impacted by just a shortage of available planes, meaning physical planes, given all the issues we've had with Boeing and everything else?
Yeah, so capacity constraints are definitely part of it. And one of the things we like about the airline investment case right now is the supply-demand characteristics are definitely a little bit more in your favor. But I do think that this idea that fares at the low end may be a little bit lower, but at the higher end are growing a little bit. Pushing up that higher end of the fare distribution has really been what Delta has shown the industry how to do. And that's changing their economics in a way that's really beneficial, I think, to pretty much the broad travel market. It's not so good for the lower cost carriers and the discounters who are trying to now compete with these full service airlines that can get you anywhere in any style and any price point. But it is definitely something that I think the travel public is going to benefit from in the long run.
David, I want to thank you for joining us. Hope you have a great long weekend, and if you're traveling somewhere, that the flight gets there safely and fast.
Go early, because TSA screenings were up 7% yesterday.
Go with that.
You got to, I got to tell you, you got to go early. Even with Clear, you got to. Sometimes the TSA lines are bigger than the TSA lines bigger than the Clear line.
All right, when we come back next, some breaking economic data. We're going to take a new look at durable goods orders. Squawk Box will be right back. Welcome back, everybody. We are just a few seconds away from the April durable goods orders. Ahead of that, you're looking at the Dow just turning into the red. Nasdaq's up by 35, S&P is up by 10. Let's get over to Rick Santelli. He's standing by at the CFP in Chicago.
Yes, Becky, April preliminary read for durable goods expected to be down 0.8%, so down close to 1%. Comes up a winner, up 0.7%, up 0.7. And in terms of revisions, I'll get to those in a moment. Now, if we strip out transportation, it's still fairly lofty and well above expectations at up 0.4%. And if we look at capital good orders, non-defense ex-aircraft, a proxy for capital spending, expected to be up 0.1%, also coming in better than expected, up 0.3%. And finally, let's switch from orders to shipments. And orders for shipments are up 0.4%, and that, of course, is also better than the 0.1 expected. So we beat on every line. But here's the issue. This is preliminary. If you looked at March's preliminary, they were very lofty. The headline was 2.6 and ended up 0.9. So from preliminary to final reads, we get big revisions, and that 0.9 just actually became revised again in March to 0.8. So it started out 2.6, ended up at 0.8. So we want to be very careful. It's a very volatile series, but still numbers are better than expected, and that does put a bit of a upside move in interest rates. Now, considering we're currently trading at 4.49 in a 10-year, that is up 7 basis points on the week. 4.94 for a 2-year puts it up 11 basis points on the week. We've had some significant psychological moves on the interest rate side because of the uncertainty, and I'm using the word that was in the minutes to the last meeting with regard to the Fed and their GPS on interest rate cuts and where the economy is exactly. And also, we have supply coming over the next couple of weeks, and that should underscore the rate game, because many believe, and I do as well, that one of the key ingredients that's keeping rates a little bit hotter than many would have suspected, in addition to what the Fed probably isn't going to do on the easing side, our debt issues and the auctions, which put it right in investors' faces every week or so as to how much issuance we're doing, which underscores how much spending that is behind it. Becky, back to you.
Rick, you are so good at what you do. I love how you're like figuring out the math on the fly while you continue to talk and get us to the end of that. And I was going to ask you what you think with all of these numbers, how this adds to the mix, how this shakes things up. It sounds like you think, yeah, higher rates are going to be here for quite a while, and this is just one more thing to add into that pot.
Yes, and I always like to make it a split decision. I understand that the Fed is quite important to all the strategies of everybody listening and watching on CNBC, but the market has a say-so too, and maybe a bigger say-so now than it's had in the past. So I think on the short end of the market, I still think there may be one ease, but the possibility of none exists, and I think the market's living with that rather well. But I do think that the debt structure of this country and the globe are going to keep rates a lot hotter, and I think pockets of inflation will remain stickier, and I think that the runway for the glide path that we're on the economy is going to traject lower. I'm not sure I subscribe to the Jamie Dimon outlook that potential for a hard landing is more significant than many believe, but I do think that a slowing is coming. Everything post-pandemic just seems to be stretched out in a longer timeline, and that's really difficult to deal with when we have so many questions as to global economies, supply chains. And I will point to one other fact, that when it comes to issuance is such a big issue, Europe, China are going to be putting much more paper into the marketplace. We know that the spreads for junk bonds, the highest yield, have narrowed, meaning the extra yield you get is getting smaller and smaller. All of that is compressing many of the issues that affect interest rates. I expect a much more volatile second half of the year on the 10-year.
I will say it again, you are so good, Rick. Thank you. For more reaction to today's data and a big week of Fed speak centering on the future direction of interest rates, we want to bring in Allison Schrager. She's Senior Fellow at the Manhattan Institute and Brookings Institution's Senior Economic Studies Fellow, Wendy Edelberg. Welcome to both of you. Let's kind of start where Rick just left things. And Wendy, this is one piece of information in a much larger puzzle that we're trying to piece together. But do you agree with Rick's general assessment that it's going to be a lot tougher for the Fed to raise rates? The market can be pushing back, and there are big issues we need to be watching just because of what it means for our ability to issue debt.
I think that monetary policy is being set with an eye to what's happening to inflation and what's happening to the labor market. I think monetary policy makers are doing their job irrespective of what it means for the cost of debt financing. Now, what they are paying attention to is how much pressure federal borrowing is putting on interest rates. And what that means is that the higher the interest rate is, because the federal government is in there competing with other borrowers, the higher that interest rate is, the more monetary policy makers have to raise interest rates to make sure monetary policy is tight. And so I think the direction is the higher the more federal borrowing we have, the more monetary policy makers have to raise interest rates. I think that's the direction of causality.
And Allison, in the meantime, as that's happening, how do you see the consumer shaping up on things? How do you see businesses shaping up?
Well, it seems like every piece of data we're getting each week is saying the same thing, which is demand is still really high in this economy. And as I said, we see this with the sort of bigger orders. We're going to see this with the consumer sentiment that's coming out in a couple hours. It just seems that we're in a really hot economy. And that means that I think with every data report, it seems like the odds of a Fed rate cut is getting lower and lower. And when it comes to interest rates, Wendy, Rick have made some really important points here. And I also want to add that as inflation gets stickier, it also starting to feel higher and more unstable. And that means rates like the 10-year rate are just going to be higher because the term premium, it's been a while since we've really had to think about the inflation in the term premium because inflation was so low for so long. That gets baked in too, not only expected inflation, which the report in a couple hours still expects to be above 3%, but the risk around inflation, like the inflation risk premium, also gets baked into the term premium, which means anything above 5 years, it might just be structurally higher for the time being.
I mean, is that okay, though, as long as the economy continues to chug along, Allison?
Yeah, it is. I mean, for most of, the last century, rates were definitely well above 5%, and we grew just fine. I mean, but it's a very different environment than we're used to. I think we have an economy largely built on very, very low, maybe zero real interest rates. So, I mean, it will be different, but there's no reason to believe that, it could be disaster either.
Yeah, I guess, Wendy, that depends on where you're sitting. There are going to be pockets where it does feel disastrous if you've built your business plan or something else around the idea that rates were not necessarily going to be zero, but we're going to be a lot lower than we actually wind up seeing.
The real risk here is inflation expectations. So right now we have tight monetary policy, a very strong economy, and higher than desired inflation. Those things actually all go together and suggest that monetary policy just has to stay tighter for longer. That doesn't mean that we're in for a hard landing necessarily. What it means is that monetary policy still has more work to do. Strong economy, high inflation, those go together. But the risk is if inflation expectations get stuck too high, then monetary policymakers have to cause some pain to convince everybody, no, we really mean it. Bring your inflation expectations back in line to what they were pre-pandemic. And yes, we will see what survey responders say when we get the Michigan survey. I really don't know what to make of the Michigan survey these days. It's pretty much a mess. Consumers say they're miserable and they spend like they're unperturbed. So, we'll see. But I think inflation expectations is the thing to watch.
Allison, how much of that is the divide between consumers, though? Consumers continue to spend, but maybe it's not everybody.
Well, I mean, I think there's sort of two different economies happening. Sort of richer Americans, high-earning Americans spending like crazy, and they have a lot of income. But I say the bottom 50%, they had a lot of money coming out of the pandemic. It looks like those savings have largely been spent. And now we're seeing sort of higher default rates on credit cards, and they're still spending, but they're going into debt. So I think this might be partially what Rick meant when he said the economy is feeling stretched. So demand is still high. People aren't feeling good, but they're still spending somehow.
What number do you look for next, aside from this Michigan number that we know is coming up today? What's the next biggie that could have an impact and make markets reevaluate once again? Wendy, I'll start with you.
Well, I mean, it's always the employment report. That is where we're laser focused to see if monetary policy is doing what it needs to do to get the labor market to a sustainable place. But the puzzle there is that immigration has just wildly upended what we might expect for those numbers. So now I expect, when I look at the employment report, if monetary policy is doing its job in getting the labor market to a nice, sustainable place, we should be looking for numbers like 175,000 a month, which is probably double what you would have expected in absence of the surge in immigration. So we need to look at the employment report.
You mean illegal immigration, more people here taking some of those jobs?
Well, it's not illegal. They're for the majority of the people, 3/4 of the people that we're talking about coming into the country are here legally. They're getting work permits. They've applied for asylum. They're here for humanitarian reasons. They're in the immigration system and in this country legally.
Allison, let's just quickly wrap up here. Are you in Jamie Dimon's camp the concern that things could get stretched, we could see the economy turn down, inflation continue to run high, and then look at some sort of a stagflation issue? Maybe not exactly like the 70s, but one that would rival it?
I'm not so concerned about a hard landing where things are. I mean, what does concern me is that we have a big negative shock and we're not quite as resilient, and that could go badly. But I think, we could keep chugging along with 3% inflation and low unemployment and 5-ish% interest rates for a while. The problem is if anything goes wrong.
Okay. Allison, Wendy, thank you both for joining us on this Friday before a long weekend. Hope you have a great one.
You too.
Coming up when we return, the government's big antitrust case against Ticketmaster parent Live Nation. How strong is it, and what could a broken up company do for fans tired of sky-high prices? We're going to speak with a top DOJ official next. And a reminder, as we head to a break, you can always watch us and listen to us using the CNBC app. You can do it right now if you want. Stay tuned. We're coming right back live from the NASDAQ market site in Times Square.
DC.
Welcome back to Squawk Box. Take a look at the futures right now. We've still got about 45 minutes before the market's set to open, but it'll open higher if things stick where they are right now. Dow up about 45 points, NASDAQ up about 67 points, and you're looking at the S&P 500 up about 16 points.
Norfolk Southern agreeing to pay more than $300 million to settle charges that a toxic train derailment from early last year. The majority of the settlement is an estimated $235 million to cover past and future cleanup efforts. The company's also going to be paying a $15 million civil penalty to resolve alleged violations of the Clean Water Act. The freight train was carrying hazardous materials when it derailed in February 2023 in East Palestine, Ohio. It ignited a days-long fire that forced local residents to evacuate and contaminated soil and waterways. Norfolk Southern is estimated to have spent about $1.7 billion in total cost associated with that incident. The cleanup is expected to conclude sometime this November.
Meantime, let's talk about the Department of Justice's big case, because it is now suing to break up Ticketmaster parent company Live Nation over alleged antitrust violations. Ticketmaster and Live Nation combined back in 2010 and became dominant in the live events industry. This week's lawsuit, supported by 30 states, and follows an investigation begun in 2022 after Ticketmaster botched a rollout of that highly sought-after Taylor Swift tour tickets. And joining us right now to talk all about this is Doa Meki. She's the Principal Deputy Assistant Attorney General for the Antitrust Division at the Department of Justice. Good morning to you. It's a fascinating case. I think we're all trying to understand what the implications are and whether prices would, how much prices would come down if you are successful.
Thank you so much for having me. This case is about the control that Ticketmaster and its parent Live Nation Entertainment exert over every level of the live music industry. And so that's everything from the artist to venues to promotions to the way fans experience music. And so fans absolutely experience the pinch of Ticketmaster's high fees. And this lawsuit really walks the American public through the different ways in which Live Nation and Ticketmaster are able to exert monopoly power and abuse it in ways that raise costs for fans and take more money out of the pockets of hardworking, talented artists, particularly the working artists who have less ability to negotiate with Live Nation and Ticketmaster.
Well, that's what I was going to ask you. How much of this is focused on helping the fan versus helping the artist, if you will?
There are lots of different markets in which we have made allegations that Ticketmaster and Live Nation abuse their monopoly power. Some of them are fan-facing, some of them are venue-facing, and some of them are artist-facing. And so what becomes clear when you look through the complaint, and I would urge you and the public to read the complaint, is that there are harms that are felt throughout the ecosystem, and that's really the way that Live Nation and Ticketmaster maintain their dominance and enrich themselves while harming fans, artists, venues, and everyone in between.
You know, a lot of fans look at the price and they go, oh my goodness, how is it possible these prices are so sky high? And yet, at least in the United States, and I was just in Paris yesterday and I was talking to somebody about Taylor Swift just played over there, about the distinction between prices in Europe and prices here and how much lower prices are there versus here. But part of it does seem to be that there is a secondary ticket market in the United States and a demand issue almost apart from any of the monopoly issues, which I'm not disputing may be part of it, but there's a real question mark about how much of the price tag that fans are paying is inflated as a result of the fact that you think that this company has too much power versus a whole sort of ecosystem, if you will, that's so different than in other places.
Sure. So the Attorney General yesterday, in announcing this lawsuit, put it perfectly. This case is not about the fact that there's scarcity for tickets or frustration or inconvenience. This is about monopoly power. This is about retaliation and threats and exclusive agreements and the abuse of monopoly power that frankly subverts the competitive process in these markets. And so we are champions of talent and labor, and we think that artists who are successful should be able to be rewarded for those talents. But this is about something different. This is not about an ordinary demand and supply curve for live music. This is about the extraction of monopoly rent through abuses.
I appreciate that. I'm just trying to, I'm trying to get to push you to see if you can actually just quantify, though, what percentage of a ticket sale you think is effectively a monopoly extraction.
So it's important to note, Andrew, that we are not required to identify or quantify a specific percentage that is monopoly rent. The antitrust laws are concerned with subversion of the competitive process, the fact that the market is not functioning as it was intended because of anti-competitive practices. And so there is, this is really a beginning and not an end. There will be discovery, there will be expert discovery, and there will be opportunities to explain both in terms of price, but also quality and loss of innovation that really hampers the experience that fans are facing, including through exorbitant fees.
Was there any discussion prior to bringing the suit of some kind of forced settlement?
I can't get into the discussions that we had with Live Nation, but we always think about opportunities to resolve competition concerns. And here we are in the place of having had to file a lawsuit precisely because our competition concerns persist.
When you think about the artist, which I know is a big component of this case, again, can I ask you to quantify it or at least give us some kind of color or sense of how you think the artist is being damaged and by how much?
So again, this is not about quantification of harm. The antitrust laws consider things like abusive bargaining leverage, and we take great pains in the complaint to talk about how differently suited the stars that are often in the press, but also the working artists who are not able to counter pressure that we allege Live Nation and Ticketmaster exert on them to use, for example, Live Nation and Ticketmaster's promotion services or a preferred venue with ticketing software. And so it's really not about quantifying a particular dollar amount, although harm will probably be manifested not only in dollar amounts, but also qualitative non-price factors.
Right. You've talked about spinning off or splitting Ticketmaster. Is that the only solution to this? Is there more that you would like to do?
So anytime we go to court on a monopolization case, we are tasked with proving up the exact contours of how a monopoly abuses its monopoly power, and we have to get a liability finding. Only after a judge finds that a company has in fact violated the antitrust laws, or sometimes a jury has violated the antitrust laws, then we get to remedy, and the remedy has to be specifically tailored to addressing the harm. Sometimes that has meant breakups. Sometimes that has meant equitable relief, behavioral factors and such, and sometimes it's a combination of the two. Here, we've alleged that there are so many conflicts of interest and an interconnectedness among the different parts of Live Nation and Ticketmaster's businesses that structural relief will likely be required in order to seek redress and open up the market for competition.
Live Nation, in its response, says that there's more competition than ever in the live markets, live events markets. They say that's why Ticketmaster's market share has declined since 2010. Is that true?
Obviously, we dispute some of the facts that they have set out, and that's precisely why we are in litigation. And so at this point, we will make our case to the court, and it will ultimately be up to the courts to decide whether, in fact, Ticketmaster and Live Nation have monopoly power.
Right. Final question for you, and I think it's a question that a lot of CEOs are thinking about today, which is, this was originally a transaction which was approved and allowed to go through over a decade ago now, about 14 years ago. And so there's a question about sort of reaching back, if you will. How do you think that the business community should think about that?
So to clarify, this case is a Section 2 of the Sherman Act monopolization lawsuit. The merger that you're talking about happened, in fact, in 2010, and that was addressed under Section 7 of the Clayton Act. If you read the complaint that we filed alongside 30 attorneys general yesterday, you will see that it is a more sweeping and more expansive accounting of the different places that we believe Live Nation and Ticketmaster has abused monopoly power or engaged in contracts or other coordinated conduct that we think violates the antitrust laws. Again, the 2010 deal was really about ticketing services and certain anti-retaliation provisions focused on venues, and this is just much broader.
We look forward to following the progress of this case on all sides, and we appreciate you joining us this morning. Thank you very, very much.
Thank you so much.
See you soon, and have a great weekend.
You too.
All right, coming up, top stocks to watch as we make our way towards the opening bell on Wall Street. Squawk Box will be right back.
Welcome back to Squawk Box. Dominic Chu joins us once again. Take a look at this morning's big movers. Dom.
All right, a couple of earnings movers this morning, Andrew. Becky, related to reports after last night's close, both in retail. We'll start with Ross Stores, which is up about 7-8% right now. 40,000 shares of volume. The off-price retailer is gaining ground after beating profit and revenue estimates. It also gave a current quarter profit forecast range where the midpoint came in slightly above estimates, even as its forecast for sales growth at established store locations came in below some forecasts. So on balance, up 8%. Then you got Deckers Outdoor. They are up over 12%, 15,000 shares of volume. The parent company of popular footwear brands like UGG and Hoka are also reporting better than expected profits and revenues as well. Some aspects of its forecast came in a little below estimates. And then check out this analyst call for Toast. Those shares are up. Evercore's initiating with Wedbush with an outperform rating on that particular stock. Check out cnbc.pro.com for more of that story. I'll send things, Becky, Andrew, back over to you guys.
Okay, Dom, thank you. Appreciate it very, very much. We've only got about 20 seconds. Take a quick final check on the markets right now. The Dow looking up and NASDAQ looking up and the S&P 500 looking up. So there we go for a nice 3-day weekend.
As we head into that weekend, it is Memorial Day, and that's a time we honor and thank our troops, those who have served and those who have given the ultimate sacrifice in that service, and we do thank them for that.
Very much so, very much so. In the meantime, do have a good weekend, and make sure you join us on Tuesday. Squawk on the Street is next.
Good Friday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Jim Cramer at Post 9 of the New York Stock Exchange. David Faber's on assignment. Bulls on the hunt for some signs of stability after the Dow's worst day in more than a year. Benchmark yield still a bit toasty near 449. Durables ran hot, although oil near a 3-month low. Our roadmap begins with the day after the sell-off. The Dow dropping 600 points on pace to break a 5-week win streak. One name that is moving higher, though, is NVIDIA, up again in the pre-market after adding more than $200 billion in valuation following that big earnings beat. And then Elon Musk reversing his stance on Chinese EV tariffs, now saying he opposes the U.S. moves on those autos. Let's begin with the markets after the sell-off yesterday, Jim. A lot of things you could point to, PMIs, some concerns about commercial real estate.
Well, I'm glad you point out the second one, because what's happened is that we've got this feeling that the reason why the commercial real estate is worrisome is because they're not cutting. And it's kind of a chicken and egg thing, but I mean, yesterday was jarring. Oh, geez, here we go again. Durable's a little too strong. But I think if I were Jensen Huang, I would say, darn it, I would have been up 100. Not that he ever will. He's actually pretty confident fellow, but that stock would have been up really huge and carried a lot of other stocks. But because the bonds interest rates went up so much, everything reversed, and the only thing that was still up in semis was NVIDIA. Look, yesterday was a bad day. It was a really bad day because we got oversold very quickly, by the way, because we had no leadership. There was no follower to NVIDIA. I mean, today we have no doubt on NXP, and that's going to have more pin action than what happened with NVIDIA. But yesterday, Carl, we're getting this undercurrents about this Starwood S-REIT, and I want to hear from Barry, obviously, because I think when we heard from Barry Sterling, when we heard from Blackstone on theirs, it was pretty calming. We don't really talk about it much after. They did a good job. Jonathan Gray did a good job, and we kind of didn't want to make them. We never made a molehill into a mountain, and I don't want to make a molehill into Mount Sterling. It's not fair. Barry's a good guy. STWD has been giving you a good return, although it hasn't done much. But I'd like to hear from him about what he wants to do rather than just read the press reports.
Yeah, Jim's referring to this limited redemption,
yes.
Buying back 1% of the value instead of 5%. Right. Of course, Sternlicht's been a consistent critic of rates and
yes.
the impact they're at least having on his industry.
But he did talk about how there'll be a bank that will fail every week. And I think there are a lot of people who might be scared, not me, because I like Barry, who might just say, oh, give me a break. Well, maybe one of the reasons why they fail is you're defaulting on properties, you're doing these SPACs. I say, let's hear it from Barry, because I know he doesn't want to sell into a low, but how do we know it's a low? I mean, he's been telling us, one of the things that Barry has done is I don't like to ever be scared, but he has scared me. I would never, if you came to me, Carl, and said you had a real good deal on a commercial real estate property, I would say, did you ever hear of Barry Sternlicht? He is telling me not to be in it. And then he's the one that is front and center for a problem.
Yeah. And then on top of that today, Jim, Goldman gives up the ghost on a July cut. They moved to September.
Yeah.
They do say by September you'll have 4 more CPI prints. They think core PCE prints in the low 20s basis points. And by that point, they think the majority of the committee will be in favor.
I think that's right. I thought yesterday was an outlier with services. We still know the service economy is strong. I come back again and again, I'm going to say it. It's employment. And we don't have mass bankruptcies. I mean, we go over Red Lobster, and if we really think that the reason why it went down was unlimited shrimp scampi, well, then I'm going to take that out of the equation of what the Fed says, oh, that's a good one. I never want a Rite Aid to go under, because I happen to have a good Rite Aid across the street from me, but when you go there, they have like some razors, and that's like it. They're not shipping.
Yeah,
they're not shipping.
But you're talking about very specific execution issues.
And that's the problem. Well, the drugstore's obviously hideous, but that's the problem. You look at VF Corp. And VF Corp people went to a sell, and that's specific execution issues that I think that Bracken Barrel's going to fix. But nobody goes under. If nobody goes under, and there's no mergers to speak of, and there's no closings, then we just don't have enough people. very interesting when you talk to NVIDIA and they go over like the forklift conundrum. They'll always talk about, look, we're creating lots of different things. I don't want to say people because that sounds bad, but they're creating a lot of devices that will make it so we don't need as many people. But we have a big, my friend Carm DeCipio, who runs EY, but now is near the end of his run, is really fond of talking about how we just don't have enough people being born.
Yeah, it's a big, it's the topic of a big FunStrat report today, looking at the long-term labor shortage all around the world.
All over the world. I mean, Italy is 1.3. You need to have 2.1, thank you, Carm, for these numbers, 2.1 people born from a family in order to make it so you don't lose population. Italy is 1.3. We're all being threatened by this, so it's the demographic challenge is really a major problem.
But Tom Lee's point would be that that is what the AI trade is going to be about.
And he's right.
Is replacing that lost labor.
Yes, he's right. I think that's what, when you talk about, when we're all learning that there's training and there's inference, you want to train, you've got to start training on the H100. You can't wait for the Blackwell. This is the upgraded NVIDIA. But you want to train using video, a lot of different things. But the main thing that Jensen feels is that we are really going to go full self-drive. Now, that was good for Elon. I mean, there's a lot of first-name people in business right now. We got Elon, we got Jensen. But I will say that Jensen's real big issue was full self-driving on that conference call. People don't seem to realize that was his emphasis. And previous to that had been the digital twin, it had been robots, it was all and this is all Musk.
Yeah, we covered it a lot yesterday, and a lot of our questions to the sell side yesterday was about your point, that what a surprise that auto blessing was, and they all agreed.
I did not see that coming in my talks with the company behind the scenes after. I said, are you kidding me? I mean, aren't we talking about digital twin and omniverse? I mean, where's the robots that can shake, not stir a cocktail? And stay focused on the prize. Prize is full self-drive. Now, I know that Jensen's always been interested in that, but think about all the people, all the productivity we get if you didn't have to go behind the wheel, right. And all the safety and all the fewer accidents. Obviously, people think that the authorities are really unlikely to go along with this right now.
Right. So overall, the vibe you're getting, I mean, all-time highs were just a couple of days ago. Yeah. This might be growth scare number 2 on the inflation scare, I guess is what we're saying.
I'd like to make more of it. I mean, I got up really early trying to find something really negative, so I come in and say, Carl, the real problem was the commercial mortgage-backed securities.
Boeing, was it the Boeing?
Yeah, the Boeing cash flow, because Boeing wants to go by Spirit. Do they have to issue equity? Do they not? But I'm not saying that you should never be sanguine after a big run like this. Maybe you should be thinking about taking profits. But we're not faced this weekend, the 3-day weekend, and there have been times when you and I have been together in June where we've suddenly wow, how did GE drop 20%? I mean, that kind of. I don't see that happening. I do think that we got the usual suspects. We have Taiwan versus China. We have to be concerned about, I would say, about, once again, for Boeing and cash flow, because we've seen Boeing be in trouble, some commercial real estate. But for the most part, if Workday's our biggest problem, Workday. I mean, Workday picked a bad day to report. There's nobody else reporting other than Ross Stores. Yeah. Good number, Deckers, great number, and then Workday.
Workday's getting punished down 10 plus on a, I think, 1 percentage point trim on sub-revenue guide.
And they did that one, they used the term, we got to get used to all the terms. They were talking about elevated sales scrutiny, which is as bad as elongated. Elevated and elongated. I've got to create an English to shortfall dictionary, right? Yes. I wonder if we go into the 40, we got to be careful of that. And if we put in elongated sales scrutiny, it doesn't come back and say that's elevated, that's elevated, same as elongated.
Yeah.
But this call, can I just say, was not that bad. One of the missing subtexts, though, I felt was HR in general has not been the greatest place to seek a job right now. And their HR. I mean, human capital management, people are trying to not beef up those divisions.
Right. Intuit's another story, too, where people are pointing to TurboTax units down 1, even though they did raise the full-year guide, Jim.
Okay, I thought Intuit was good. I'm just going to put it out there. I thought it was a good quarter. It wasn't a great quarter. It's a high multiple, and under Goodarzi, we've never had anything other than beat and raise. So this we did not get beat and raised. So I get that, but it has more to do with how perfect this company's been than anything that is really worrisome.
Then, of course, you talked to Walt Bettinger of Schwab yesterday, which his comments really rhyme with Yellen and the FT today, talking about how inflation has become a #1 concern.
We should listen to this.
Yeah, let's take a listen to what Walt told Jim.
Inflation has now become the #1 concern among investors across, again, 35 million clients that we serve. And so when they think about inflation, it has moved their position from the first quarter of being a little bit on the bullish side to where now they're a little bit on the bearish side.
And we're going to get Umish in about an hour.
Yeah, I didn't see that coming. I was asking him because his business has been very good. Now, it wasn't as strong as people thought. He did guide people down a bit. Remember, 35 million, that's, you're talking about 1/10 of the country is with Schwab. But what I thought was interesting was he had an opportunity to be able to say, but I think it's coming down. It's not a problem. If I were President Biden and I heard that interview, I would say, you telling me that 1/10 of the country with a stock market where everybody's making a lot of money is worried about inflation, and then we have Janet Yellen over in London talking about inflation. It makes sense why we're higher for longer. I did not expect that from Walt. Walt's a really good guy, and for him to say that to worry about inflation, then people at home are saying, you know what, it costs too much to go to the store, and I'm stuck in my house. I ain't going anywhere.
They're not stuck in their house, Jim. Atlanta's airport yesterday just blew away the record for the busiest day in history.
I don't know. I mean, they're still going. Gasoline's lower.
Gasoline is lower. TSA, 111,000 people yesterday crossed through Atlanta Hartsfield, and they're going to probably break the record again today.
Well, okay. So everybody does have jobs, and jobs are plentiful, other than human capital management coordinator. It worked out. But I do think that I didn't want Walt to say that. Okay, I'm going to tell you. When you're doing these interviews, you're revving, it's 8,500, and you say, I better ask him about inflation because everything's so good. And then he just hits me with a roundhouse. My plan was really good until I got punched in the face.
Yeah. It brings to mind, Jim, a note from Goldman, the desk yesterday, talking about they don't think institutional traders are prepared for the potential for a blow-off top, and they say the retail cohort is the reason why, because they're on the come. But would Walt's comments back that up?
No, absolutely not. And Walt, I asked about individual stocks, and he's just going toward mutual funds and going toward index funds, and not. Remember, we've been using these things of trying to figure out whether the consumer is enthusiastic, whether the consumer is ebullient. I mean, we got a lot, and I felt from him that the consumer was business as usual. It's okay, but inflation's not okay.
Yeah. Well, when we come back, we're going to talk about maybe some moves in the opposite direction as some of the fast food chains move further into value, and the target price cuts as well. We'll get to the latest developments surrounding Tesla and Elon Musk, his message regarding tariffs, some reports of cutting production in Shanghai as well. Take a look at the pre-market. More Squawk on the Street continues in just a moment.
Here you go.
Some new challenges for Tesla in China. Published reports say the company has cut Model Y production at the Gigafactory in Shanghai as it faces heightened competition from the Chinese EV makers. Meantime, Musk doing an about-face, saying he's now opposed to U.S. tariffs on Chinese EVs. This is Musk speaking at a tech conference in Paris yesterday.
Neither Tesla nor I asked for these tariffs. In fact, I was surprised when they were announced. You know, Tesla competes quite well in the market in China with no tariffs and no differential support. In general, I'm in favor of no tariffs. I'm also actually in favor of no tax incentives for EVs, but provided that there are also the tax incentives for oil and gas must also be eliminated. So I'm in favor of no tariffs and no incentives for electric vehicles or for oil and gas.
So is it that after you build a giant on the back of subsidies, you're for no more subsidies?
I guess so. I mean, once you've won and no more subsidies for the other guys, I think that the most important line that came out of that, he was pressed. Musk was pressed about flagging sales. He was pressed about declining stock price. And he did say, in a most informative moment, we can stop the question right now because I don't think Business Insider is a real publication. That was very good. That was kind of like President Nixon used to do that. You know, you're running for President Dan Rather. I mean, to turn on the press like that, that's a time-honored way when you're really just sick and tired of hearing about your flagging sales.
Right. Speaking of the press, Reuters does have this piece
about them too.
He doesn't like Reuters about Model Y, which Jim, data already shows is down by a third in April year on year.
I know. I mean, things are, you know, look, the long knives are out there. I mean, you've got the Chinese coming up with cars everybody likes that cost very little, and look, I'm going all in Musk on the vote. I think he wins the vote. And I also think that if he's got right with Jensen, I'm not writing him up.
You do like the autonomy, and the stock's been resilient.
I think that I think that there's something going on in the last few weeks, which is saying, okay, listen, we are going to go autonomous, and you better get on board. I don't know where. I mean, to me, I was still used to when I was in San Francisco. I was autonomous, and then the next thing I know, it's gone. And Mary Barra, shrewdly had to do what she had to do. But I keep thinking about that if there's this much backing, something's going to happen.
Speaking of Barra, she did speak to the Detroit Economic Club, and she says on Musk, I have respect for him. That's a different kind of playbook. For the GM, we have to really think through and try to talk about the issues that are consistent with our company values.
Well, I don't know why she should comment on Musk. I think that this is a good chance to say nothing. I do think that the tariff issue is very strange, Paul, because remember, Mary has a lot of cars sold. Huge GM business in China. You don't want any tariffs. Just keep low. Stay low. Stay low.
You've been watching these military drills, the biggest series of military drills for the Chinese in about a year.
Yeah, and that's back, and I think that ASML comment, we got to go back to what they said, Taiwan 7. Don't worry, we can shut these things down, and then go back to Gina Raimondo from Commerce, and a lot of people feel, oh, she's picking winners. What she is picking, and her team's very good, Brad Koenig, used to run investment banking guy at Goldman, ran the division. They're not picking winners, they're picking a strategic semiconductor reserve. Because if we don't build them here and China takes action, then we are done. We saw what happened just with COVID. I have felt, and I know it's a very outlier move, that maybe we do have to put soldiers there. Now, no one wants to put soldiers anywhere, but we have to make a statement to the Chinese, listen, this is not, we're not going to let this stand. Because we, as a country, we can't let Taiwan's the most important ally we have. That's probably true. I mean, that's something that's a little bit fraught. They're our most important ally because we can't make most of the things we make without them.
Be a huge new chapter, Jim, in a geopolitical risk. While we're at it today, we do want to take a note and remember our good friend Mark Haynes, who passed away 13 years ago today. Mark was the founding anchor of Squawk Box, as you know, co-anchor of this show, Squawk on the Street. We, of course, always remember Mark for his knowledge and wit. And Jim, I sometimes think about what he would do in the face of so much misinformation today.
Oh, he'd be so angry.
Yeah.
He'd be so angry and so dismissive. And what he would do, I think, would call out one of them so strong that the others might say, you know what, maybe we should stop.
Yeah.
Did you hear what just happened to so-and-so news outlet? Because that's the way Mark was like. Because Mark used to tell me, come on, and I would have my rap, and you go, remember, no free passes. And then one time I was under fire from him, and he goes, no free passes. And you tremble. You tremble because Mark Haynes was the authority, and we forget that, and we miss him.
There's a look at his portrait, which still hangs on our way down to this set every single day.
What a guy.
Our thoughts are with Mark's wife Cindy, his son Matthew, daughter Meredith on this day. Opening bell coming up in a few minutes.
Okie dokie. Good morning, retail traders. Man, I can tell you what. Take off my shoes and get colors. Got me some new glasses today. I don't like the glare in them, but I don't see it. Strange. I got these computer things. That's probably what it is, the blue. Spies at the 200 right at open. 1 minute. 2 minute, we could come down and do a double bottom. What's a 1 minute say? And we already had a double bottom on this 200 on the 1 minute. Different time frames, man. You have to think differently. One could mislead you. Like the 2 minute would probably, I don't know. 1 minute tells me to wait. The 2 minute says jump in, but we have to wait because we didn't break the 63. But today's Friday and we got a 3-day weekend. Says Fed Waller says return to capital is not suitable for gauging neutral rates. Funny thing, I heard this morning that they're pinning this all on Boeing yesterday. CNBC, and I said, what? That used to be back in 1970, 1980. You could judge Boeing, but I don't think the market would. I mean, it's down, right? It's been down a long time. How can they gauge that on Boeing? The market didn't tank when they got that bad news on the flight. I turn on CNBC, the first thing they start doing is bashing Elon about China. Says he didn't like the tariffs in China. I don't either.
Ow. What a week it's been in retail. Take a look at some S&P gainers. Ross and Deckers both leading the chart.
ROST, Deck.
Both of those.
Deck at 1,000. One up? What? God, that's it. Nuts.
3-day Memorial Day weekend. Stay with us.
Yeah, this is stupid. Oh no. You're not going to catch me doing this. I'm going to short the sucker. $212. And it's up to 1,000. Nope. Not me. I'm going to short it. Outdoors. Come on, give me a break. Maintains buy on Deckers to 11.39. We got 11.10 and 11.11, and I got $2. Peggy was up this morning. Up yesterday, pretty good. Starbucks up still too much, but Starbucks has had a good run. I'd like to get it down to the 200 on the hour. We're at 2 minutes left. The Spy. Victor Descenda. Good morning to everybody. Hike.
Third and fourth quarter is going to really begin to show some of the improvement of the rest of the 493 in terms of earnings growth, and I think that's going to be an important thing. You're going to get better comps in terms of things are kind of stabilized in the previous periods, because we've coming out of COVID, everything was kind of crazy. So 2023, 2024 is the first time you get some really meaningful numbers to look at. So I think we're going to look at a third and fourth quarter situation where you can get hard data confirmation on what we're talking about.
All right, reassuring after a day yesterday where we didn't have much to back us up outside of the big winners. Appreciate that, Dryden. Thank you very much.
Absolutely, thank you. Happy to be here.
All right, appreciate that very much. Dryden Pence, Chief Investment Officer at Pence.
Anthony!
All right, looking for some broadening out, some faith.
You got glasses on.
And power, a broader stock market rally. Russell is leading the way this morning. Coming up, we're going to take a look at work day after its sell-off post-earnings. Ross Stores, Decker, retailers were looking better yesterday afternoon as the market responded to earnings. Got a few little notes out on the semiconductor sector as well. Good start here on.
So we're looking for a flat market today. We don't want nothing real belligerent. And then later on it can pick up momentum. So today's red is Peggy, Selena, Shop, PLTRs at support. Good morning, YouTubers. We had Lily yesterday. Meta. See if we get it. If 803.73 doesn't hold, 802. A little lower maybe. Had breakout this morning, so it's got the stutters right now. NVIDIA. We got 1, 2, 3 on NVIDIA. Just right under 1032.50. I mean, excuse me. Yeah. Could be selling the news, so just give it some time. Wait for the pullback to 527 if the 200 doesn't work. Yeah, I don't like that glitter, but I don't see it. Morning, Mike. Good morning, Yoko. Healthcare strong. Watching Lily. Intel's up today. SPWR. We got FFIE up. That's a penny stock. Down now. Carvana at 111. That put paid pretty good. BlackBerry. And Tesla. Disney. Disney's at my support area. We hit it yesterday. I was going to buy some and I just didn't do it. I remember me charting it up to 127 cents. We pulled back to it. The Nvidia's moving up. Lily at 71. Getting squeezed right now. Cannabis is up a little bit today. snow's moving a little bit. Dell's up too much. Oh, God. FSLR, look at that baby go. PDD. I'm waiting for the knife. I better set my alert down here on the 1 minute. $527.38. We're at the 63. We have the 9 crossing, so if it gains respect, we've got some big blocks coming in. Not real big, but to 300, 350 there, 500 right there. $500 right there, 150, 200, 182. I see 1,000 one in here. I'm gonna be bullish on it. Now we're above the 9. This is the 1 minute. We had 3 black crows. That gummit, Jim. You just now see it. You stupid idiot. Jimmy waits. I had to think this morning. Am I jumping in these trades a little too soon during this irrational exuberance experience that we're having? See, I had 1, 2, 3 here. I should have been watching that. I didn't keep watching that. That'd have been a trade. Perfect. 3 black crows with a spinning top. I'll be out of it right now. Microsoft down. AMD starting to move a little bit. One I didn't watch this morning. QQQ has 3 white soldiers. That's an extension pattern. I'm going to set the alert right here off that wick and that body of that candle. There's 3 white soldiers, so that's could be an extension today. That's on the 1 minute for the QQQs. Go, baby. That means the SPY probably broke out too. We got a double top on the SPY with a higher high. '63's been holding up as support. I think this will be 1, 2, 3, 4. So we're going to know something here soon if we're going to have a breakout to the upside. Or we pull back to the 200, snap it up. Actually, it probably won't even hit that. The 529 strikes, or the 530s. Ten of them. Amen. Amen. Get ready. Oh, there it is. Shit, Jim. 89, 90 cents. 89. Oh. Yeah, this has got to be it. That's the double bottom right there. Let's keep this stable and hold this double bottom. This is a SPY 529 strike. Fuck are you? Where is it? $0.81. 529s. Boom, 527. 83. Let's see if I got it right. So far I don't. Where's Randy? Randy! We're squeezing between, on the 1 minute hour, we're squeezing between the 9 and the 21. I want to see this hold, and that'll keep the markets stable. Test the new highs. Tight stop. And 77, 78. News in 5 minutes. $84. Give me more. Break the 200. VICTORY. Parkview is my battle cry. Some of you could have got them at 77, 78. I should have added on there, but I just didn't want to. I just got 1,000 in this thing. 800 and something. Could get 20 of them. We got a little bit of humble jumble to go through. If we break the 9, I think we're sold, but if we got to break the 9. Now, yesterday, listening to CNBC, Fat Cats, some of them thought we were headed for a bigger pullback. Some of the chart guys, well, the real traders, not the pumpers. So if we break and we hold respect above the 9 EMA, on the 1 minute, not? Yeah. Oh my. Oh no. Profit, 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 profit. Calm down. Calm down. Run deep. Boom. 110. Yeah. I love you. I'm off to the beach. I just love how I did it today. I had to, like I said yesterday, I had a real rough day. Man, that was nice. Woo! Did you like that, Jay? Let me tell you why you want to get out of that trade. I'm going to give you two reasons. We could still extend and move up higher, but we don't want to do that today. We want to consolidate and not really get freaked out and make a big move, and that will respect the pullback that we had yesterday. So, two reasons to get out of this trade. You have a 1, 2, 3, and then you have a huge engulfing candle. And you see something like that, man, just get out of the trade and wait for the pullback, and then take and put you a Fibonacci extension on it all the way back to the bottom from the breakout, and it should pull back right to 50%. And if that holds, then it's going to go back up. If not, your second idea will be off the 200 on the 38% Fibonacci. So don't go in there and start chasing it. Let it relax and consolidate. Don't get into the habit of going in and out, because you'll get caught. Just give it some time to rest, and I'm gonna go get me some coffee. That was real nice to wake up to. I mean, I wanted to get 20 of them. I just got 10, but still yet. Randy? That was played perfect. I didn't chase it. I could have jumped in at the 63 and sold that, but I waited. And then just perfect. Now we got a head and shoulders. Now we have a head and shoulders.
Look to the fact that it's a holiday session, very muted session so far, but
see if it pulls back to the 200 if it doesn't hold the 9.
The bid there, so we'll see. I think that makes sense. And bonds firm up, so dollar's still weak. Looks like we've got risk on still. Thanks, Ben. I'll look at the number here. Should be helping out bulls as we get a little reprieve from a data point that last time was a bit dicey. All right, we're watching stocks, looking pretty good. One of the big leaders this morning actually is Apple, coming back up 1%. And there's some good commentary, a little bullishness from the Wedbush team. Jeff Pierce, is that right?
That's right. I mean, we don't have Apple's earnings coming up again until August, but we do have the developers conference coming up on June 10th, and we've got some analysts weighing in on that. Wedbush Dan Ives raised the firm's price target to 275 from 250, kept the outperform rating on the shares. The analyst sees iPhone demand turning the corner into an AI-driven iPhone 16 super cycle. They said the AI technology being introduced in Apple's ecosystem will bring ample monetization opportunities on both services and iPhone hardware fronts. They did say the AI technology built in the Apple ecosystem could add $30 to $40 per share to the stock in their view. The analyst also highlighted that upcoming developers conference as a pivotal moment for the company. They did mention China, which we know has been a bit of a headwind for Apple as of late. They think the China slowdown will see a turnaround too, with an expectation that June will be the last and lowest negative growth quarter, leading to a positive turn in September.
Okay. So it sounds like
Use the wicks on the video. We're at a support that's getting ready to squeeze.
Dan to come out and put another $5 on a price target that's 80 away. That's pretty confident.
Yeah, I would say so. I mean, that conference that's coming up on the 10th, they are expected to show some of those new features for the iPhone, the next iOS. They've, many have speculated that Apple can unveil a new AI-powered Siri voice response system, among other services for it. The operating system should roll out around the next time that iPhone launch. So, the question is whether or not this is going to be enough to push consumers to go buy the new iPhone, and also if they're going to be able to have a little bit more pricing power. If we're going to see that average selling price rise. Now,
You're welcome, Jay.
On the AI front, Apple has certainly been a little bit behind, especially compared to companies like Microsoft. But
One beach trade will keep you up at day.
this is really on the consumer side of it. So they have a big area with these iPhones where AI could really benefit them, including across the rest of their line, like the iPad, where some of these other companies that have been mainly focused on AI are more on the commercial side of the business.
Okay. I could totally get the case that they have a AI product or AI assistant on the phone that brings people to upgrade, and that whole kind of cycle comes back around. Totally reasonable take, but so far we haven't seen anything, right? So it's kind of hoping. It's kind of a speculation on what they're going to deliver. I don't know. Dan's got the inside line. Very possible.
Yeah, it certainly is. I mean, as you're watching it from an investor standpoint, you're still looking at.
Now I watch these guys on CNBC, and I can see when they're desperate in their eyes and in their faces and how they wake up and how they look at the cameras in the morning. First thing they start to do is pumping the video. That's their meat. And then they use the excuse of Boeing yesterday, and I'm going, are you people idiots? Boeing's already got a bad reputation, but they don't look at it like that. Boeing is really, really, really screwed up, and I've never said that about Boeing. I mean, really screwed up. They've had 7 years or 5 years to straighten this up, and they've not done it. So they came out a month ago and said they're going to have profit. They came out today or yesterday and said, the same guy said, no, we're not going to have profit. We're not going to meet the demand. So that was real bad news. And back in the day, that would be a market changer. You would go ahead and short the market. But today they're pumping AI. That's their bread and butter. It's not Boeing. But that's what they used yesterday as an excuse. And that didn't even cross my mind because I already downgraded Boeing. And I'm not happy with it. So we got head and shoulders right here, and that's probably what we'll hit. I'm going to set an alert right there at 166, 167. Always want to set your alert a little bit higher than So that's an inverse head and shoulders. And we'll keep this right here too. I think we can go down more. And remember, we've been lied to all year about the interest rate cuts. They're brushing that up under the table. They don't want to talk about that anymore. That's why this market went down so hard, because of the interest rates are too high. So we could still have a good pullback in the market. I just want everybody to be very, very careful. We got a 3-day weekend.
So I'm looking at buying the 190, 197 half call spread, and then selling the 180 put to finance some of the cost of that call spread. At the 188 quarter level, you could have done it for about $1.15. Now we're up around 189, so it's closer to $1.50. But nonetheless, it gives you the opportunity to basically participate and capture any further upside
AMD
to 197. And if we do see some weakness over the next 3 weeks, if the markets come under a little bit of selling pressure, then you have the opportunity to pick up the stock at a much better level, and you have a range where you're really not going to be impacted too much from that, let's say, 189 level down to the 181 half level.
All right, so you get the upside. You've got room to kind of flex and stretch, without it getting hit. So it's.
I'm going to wait on the video. I'm not really.
Given you're selling the downside put, you gotta, basically this kicks in what, like $3 from here?
We do have a head and shoulders, right shoulder twice.
From 189 up, I mean, the true value of it at these levels is you're looking at the spread right now.
God.
About $1.50. So let's call it 191 half break even. But you got a little over 3.5, almost 4 weeks, honestly, 28 days until expiration. And again, if we see another 1 or 2% move higher, then you're going to basically participate all the way up to 197 half. And then if we do see it hold here,
if we break past these here moving averages, we'll shoot to the sky. We'll shoot up.
$1.50, depending on where the price is right now. But then you have a little bit of a grace area, I should say, or a little
INV
drift lower. You don't realize the entire down trough is what I'm showing here in this trade example. So it gives you the opportunity.
Inverse head and shoulders on the SPY.
In the next 3 weeks, you got the $1.50 you're risking, let's say at the 189 level. But if we get down to 180 and you get put into the stock, then you pick up the stock at 181 half. And again, so you don't realize that big drawdown over if we did see a shift lower here over the next 3 weeks. But by and large, I think that if you look at the general trends and the momentum,
what's going on here?
That if we do see a pickup in the upward momentum once again,
I gotta get out of this
to capture a pretty nice chunk
chart.
of the
Looking
upside
right.
over the next 28 trading
Yeah,
days.
inverse head and shoulders.
28 days.
Given the selling of the downside, though, if it really gets slammed, you're going to get hard on this.
You got risk below. So basically, on this trade example, let's call that 189 where it's trading right now. It's the total package or the spread buying cost.
Inverse shoulders, and we got a 1, 2, 3 moving up.
So that would be your break even. So let's call it 181
to
half. So
228, 30.
Then yeah, you're going to realize the loss.
So we're still kind of at a resistance.
But this gives you a little bit of a cushion, about a $6 or $7.
If it breaks that resistance, we'll move higher.
Not too bad unless we see a significant sell-off.
Okay. So this is, the trade as a whole kind of more resembles the selling of the put side than the buying of the call side in a way. Because you've got the unlimited risk to the downside.
You've got just similar to owning the stock. This is just a way to, again, if we see some weakness over the next that's why it's a short dated trade example hour. As I mentioned, going out to that June
I'm gonna wait.
Is the idea here is
I'm happy to get that trade. That was just
this 185
beautiful.
to 190 level. You're going to give up the cost of the spread, but if buying a call spread outright would be much more expensive than constructing a trade where the trade example like this, where you're buying a call spread, but then trying to finance some of the costs to lower your break even to capture more upside. And again, if you do see it wash around here between 185, 190, even 182, half to 190, you're going to give up the cost of that call spread but the put's going to cover a chunk of the cost of the call spread instead of just saying, like, the call spread alone, I think, is trading about $2.50 to $3 right now. So again, this is a way just to mitigate some of the cost, but still capture up.
GME, I got a support to hold at 1722.
Looking for Apple to stay strong, maybe break out, maybe push a little bit higher here, but definitely not break down. So we'll call it a bullish Apple trade. Thanks, Dan.
All right, Albert.
Appreciate it. Mr. Deming, managing partner, KKM Financial. Looking at Apple on a good day here, up 1% on the back of that bullish note from Dan Ives.
Anthony.
When we come back, let's talk some candy. Let's get out of the serious earnings business and, well, talk some more earnings, but on freeze-dried snacks. It's actually been a pretty good couple of years for So Good stock, which has been moving and got
SOWG. Never heard of that one before. Never.
Up with the leadership of the team and tell you what they're trying to do, because I don't know, it's kind of tasty. Freeze-dried candy. I don't know if I've ever had any of that.
Man, too much. It's up too much, but that's something to watch. Oh yeah. Dance, baby. Boom, boom. Oh, yeah. Oh, yeah. Boom, boom, boom. Oh, yeah. Boom, boom, boom. Oh, yeah. Where's my mentor? Where's my mentor?
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
No, Carl is the only front man you need.
Oh, I gotta take this, Carl. It's Schwab.
Have a choice in how you invest with Schwab. Missed out on today's market headlines? Get caught up and catch the wrap at schwabnetwork.com. Available anytime, anywhere, on any device for free.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums, unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
SOWG, I don't remember that one.
You don't have to be an AI trade to make big gains on the year. Just take a look at Candy and So Good, which is up 90%. Got the CEO joining us in the freeze-dried candy business that just got uplisted to the NASDAQ and had a pretty big rally on earnings as well. Claudia Goldfarb is the CEO at So Good, SOWG, the ticker. Claudia, thanks for being here this morning.
Thank you for having me. I'm super excited to be on.
Appreciate that.
You are excited.
Talk about your business first. especially, and the name too, so good, S-O-W.
She's very excited.
So we make freeze-dried candy, and we're ready to disrupt the candy industry. We're leaders in freeze-dried manufacturing, and we have an amazing manufacturing facility in Irving.
She is very excited.
And about a year ago, we decided to take the candy industry by storm. There had been a lack of innovation and disruption in that space, and we took our technology and made some amazing, tasty, hyper-dried, hyper-crunchy, hyper-flavorful treats.
Wow. Who does it, what's the market? Kids, adults? Who's eating them?
Everybody.
Have you ever
That's
thought
been the most
about...
shocking thing. We thought it was going to be just kids, but it is.
I'm curious. Are you stoned, ma'am? Because this looks like stuff that you would buy at a dispensary of cannabis. See? She got scary eyes. Applause.
For now, the category is ours.
That background of freeze drying.
Price, 12 public offering.
Comes from a pet product snack that you and your co-founder husband, Ira Goldfarb, sold some years ago, right?
That is correct. We started in pet, and now we're in sweets and confections.
So tell me about the plan then. How do you kind of balance the kind of CapEx nature of building out and having these freeze drying machines with the sales and the profitability kind of consciousness now that the market's going to apply to you as a NASDAQ listed business?
Yeah, no, great question. So uplisting onto NASDAQ was definitely the first piece of that plan. Getting the capital in place to increase our production capacity. We're moving into a 320,000 square foot facility. We've ordered 5 more freeze dryers, which will take us to 9. So, from a CapEx perspective, we're incredibly well positioned to support our growth strategy. We're very disciplined in regards to our operating costs and our manufacturing costs. So we've been profitable since the third quarter of last year, and we expect to continue to be profitable as we scale our production capacity.
The market was pretty surprised by our latest earnings report, where you reported earnings of about $500,000, 4 cents a share, which was distinctly better than the year prior. Analysts were thinking that you were going to be operating at a loss. So where did that surprise come from? What happened there?
I really think that as the street gets to know who we are and how efficient we run our manufacturing facilities, they're going to be less and less surprised as they continue to follow our growth story. We're incredibly efficient in our manufacturing processes.
I don't believe you.
We're disciplined in our operating costs, and we're not going to turn back. We're going to continue to be profitable as we continue to scale.
Where do you go next? Where does a candy breakthrough business need to?
What's going on here?
Airports? Is it like in major grocery stores? Or do you go through the online direct-to-consumer route?
No, so we've got great retail partners that we're continuing
I don't believe you.
to increase. We're in 1,850 Targets. We're in 5 Below.
Oh, you're in Target? There's the answer. I ain't buying the shit.
So our brick and mortar retail relationships are incredibly important.
I can't take any more of you. If you sell your goods at Target, I don't want to buy it. SPX new highs. SPY's at 127 now. Keep going, please. We just now hit the 200. We just now hit the 200. Okay, trick. Trick. Snip it. See, I cut her off when she said Target. I'm boycotting Target. I don't think they should be selling women bikinis with a place to put your penis. I don't know if we can break the 200 on the hour. Let's look at a different time frame. What to look at? Let's look at the 5 minute. 5 minute, we're off to the races. But hold on, we got 3 white soldiers. So yes, if we break this candle here, this body, if we break this resistance, now I'm using the 5 minute, okay? Every time frame I look at will be different. But here, I would suggest it pull back a little bit to this right here and hold that support, then come back up. But we have 3 white soldiers, so that's a leading indicator that we could go higher. Now we got a dragonfly doji. 2 minute, or 5, that's 5 minute, 1 minute. There's no soldiers. As long as we hold the 9, but I think it will pull back and hit the 21 first on the 1 minute. The 2 minute, 3 white soldiers. This looks bullish. We got 2 hammers. As long as we stay above the 9, we'll find out any moment here. We're going to find out any moment. Well, like I said, I don't really want it to break out, but I can't. I'm not a market maker. Or am I? Would somebody do a piece of artwork for me and call me a market maker with my face on it? My good side. Not my butt. Jill, how are you doing today? I want to see some of your charts. Don't be shy. Sue knows. Someone to me yesterday about coin. Dragonfly Doji, yes. On the SPY. Oh. Personally, I like to see it come back down and hit the 63 and not, and well, we got the 21. But if we hit the 21, I think we'll go ahead and pull back a little bit more. This is something to really learn. If you come in here and you do a freaking trade like that in 5 minutes and you're done, that'd take a little bit of break. And then sell it at 127. I mean, that's beauty. Now we're going to hold the 21. Lulu bounced off that pullback yesterday. 1, 2, 3. Oh. Actually, 1, 2, 3. Megaphone. So wait for the 63 EMA on the 1 minute. This could be it for the day. Think. I want you to think here. People are going to take the day off trading. Fat cats, they don't give a crap. They got a 4-day weekend to celebrate if they take today off. A lot of people plan their vacations during this holiday to go see loved ones. And you know what it's for. So we might not have any volume later into the day. Sneaky snake trading. A beach trade a day keeps the collections away. Booyah. What's the micros are telling you? Oops. Delete. The market, boy, look at that watch list. Damn. That watch list is green, Mike. Or Geo. Called you Mike. You look like a mic setup. Now you're talking, Geo. Thank you very much. Nailed it. Okay, we're waiting for the 200. Well, Black Betty, Bam Jam. Yoko, 200 SMA, brother. Let's get the other soldier. We need one more crow. She broke out.
a hike in interest rates.
I'm gonna go make my lunch.
We just have to kind of see how it all plays out, but you know, there's good
SPY
news,
reversed on this
news that's a
double
little bit
tweezer
challenging
bottom with
in
these
the
two
markets
candles.
as
I
of
didn't
late
call it.
as well. That's
I missed that one there. I thought we were going to get another candle down, and I was going to take it. I was ready to take it because that would have been a good little head and shoulders right there. But still yet, it still respected that shoulder line. And I just now, and you mentioned it earlier, Yoko. I didn't even think about that, damn it. I mean, it's perfect. Almost, but I mean, it's good enough. It's breaking out. Damn. Man, I missed that trade. Inverse head and shoulders. Cup and handle. Come on, honey, get on here. It's now 10 o'clock, 11 Eastern Time. Hi. So a lot of people put their videos on at 10 o'clock, I see. Meta.
Welcome to Trading 360.
I told you not to wear that this morning.
Live on the floor of the New York Stock Exchange. Glad you're with us. We have a big show for you this Friday. In our 360 Spotlight, Joe Mazzola from Charles Schwab.
I told you not to wear that this morning. You don't tell me what to wear.
Semi, after Mizuho upgrading this stock to a buy from a neutral. Our panel ready to focus on the state of discount retail in light of TJX and Ross stores, those earnings out that we got this week. And here's a look at the markets, all up arrows on all four of the indices. You see that the Dow's at 39,117, closed, remember, at the 40,000 mark last Friday. S&P 52.99, the NASDAQ is up almost 1% at 18,797, and the Russell up 0.85%. We have been hitting some new highs on the major averages, but this moment a little off those. U.S. dollar 104.65, gold 23.39 a troy ounce, and copper right now pulls back by 0.25%. Oil 77.37 the barrel, and Bitcoin 68,320. For a look at some of the top moving stocks in today's market, I'm joined by Jenny Horn, markets correspondent here on Schwab Network, taking a look at Ross stores. That was looking pretty good. Some of your thoughts on the earnings and what's driving this?
Yeah, Nicole, and I have to say that it seems like these discount retailers that are able to cater to various price points they're really faring well this earnings period. I mean, we saw the same thing from Walmart that has really been committed to keeping its costs low, and in this highly inflationary environment, it's no mystery why customers more and more are flocking to names like Ross Stores. So we saw that very much reflected in their first quarter. We did see bottom line that beat expectations. Top line sales came in just shy of around $4.9 billion. That also beat expectations. Same store sales did take about 3% higher. And their CEO did say, though, they had hoped to actually do better. First quarter sales were in line with guidance, despite some of the overall macro headwinds that continue to pressure discretionary spending. Earnings results for the period were better than expected, they said, due to lower expenses relative to their plan. For the fiscal second quarter, they now do anticipate same-store sales to grow between around 2 and 3%. Earnings per share to come in around 143 to 149. They did, for their fiscal 2024 year, also reiterate their same-store sales guidance for about 2 to 3% growth, but actually boosted their earnings forecasts. And I think that when you look at this report and so far how the street has weighed in, it has been a company that's historically given more conservative guide, but all in all, I've seen nothing but price target raises, at least thus far. TD Cowen, Guggenheim, Jefferies all did acknowledge a very strong quarter, but I will say the Jefferies note said that this is right now it's still in the shadow of TJX. And I'd say from a consumer standpoint, there is no mistake that TJX may have a slight leg up, but hey, it's still a nice, 9% rise on the session today, Nicole.
Yeah, nice move there for Ross Stores. Thank you so much, Jenny Horton. Great to see you, markets correspondent. And we'll have more retailers coming out in the next few weeks, and we'll talk more about that on the show. In the meantime, let's get some insights from the news shaping the markets. For that, we welcome in Joe Brusuelas, Chief Economist at RSM. Thank you so much for being with us. Thank you. So let me tell you, yesterday we had this big sell-off. Today you see that orders are happening. I mean, we get, the push and pull, right? What's going on in the markets these days and the economy?
Well, I think what you're seeing is the market's overly concerned about when that Fed rate cut occurs, and then the order and the magnitude of that will occur this year. You're really seeing, I think, the hawks make the case that rates are going to remain higher for longer. Okay, I think I'm in agreement with that. It's hard for me to see if any other market participants aren't either. But my sense is that we get the first rate cut in September. We get 2 25 basis point rate cuts this year. You know what I think some market participants are overlooking is that the rate cut parade is going to start in June, but it's going to start with the European Central Bank, the Bank of England, and the Bank of Canada. The Fed is going to lag the other major central banks in this cycle. But nevertheless, we are about to embark on what I think is a multi-year rate cutting campaign as we see the economies continue to cool with respect to growth. In the United States, you're going to see fairly solid hiring, but not the kind of robust hiring we've observed over the past couple of years.
So it's interesting because you're saying how the Fed will lag some of those others, and look, the inflationary picture there. We look at ECB; they're probably the most likely to go first, right? June, I think there's a 90+% chance of a cut, followed by the others. I mean, at least if the Fed cuts, they'll all be cutting. What if the others cut and the Fed just stands pat month after month?
Okay, so we clearly have had a divergence in economic growth trends between the United States and the other G7 economies. Because of the policies put forward, most notably through the fiscal channel, the U.S. economy emerged in the post-pandemic era in much better shape than the Europeans. They're going to be lagging for some time with respect to growth and employment. In my sense, that would be okay if it's not appropriate for the Fed to cut this year because the U.S. economy continues to outperform. That's a good thing, right? Now that we're talking about the real economy, you'll see a bit of a correction in equity markets if that's the case, but I don't think it is. But it's all right. The U.S. is likely to be one of the major
Is that your bar in the back there?
Overall growth, if not the leader amongst the developed economies. I think through early to mid phase in this business.
But you got some good shit.
As we look at what's going on here, I mean, and I talked about
Pawn, man. Pawn had that drama too.
This morning when I saw durable goods.
Oh man, see?
0.7%, and the expectation was a down arrow, right, and contraction of some sort. And so, I mean, this was an unexpected rise. What do you think is driving that? And does that give us is it a precursor to what comes next?
All right, so over the past 3 months, we've seen a modest improvement in durable goods orders. What you saw this morning was a big increase in defense orders, So I don't look at necessarily the top line. What I do is I decompose the data, and I look at new orders, X defense, and shipments X defense. And what you see is a very, again, modest expansion in overall orders for durable goods. Unfortunately, the future quarters looked a little bit better when you looked at the 3-month average annualized pace. In the current quarter, it was flat, right? Even though the top line looked fairly good. But in future quarters, it's looking like a much better situation. And that's what we want to see. We want to see those durables improve. And of course, what we really want to see is orders of equipment, software, and intellectual property, which really will push productivity. And that's the magic elixir in the U.S. economy. By the way, that increase in productivity continues to look fairly solid from my point of view. Inside RSM's middle market business.
We got 3 white soldiers leading out on Pawn.
Where firms are telling us, a majority of firms are telling us, they intend to increase outlays on productivity enhancing investment. Let me tell you, that's one of the most understated and unexplored aspects of the U.S. economy. You just don't see that other places, and it really doesn't have anything to do yet with the investment in artificial intelligence. That's going to come online in a couple of years. This is just good old-fashioned improvement in productivity, mostly, I think, because labor remains so tight in the economy. Firms have had to adjust and increase more capital in order to meet demand. Let me tell you, Nicole, this is one of the best stories in the United States that we're really not telling right now.
Yeah, you talked about productivity the last couple of times you've been here, so that's a very good sign. And what does that mean for the labor market? Because we've seen the labor market falling off a little bit. Clearly, it's still a very tight labor market,
Okay,
but
so, yeah,
right?
yeah.
So, but what does it mean there?
Well, what it means is we don't have enough people in the economy to meet the jobs. You know, we're still 2.9 million jobs short here, where we just don't have enough people to fill those openings, right? So when you have that situation, you can go to the immigration channel, which we have, and then you really have to start talking about substituting technology for labor, and that's where firms are. You know, inside that survey I mentioned, in the fourth quarter of 2020, just as we came out of the pandemic trough, that's when we saw the acceleration in both real spending in terms of software, equipment, intellectual property, and then future intentions. And that's what's important. We still continue to see that being the case. And you know, that's going to be with us now. It's a permanent characteristic of the economic narrative going forward, because we just don't have enough native-born population to fill the jobs that we have and the new jobs that are going to be created as this economy gets more innovative going forward. I'm very optimistic about the American economy over the next several years, despite the public pessimism, which I think has more to do with we'll call it the current unpleasantness in the political sector.
So what are we leaving out? I mean, what are you telling
I'm
them?
gonna tell this guy
You know, they're just
bullshit.
New highs in this last week. It's been very exciting. What do you tell the investors who want to put money into work?
So we really don't get into individual stocks, right? But what we say is, look, we think that if we look at what's going on in the real economy, there are several tailwinds that we can see. Infrastructure, AI, energy infrastructure, we think is a wonderfully unexplored area that's going to reap positive benefits for mid-market firms in the real economy. We think tech and life sciences, again, as interest rates come down and risk appetite begins to pick up, will begin to explode to the upside because of all that innovation. Moreover, you know, the supply chain resilience, the policies to push that, the creation of the fabs. You know, I live in Austin, Texas, 20 miles away. Samsung's investing tens of billions of dollars in a new factory. And it's amazing to see what's happened just around where I live and the development. It's like a game of Sim City back in the 90s, where you're just creating civilization. And it's being driven, you know, by very specific policies, industrial policy, yes. And I think that there's a very long, a decade tailwind behind infrastructure.
All right. So it's great to see you of RSM. Thank you so very much. We
Thank you.
appreciate it. And of course, we'll have PCE and a lot more going forward, so stay tuned. In the meantime, more to come here on Trading 360. Up next, it's the big three. 3 stocks, 3 charts, 3 trades. Then Lichtenstein will go through the technicals. Joel Hawthorne takes you through the trades for Apple, JP Morgan Chase, and Qualcomm. That's next here, Trading 360, Schwab Network. We'll be right back.
out on today's market headlines? Get caught up and catch the wrap at SwapNetwork.com. Available anytime, anywhere, on any device for free.
Welcome back to Trading 360. I'm Nicole Penalidi, live on the floor of the New York Stock Exchange. Glad you are with us. It's time for the big three. 3 stocks, 3 charts, 3 trades. And Lichtenstein will take us to the charts. Here to take us to the trades, Joel Hawthorne, Retail Trader Magazine. Glad you are both here. Joel, how you feeling about the markets? We wrap up a very busy week.
Thanks for having me, Nicole. Always a pleasure to see you and Ben. Markets, I'm still very optimistic. I think this morning's kind of reversion back to the upside after yesterday's sell-off is positive. I anticipated a bit of downside price action. I think, anytime we start to get anywhere near all-time highs, new highs, stuff like that, I anticipate some profit taking and price going back to where it's comfortable. And I think that's what we've seen here as of late in some yesterday's price action.
Right, so after a big sell-off day, right, the worst since March, what you're not seeing is another sell-off day, to your point, right, a reversion. And so with that, that brings some optimism for you. Tell us a little bit about your Apple story. Where do you think it's headed and why?
Apple is one I couldn't wait to talk to you guys about. I was actually on your show March 21st. Apple had a bit of a pullback, and I was saying that I like that price. I like Apple anywhere below 170. And we saw Apple hit a 52-week low of about 164, I would say maybe a month after that. And then since then, obviously, we see it's currently trading 199 and change. Because of that, I think there's still some optimism to the upside. I still want to be a bull here. And I would
Now, we were at the double top on Apple. We were, I just got to go back and tell these guys that they're a little bit, when we're up here at the all-time high up here, that's pawn. I remember, I listened to these guys. They were pumping Apple. They said we were going to break. We were going to go to 220. They were doing the same kind of language back then as they're doing now. I like Apple here. We come back from the pullback and we're moving up and we're going to break out to 220. And I said, no, we're not. Apple's always been a slacker. Always. For a whole year, we've been at this resistance level. For almost a whole year, we were at this resistance level. They say the same stuff over and over and over and over. And so Buffett got in here and bought some Apple after the breakout, probably about the third or fourth crow right here. First, and he got out of Apple. He sold it. He sold his position to pay for taxes. Now, if he bought the dip, I don't know. But they're going to keep pumping Apple. Apple's always the pump, just like NVIDIA is now, just like Microsoft was at one time. It's the same thing as Intel. So they started pumping Apple. And all of a sudden, it started getting bad news. China sales were down. The Apple Watch was kicked out of some countries. I'm cooking salmon. Right now I'm cooking salmon, so I got to keep a close eye on it. They need something else to pump besides NVIDIA, because they know that NVIDIA is too high. and Apple hasn't moved. Watching another week, something bad going to happen about Apple. So I ain't falling for it. It was beautiful down here when I alerted it. Not there. Down here, let this sucker drop another 10, 15 bucks. If you want to go long in it. But I would not buy it at the break of resistance on a good day. And look at yesterday. That's a scalping trade to me. Snow looking real good. I gotta go get my fish here. Oh, I forgot my cheese. Whoops. Oh, shit. I went to one of the fanciest restaurants here in Springfield, Missouri, and I ordered salmon. And I waited. They came out and they brought my salmon to the table. And I said, "What is this?" I said, "This shit ain't cooked." And he looked at me and said, "Well, that's the way you cook salmon." I said, "It's raw. I mean, it's been barely cooked. It's mushy. I can't flake it." I said, sir, and that's the professional way of cooking salmon. And I said, I've ate salmon all my life, and you're telling me that I've been overcooking my salmon? And he didn't know what to say about that. I said, I don't want this salmon. You want me to eat this raw salmon? Now I've had poke, or what do you call it, in Hawaii, where they feed you raw fish, but it doesn't taste nothing like raw salmon. You put it on the steamer or grill it or whatever they did, it just mushy. And I said, it was the nastiest food I ever ate, and I gave $70 for that plate. I said, this. What'd I miss? What'd I miss? Oh, the SPX? I didn't miss it. But I did miss that. I got 24, a little less, 21. On SPX. 22, 53.22. Back to the third crow. Back to the third crow. Mike and I watched the Bronx rally yesterday. It was magnificent. Might have an expansion pattern. Yep. Jimmy mentioned that one. Up, drink. That rally was a blast. We all able to get out of that? SPX and SPY. That was good. It really was that salmon. Man. Surprising how good cooking can get when you've got to change your output on how you want to eat. I mean, that goat cheese, Jen, if you were right here right now, I'd kiss you. Do you think she heard that? She heard it. I'd kiss you right on the cheek. Now some strawberries for the sourness. Oh boy. No, she's with the girls.
And you're seeing some folks who make some decent money, and they're running over to Dollar Tree, right?
Exactly. I mean, they saw an increase in upper middle class households that earn $135,000 or more going to Dollar Tree, going to Dollar General, and you know, we continue to see that kind of trend. That said, I will say, you know, you shouldn't not look at the luxury brands because they have also become kind of bellwethers. I mean, we think of them as consumer cyclical, and you know the possibility or the danger of them trending downwards. Don't get me wrong, we do see.
I just did, honey.
But they're still having, you know, consistent profit. So, for example, LVMH. which owns Tiffany, and you're seeing
Got a piece of salmon on my keyboard.
Increases in their revenue as well, not just the discount retailers.
Yeah, I'm glad you brought that in to the conversation. Thank you both so much. Wonderful to see you. Sandra Tro of Point Wealth Capital Management and Amanda Lai of McMillan Doolittle. Thank you both very much. Nice conversation, and we'll watch for more of those retailers next week. These discount names have been doing well, no doubt. Thank you, friends, for being with me here on Trading 360. I'm Nicole Petalides. Download our free Schwab Network app, available in the Apple App Store 24/7, schwabnetwork.com. I'll see you at 2 p.m. for the watch list. Join me then. Fast Market is next.
You're not leaving, are you? Don't leave. Girl.
Be part of the latest commodities action on futures.
And Mr. Frankenstein. So we're going to go over the watch list. And it's now 10:57. Percentage gainer today is SPWR. What? You gotta be kidding me. Oh, GME, I bet you GME. What'd I say, 1722? Hey! Nope, didn't get it, but we got a flag. We got a flag squeezing. Lulu. Sava News. Sava News. They got something for your AD, Mike. Mentor. Mr. Frankenstein, no. Sava poppin'. What's that, Jim? Oh, it's attention for your attention deficit disorder, AD. It's medicine for you for your cognitive impairment. Oops. Where in the frick? I want you to sleep better, that's for sure. Man, that was the best salad I ever had. That salmon. I am getting checked out on the 19th. I hope it's good news. Jim, you're going to have to retire from trading. Now that I got glasses, that's it. My glasses, I've had issues with them here in the last month or two when I broke them. And I've had them for like 6 years, and they were very expensive. And I didn't want to go and buy a new pair because these things cost me so much. So I went and bought me a new pair of glasses, and they put this shield on it for staring at the computer all day. And I was sitting there cleaning the day, and I looked down at my hands, and I said, God, are my hands that big? I thought I had small hands. You know, I mean, I got big hands, big as my face. But they look so much bigger now. I said, ma'am, man, everything looks so big. Well, we've had to adjust your eyesight a little bit there. And I went to the eye doctor, and it was on a computer. There's a guy in another part of the country looking at me doing this test on my eyes, and I'm freaking out on it. I said, I'm in this room with nobody but a TV screen. So I've never had my eyes checked like that before. I've always had an eye doctor, you know, and they get in there and look at them, and just felt very different.
Was the whole thing. It was the catalyst that NVIDIA took us to all-time highs. Quick reversal on that, Alex. Maybe some of the expectations built in. I think maybe that 10-for-1 stock split, although we know it doesn't change the value of the company, it's still something that...
It does change the value of the company, you ding-dong.
I mean, yeah, NVIDIA is doing really well.
It changes the share structure.
In the AI realm.
Hello.
Can you equate that to the overall market? You know, 5 stocks, 10 stocks.
It changes the share structure. So there is an effect. You've seen what it did to Tesla. They had the split and the thing tanked. I see it all, you know, I see it a lot, but NVIDIA could be a different story. I mean, everybody wants NVIDIA. If you can buy this thing at $150 a share, I'd buy it. But I like to take my time. I buy little bits at a time and scalp it. Yep. I agree now. This guy might have been in India. This guy might have been in India too. He was definitely a foreigner, and I had to listen real hard to understand what he was saying. He could have been from India, and I like Indians. My best friend is Indian. Yep, I agree that. Spy Key here, nice scalp on the 5 SMA test. Whoa! The 5? Use the 5? What time frame? On the daily? I'm gonna write that down, study that this weekend. 5 SMA on the daily. Yeah, it's been rough. I've always stuck with the 9. Very good. That's all you got to trade. That's all you got to trade to be rich. And if you study the same stock, the same patterns, you can't go wrong. It's like Mike with Lilly. It's like me for 10, 12 years with Tesla. I traded Tesla every single day. It's still my number 1 stock, but we got to get over this roughhousing from CNBC. Then we got to sit back and watch it and come in Tuesday and trade it again. Or it might be in one of them periods where it's got to shake it off. 5 days. 3-day rule and a 5-day rule. 3-day run, pull back. 5-day run, pull back. Lilly. See? 1, 2, 3, 4, 5. Boom! 1, 2, 3. 1, 2, 3. 1, 2. 1, 2. Yeah. See, it needs to come back and rejoice. at $7.91. Jimmy's gonna put his alert up here. Replaced. It is forming a little flag. Like, man, that was good. That lunch was overwhelming.
Overbought because each time it hits that 90 level, 90% of them is typically when we see that pullback, and we're not even close to that right now. I highlighted that chart earlier this week, and it was still at about 65% until that sell-off yesterday. So that's a key chart to keep an eye on if you think maybe this rally's too extended at this point, because maybe it's not. All right, let's take a quick break. When we come back, we're going to take a look at Apple. The iPhone maker stock has rebounded about 11% so far this month. They got a price target hike today out of Wedbush. Fast Market's coming right back.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Knock, knock. Number one broker here for the number one hitmaker.
Thanks for swinging by, Carl.
No problem. So what are all those for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full-service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know Carl is the only front man you need.
Oh, I gotta take this, Carl. Schwab.
Schwab.
Have a choice in how you invest with Schwab.
Welcome back to Fast Market here on the Schwab Network. It's time to discuss Apple. Got a price target hike. I got a Wedbush. Let's bring in Diane King Hall, senior markets correspondent here. Diane, I've been saying this for a while. 5 out of 6 quarters basically declining revenues for Apple. It's almost like they're getting a free pass, but Wedbush thinks it's not a free pass at this point.
Yeah, no, Wedbush believes that some of the street's expectations are underestimating the direction that it sees Apple going. So Wedbush has raised its price target on Apple to $275 a share. Previously, it was at $250 a share, their price target on the stock. And look, think about where shares were for Apple just a couple months ago. They've certainly regained some momentum. Even before today, the stock up more than 1% on the session. Here's some of the reasons why Wedbush sees it going there. It believes there's an iPhone super cycle coming up this time around this September, where more consumers will be upgrading their phone. Especially, Wedbush talks about AI and how AI will be a factor in kind of the development of both Apple's latest iPhone and also within the App Store. Wedbush believes that the AI technology will bring more monetization opportunities, both on the services end and on the iPhone and hardware front. They believe that'll add between $30 to $40 per share to the growth story. And that will help both the base, the current base, and
They're pumping Apple big time.
To Apple.
They don't want this dip to, they don't want to see another dip. There's a lot of people invested in Apple, okay? They held on to it. They were pumping that sucker and it dipped all the way down $20. Wedbush, I don't trust him as far as I could throw him. I don't trust any of these people, except when it comes to the fat cats. Now these other little guys, so they want to break that resistance. I know where resistance is. They were probably shitting their jeans yesterday when this thing pulled back. Problem is we have the 200 snugging up there next to it. So it'd have to take some news to pull this thing back. It's already up 11% this month. That's way too much. I wish you'd quit pumping Apple. Your credibility is falling with me. Breakout on GME, do it which way? Oh no. Did you hear me talking about GME? Okay. I want to give you all a lesson here. Okay, we're in a downtrend, right? We're in a downtrend. This is called a bearish pennant flag. A bearish pennant flag. Let me find, see if I have it here somewhere. There's two kinds of pennants. One is bullish and one is bearish. I'm going to show you examples of both. This is a bullish pennant flag, is when you're going up to the upside and you have a symmetrical flag. They usually break out on the point of 1, 2, 3. 1, 2, 3, you can trade with me. Bearish is when you're coming down and you create the symmetrical flag. 1, 2, 3, boom, to the downside. SPX is about ready to break resistance. Ooh, what was that? Jim. Don't worry, folks, I was just detoxing.
But coming up after the break, Alex and I are going to be joined by Megan Brantley from Likefolio for a discussion on Block and the sentiment data on the stock moves. The fintech shares have fallen about 13% so far this year. They continue to lag the overall markets.
Lily. Pure Power Picks. Doom. I'm going to sing you a song. Welcome to the room, Pure Power Picks. I like investors. We can do that here. I use Schwab, and there's all kinds of platforms out there. If I was to look for a platform, I'd look for one that can get you in and out of trades real fast. One that's reliable, one that has a good trading platform that you can chart with. Now Schwab, I use Schwab. There's other traders in here. I don't even know if you're on mic. No, I'm wasting my time. Spreads are crazy. Well, right now the SPX just hit a resistance, Jen. Everything anything to do with Lily. Mike, I see an ascending I see something different than you do. But I see what you see too. I see it could be a head and shoulders. Now, I don't like this part right in here. I see a head and shoulders. See an inverse head and shoulders and a head and shoulders. I gotta drink some water. I think I'm putting on water fat. I've been drinking twice as much water. It means I got to work out more. Welcome to the room, Pure Power Picks. Are you new to trading, may I ask? Are you just now wanting to get started and learn how to trade? That'd be the first question I'd want to ask. If you just started out, I'd look for good mentors. I'd look for we all have different platforms. Most of us trade on Schwab, Think or Swim. That's what I chart with. Also, so if you're new to trading, I would advise you to start paper trading at first and try to build a good trading strategy. Not to go in blindly, for one thing. We all trade with chart patterns, and some of us trade with moving averages. And my most important thing about trading is being in the now. By what I mean being in the now, I mean like knowing, are we at all-time highs? Is the market, ready for a pullback? Or looking at a chart, you can see it up there, monitor to the right. Are we a little overbought? Would it have been nicer to get down here off the 200 SMA? And you say you want to be an investor. You look at bigger time frames. My strategy is all about chart patterns, moving averages, and being in the now. I have a live YouTube channel. You can always watch me trade there if you're out and about. And I'll put that link in the room. A lot of people that are at work, they like me on the YouTube because that gives them a chance. If they got other things and stuff, they can always listen to me on the radio or but here, I'll just give you the website. Be aware of pumpers and people that don't talk a strategy. You want to be around good people. You want to follow good traders. Now, my first person I ever followed was I can't remember his name now. I just had it in my head. Who is it, Mike? I can't remember. My first trader. Clay Trader. And he kind of got me into where I wanted to buy stocks at support and sell at resistance. I wanted to look for the best place to take a trade. And it was started out being horizontal trend lines. And then I started learning about moving averages. And I've been trading since President Obama and George Bush. And that was back right before the crash. Then the crash came, and that was one of the best learning experiences that I could ever possibly have. So I followed good people, good traders. And then I wanted to learn, so I mean, my best way of learning is having someone ask me a question. And then I'd look it up and I'd study it and I'd do a case study on it. And I've been helping beginners from day one. I started a chat room in 2007. And I was nothing, but I knew a little bit more than everybody else did. And they couldn't believe how close I'd get to my support levels and, my resistance levels. I wanted to look for like double tops and patterns. You can use patterns on any time frame, even when it comes to swinging. We see a lot of falling wedges, a lot of inverse head and shoulders. So you need to get familiar with chart patterns. And all you got to do with that is just type in bullish, bearish, chart patterns. Go to image. Oh, this is YouTube. You can go to YouTube. Was a great experience on me learning how to learn. That's how I found Clay Trader. Bearish chart patterns. Let's type in for swing traders. Pull up the images. It gives you little ideas of what to look for with a chart pattern. What's bullish and what's bearish. This has always been a great way to learn how to trade, learn how to get started. I was just talking about the bullish pennant flag right here. It's called a bullish pennant flag. You're coming up from the down, so once it gets ready to squeeze and it breaks out. I've also come up with a theory that, and it's pretty obvious on these charts, that if you can count to 3, you can trade with me. If you can count to 4, you might make a little bit more. And so we got a little flag here. We got an upward trend. It broke down, and it started creating the symmetrical flag. And each one of these peaks is a number. 1, 2, 3, 4, 1, 2, 3, 4, boom. To the upside. Any more, we start to squeeze to the end of that flag. This is an ascending triangle, same thing. 1, 2, 3, boom. 1, 2, 3, 4, boom. That's a sweet spot. So you want to learn chart patterns. And just type in bullish, bearish chart patterns. Now, you got to develop a strategy. You don't want to take a trade off somebody's alert. You take it, you look at it, and you study it, and then you make your own mind up. You got to learn how to do that. Like, create a small watch list of companies that have a lot of good money, a lot of like Apple, Boeing, Baba, Tesla, Microsoft, tech companies, NVIDIA. Everybody's trading NVIDIA. There's always one hot stock to follow. But keep it short and sweet. Don't make it too big. Make it to where you can memorize these stocks and watch them every day. Come in the morning. I got what's called beach trade. I come in here and I can be in and out of a trade within an hour and be done for the day. There's different times of the day to be focused and not focused. The first hour, then you got a couple hours to play around with, learn how to study charts. Then the fat cats come back from lunch. Then you got power hour. Depends on your schedule, how you want to trade. You could trade pre-market. You can only trade after hours. So the market's set up to where you can maneuver your lifestyle on how you want to trade. It makes you a better trader. I mean, some of us don't have the time like I do to sit at the desk 8 hours a day for 20 years every single day and not have family or want to enjoy life. I've had a pretty exciting life when I was younger, so I'm kind of mellowed out now. And this is what I found to entertain me instead of going out and being a rock star and playing music. So I learned how to study charts. And the more you study charts, the better you will become. You'll learn how to draw trend lines. You'll identify what's bullish and bearish. Now this is my snake. I talk about how to trade the snake. It's a downward trend. How to find breakouts, like the downward trend right here. Snake, breakout, pull back. Got inverse head and shoulders down here at the bottom. Then you got a resistance that you got to break. So you know you can take this trade once it breaks that resistance. You got to have a good broker. There's all kinds of brokers out there. They've got Weibo. They don't charge much for transactions. Then you got, I'm in Schwab. I used to be in Ameritrade. I used to be in Scottrade. It seems like it just keeps going down the line. I trade with Tastyworks. Also have another platform that I study charts on. It's called TrendSpider. This tells me what flags are on here. I can automatically show me what a flag is. This was already set for me under chart patterns. So if I want to learn a special kind of chart pattern, I just go in here and say, okay, I want the head and shoulders because I might want to buy a put. Inverse head and shoulders because I might want to go long. I know I'm at a bottom of a trend. Ascending triangles. So I apply that in there and I just type in, this is on a 1 minute. Go to a daily. You can play inside of that channel. If it comes back down or if it breaks out, then you're bullish. AVGO. Apple, they're talking about Apple a lot today. They're trying to pump Apple. So we have here what you call an expansion pattern. We see a lot of them expansion patterns on a volatile, all-time highs volatility market. Also, I got a flag right here. So we got trend line right here. Whoop. We got the expansion pattern, but we got this here is called snake. You play in that channel. 1, 2, 3. Boom, baby. If you ever played baseball, that's called the sweet spot of a bat. You call this a double bottom. Once it breaks that trend line, you could probably play it back to the top of this here trend line by building it off just them 2 candles. You take the entry and sell it right there. And right there, that's what? 66, that's 66 to 75. So that's a good scout. That's a good swing. But you got to be on it. You got to come in here every morning and look at that chart and see where you are. If you're at a resistance, you want to get out of that trade. This could have happened right before earnings. And then they had a big breakout. So different kind of patterns. You got to learn a lot of stuff. It's going to take some time. And some people pick it up pretty fast and others don't. It took me a long time. It took me a breakup. I heard this many times. I was a good trader, but it took me, I had to break up from someone that I really loved trading with and I was lost. And that was about 3 years ago. So they created this room. I knew I was by myself again, so I had to come up with a new kind of trading strategy. And all of a sudden it just clicked. I was very, concerned of what I was going to do. So I developed the sneaky snake, where it got real simple to teach other people how to trade. And it's just playing at the bottoms, big long trend down, and then waiting for the breakout and then playing it. And we'll get a better example here today on the SPX. God, I need SPX. What the heck? Calm down, Jim. SPX. How in the heck does the C come in here? Jeez. So we got, I forgot even how I traded this. Let's get down here. Now I use the other chart. See, here's one right here, Lily. We're talking about Lily. So we have what you call a snake. That's a trend going down. 1, 2, 3, and then she broke out. That's a channel, and that's what I try to share with people, how to trade that channel and what different kind of flags to look for. Snake. And it comes up many times. So here's the 200 SMA. These are moving averages. And I'll show these moving averages. Are you still in here? Hell, he's gone. I guess he got tired of hearing me. Melodic voice. Yeah, put him to sleep. A-I-O-U. Well, that was a waste of hot air. Did you get to hear me sing it? I was going to sing him a song. That's probably what let him off. He said, I heard that guy's voice. Well, here we go again. Lily, I'm going to talk about it anyway. Snake. Second time it hit the 200 SMA. Boom, baby. Jen, did you hear what I said? Did it sound interesting? All of it. She wasn't paying attention. No one was paying attention. Just for that, I'm going to go out and buy me some gummies tonight. I should repeat all that again. You're making my eyes water. That's better than the Trump show yesterday. Yeah. I've got a recording. I may do another one. Update it. I still got the one that I very first started way back. So it's now almost 1 o'clock. The volume's going to be going down a little bit more. One, two, three. Inverse head and shoulders. On spot. On spy. On the 1 minute. Man, this looks strong. One, 2 bits, and a freebie. Left shoulder, right shoulder, and right shoulder. And head. Type it in. Type it in. A-I-O. That ain't the right way to type it in. 2 heads is better than 1. Head. Shoulder. S-H-O-U-L-D-E-R. So at least the people on YouTube that are new got a good lesson there, didn't you? Right shoulder. With the capital R. Oh, you dick. Now I've really messed up. How do I get that? Move that there. How'd I get down? Oh. And left shoulder. Remove. And the 200 SMA. Now that we've breached it, we have to wait for the 200 SMA now, or this could be a fake out. And we are getting into close. Well, it's only, we still got a half hour to play here. And we did not hit the top yet. So we still have a free. We have a 1, 2, 3. And that don't count. Because that's just got a wick. Or we could have an expansion pattern back down to here. Yep, I think it's going to drop. SPY. MD new highs. How long ago was that? Mannequin. Not too long ago. C's dropping. INT tell. I'm still in Intel. So they're pumping Apple. I think an island's a good idea. I've got 2 of them I want to move to, 3 of them. One's called the Big Island, the other one's Maui, and Honolulu. So probably have an apartment in Honolulu and rentals in Maui and the Big Island. And then you got Jamaica and the Bahamas. And then man, you look cute today wearing that dress. She's so fashionable. She never wears the same kind of, well, it kind of has a little glamour to her, but I mean, farmer daughter stuff with a little bit of zest.
No doubt about it.
I know, sometimes these days are like quietly actually really interesting. It doesn't seem like it's been that way, I mean, this far, but obviously we have...
NVIDIA has an ascending triangle.
In this trading week, and of course we have a
1, 2, 3.
trading week next week with Monday off. But as always on the show, we'll focus on always the individual movers. We'll kick things off with upvote and downvote. We'll chart and trade our upvoted names. And for FOMO today, we're talking a name that's been somewhere on the radar all week long, but now expecting to close out this week as the S&P's best performer, and that is First Solar, with solar stocks having a pretty nice week and a pretty nice run-up as of late. We will also look at the value war right now between Burger King and McDonald's, a great conversation about their value menu pricing and the way they're competing. We'll end things with Lucid laying off 400 employees, about 6% of its workforce, which not a huge shock there.
You know, we've talked about this before. I kind of firmly believe you were either like a McDonald's family or you were a Burger King family, and like I'm unfortunately, I have to say that like my family liked Burger King. I'm not. I'm personally not, but like it explains all the issues that I have now later in my life.
I'm a McDonald's family through and through. I'm like we're still active McDonald's people.
Yeah, I think that especially around Chicago too, local to the area, but. Yeah, I don't know if I ever forgiven my parents for that, you know, having me grow up on the BK, but that's a joke, obviously. Jokes aside, no endorsements for upvote and downvote, not recommendations. Live Nation is our first one on the list, so we talked about this a couple times this week, Jenny. The fees have gotten out of control. You look at the Ticketmaster, anything, it's not just Live Nation, this whole space. It publishes you a ticket price. Just multiply that by 2 and you're probably closer than the actual ticket price posted.
Okay, and I hate that I'm aware of this, but we have to discuss her. We're talking Live Nation. Taylor Swift is touring right now in Europe, and ticket prices are, because they don't have this
It's okay to be a Swiftie. You can be proud.
No,
I'm a
I can't.
Swiftie. I'm all about it. It's all good.
You're right, I'm like a closeted Swiftie, right? I try to act like I'm not a fan, but I do know all this information about her. But she's touring right now in Europe. Her most recent leg of her tour, I believe, was in Spain. And tickets cost $100. The average ticket price here in the U.S. is now well over $800. So that just goes to speak to exactly what right now Live Nation is facing. So the U.S. Department of Justice is suing to break up the company, of course, the parent company of Ticketmaster, over these alleged antitrust violations. So 30 states have joined the DOJ in this suit, which comes after the department's investigation into whether Live Nation is a monopoly and the overall ticket industry. So the Attorney General on the case would say that Live Nation relies on an unlawful anti-competitive conduct to exercise its monopolistic control over live events in the U.S., which costs fans, artists, smaller promoters, and venue operators. They did respond and say these allegations were absurd, but it's amazing to me that with this pretty major piece of legislation possibly weighing on shares that we're hired today.
Yeah, and all of this is more into how they interact, like you said, with the artists, with the venues, is like the key kind of company that helps put on the events. Of course, they also have the association with ticketing through Ticketmaster. But as fans, this is it's clearly a problem. I don't think anybody disagrees. I mean, even the people who do the tickets probably understand that this is this is broken. But I don't know how you fix it, because even if you find a way to provide cheaper tickets, it's the reselling, it's the constant kind of scalping aspect of this, where it's almost like its own buy and sell marketplace, almost speculating on the value of tickets. But at the same time, you don't want to lock people into purchases, because what if suddenly something comes up and you can't go? So you need these to be transferable, but the fees are out of control, and it doesn't matter what company you go to, any of them, out of control, and that's not even really what this lawsuit's about.
It's not. I have my own whole personal gripe with it, because I think all concerts here in the U.S. have just gotten way too expensive, and this is sort of a solutionless problem, but at least DOJ's stepping in, trying to help a little.
And maybe explains why it's up, because it's not going to really mess with the fees. So the fees are still going to be churning over at Ticketmaster and Live Nation, etc. Next on the list, though, is BABA. So we're going to talk BABA and Boeing. So a lot of BAs in the next couple, but let's start with BABA. This has been we talked about it countless times. Struggles in China, well documented, but we're trying to stage a comeback.
We are trying to stage a comeback, and unfortunately this week doesn't seem like it's the week for the comeback, because BABA shares are down about 7.5% now week to date. Most of these Chinese names like Baidu, JD.com also lower, the one exception being PDD, which should have some pretty nice earnings earlier this week. But Alibaba did disclose late Thursday a price of private offering to eligible purchasers of around $4.5 billion principal amount of around 0.5% convertible senior notes that are due out on 2031. Initial purchasers have been granted a 13-day option to purchase up to $500 million of additional notes. And the net proceeds, which are estimated to be around $4.4 billion to around $4.9 billion, will be used to repurchase around 14.8 million ADSs or other share repurchases, as well as fund various capped call transactions per the company's release of this news. So not the most exciting piece of news for this Friday, but there is some movement in Alibaba to close out a pretty poor week that we're at least sort of etching back some of the losses up about 1%.
Yeah, the convertible debt offer, obviously dilution potentially out there, increase in the balance sheet, but look, I'm out on stock buybacks. If you got to borrow money to do it, maybe you got better things to do. Also, your stock's been going lower, possibly because your company is struggling perhaps, or maybe it was overvalued. I mean, is the best use of that capital that you're going out and borrowing simply just to buy your stock back? Look, I get it if you're Apple, you got $100 million in cash sitting on the sidelines, you don't want it to burn a hole in the pocket, you buy some stock back. Still, I'm not sure when your revenue's going flatline. But Alibaba, your stock is struggling, and I guess maybe they're trying to buy low. Maybe they think the stock should be worth more. If they want to borrow some money, they want to buy low here because they think it should be worth a lot more than this. I don't know.
Picking the lows, or at least attempting to choose the lows in this name, all of these Chinese names, actually most names, I would argue, is nearly impossible. So yeah, I think that's...
At least they're not buying the highs, though.
That's true. That's always the biggest mystery to me, Warren Buffett and Occidental Petroleum. I'll never forget that whole fiasco. But nonetheless, our next name today is another one of those closely related tickers, but totally different company. That's Boeing. So Boeing CFO Brian West did say on Thursday that they will burn through their cash in 2024 and that new plane deliveries will improve in the second quarter of this year compared to the first. So
Bullshit.
they've blown through about $4 billion in cash in the first quarter of this year, and they think actually that number for second quarter could be a little bit worse. But he said this turbulence won't last forever and that Boeing will likely begin generating cash again in the second half of this year. Shares fell about 7% in reaction to those comments, but then are up about 1% today, as we did see that the company's unionized workers and federal regulators will now be on this new committee to review safety incidents and quality concerns. And I think that has since been a pretty
That's going to be another big mistake.
Given the fact that we did see that in-flight blowout on the 737 MAX, and it feels like the headlines have only piled on. I just saw a more recent incident that was involving a Boeing plane, but I don't believe Boeing was at fault. So unfortunately now they're like swept into every headline. They have got to do some damage control and do it quickly, frankly. It's actually amazing to me how resilient Boeing has been in spite of like an...
Resilient?
Yeah, and one, I mean, has to think it's because there's really...
Oh, gosh. Oh, gosh. It's because they were lied to, honey. They came out a month ago. Did you not hear me just a few seconds talk about it? They came out and said they were going to be profitable this quarter. They said that they were going to shoot them planes out. And it's not. They came out yesterday or the day before and said the opposite. This was only a month ago. That's why it was so resilient, because it was pumped on a lie. The thing's going to fall more. They're not going to show profit for the next quarter and the quarter after that. Maybe the one after that. I worked in a frame shop. I got a job on the telephone to go to Hawaii and become a warehouse manager. So I get to Hawaii, and they make 20, 30 million a year selling picture frames. So I'm about there about 4 or 5 months, and the boss comes up to me and says, "Jim, we're thinking about having a meeting, and we want to make this easier to trade." Everybody had a workstation, and one section did the mat cutting and the preparation, and then the other section did the fitting. It was simple and easy. But he wanted to have it different. He wanted to turn it into an assembly line production thing, where you have one person cut the mats only. Then you have one person putting the mats together on the art or prepping it. Then you'd have one person cutting the glass. And you'd have 4 or 5 assembling the product. I told him, I said, "Man, you're going to be moving this shit around all over the factory. You don't want to do that. You're going to get nicks and scratches on your picture frames. You're going to get dirt on your mats. It's going to cost you a little bit more to bag everything up." So they tried to do this switcheroo, and it turned out to be, a total flop. There's outsourcing the job. Not one person doing it from the beginning, cutting the mats, putting it together, and then handing it over to the framer. This is going through 4 or 5 different hands. And by the time it got to the picture framer, it was usually didn't fit the frame. If it was a custom frame, if it was a ready-made, you still need to measure the frame before you cut the mats. So there's cutting these 8 by 10, 12 by 16 by 20 mats and hoping that they'd fit in a ready-made. And many times it didn't. It was a little bit a 1/16 of an inch too big, or and that's what Boeing does. It outsource their work. They used to do most of it was I don't know exactly. Boeing's a big operation. I don't see how they can get it done, but they're getting it, they're rushing too much, and it's causing flaws. And then they're hiring people that are woke, that care more about themselves than about the company. I just got a plaque, or I'm getting my plaque for 20 years of working on this one job. And they didn't want to outsource. They wanted to keep me because, I was good. But my opinion about Boeing is not positive. So, honey, you're fed the wrong information. That's why it was so resilient, and it's not really resilient. They were saying the same stuff when it was at 220. When we were up here and we got that bad news, they were pumping this thing up. I mean, I took this trade at the very bottom. I was so proud of myself. Back in September was the month to remember. This thing was at 120. We had the snake breakout pullback, and then the big boom. And I run it all the way up to the 200. And then you had this big run. Irrational exuberance. And it came back and pulled back after that. But they had this thing at 220, and they brought on a crew of people saying, we're staying in the stock. It's going up from here. And it's down here. Now we are at a real solid support. I mean, if you look at the chart, you'll say, I want to buy this thing. Because you're down here at the W, right at the neckline. I mean, it's just at a very solid support, no matter what's going on with it in a bullish market. But this news is just another. I mean, when a company tells you that they're not going to make money, and this is supposed to be a market leader indicator, as what that guy said this morning on CNBC, that's why the market tanked. It was because of Boeing. And I disagree. I disagree. It was a sell in a news event. Because I realized it after I got out of the trade yesterday, and I woke up this morning, I said, it was selling the news. Because we waited so long for that NVIDIA. Putting all your eggs in one basket. But we are at a solid support. In the money sweep at 682K, May 24th. Man, I'm going to enjoy these 3 days off. Spy. Go get my water. First Solar.
Kind of gave some cautionary tone to it. They said investors should expect just kind of these lead times that First Solar is dealing with to gradually come in throughout this year.
Yeah, and that's a good point as well. I mean, like the run-up in this name has been, I mean, like phenomenal. But it's also interesting that First Solar has been like the obvious greatest beneficiary. I mean, I know that there's been this recent strength. I was looking at the Invesco solar ETF that has also been on a nice run, but then there's still some of the laggards, and I do know that every solar company performs differently, but First Solar has been like the clear leader.
Absolutely.
Just like NVIDIA.
But you know, they, for instance, JP Morgan Chase said that the macro factors, while that's impacting projects,
That's too much. That's $100. That's $100 move in 5 days. I'd short this sucker.
In this space.
Let me see.
Yeah, I would say that checks out based on its recent, I mean, nice upside performance, but. I mean,
but
nice run up, nice performer this week. So hey, a nice way to close out things on a positive note. Appreciate it as always, Dan King Hall, senior markets correspondent for the network. So,
June 21st.
I have found the solar space to be so interesting as of late. Maybe because I like the AI hype, and it's like follow the hype cycle. It's now moved into solar.
What I found incredible too is I was just going through this, slew of analysts, and Diane mentioned the Guggenheim.
I like the 260s.
Target that is the street high.
But
I don't see a single other
the 240 puts
target above 300. This stock is higher than the majority of these price targets, even though 84% of the analysts say to buy the stock.
No.
That tells me that this rally has basically hit a new gear. It's in hyperdrive to the upside, and it's blown past.
Nope.
First thought was, were people short this stock? Is this some short covering? Were there some doubters that got caught offside? But you certainly don't see a big short interest on it.
No, you don't. Not like SunPower.
But the spread's too wide.
Notoriously, I mean, like it's like sky high short interest. So,
see, if the spread starts to shrink.
The way that analysts do see, I mean, like all these notes are so positive. They're like AI is going to be the next major catalyst for solar. For solar's underappreciated by the market. Is
it going to make the sun come out in Chicago? Because if we can figure that out, I'll finally capitulate and be in on AI if it can make it sunny here.
But you know, we are in like the upswing of weather in Chicago. So
we get like 6 weeks.
Yeah, it's true. But first, yeah, I think that the way like these analysts speak about this, and you'd think the average price target would be higher, but as we know from analysts, it's not.
They got windmills in Chicago, baby.
It's just sort of like the gauge on what the street thinks. But so when we trade this name, then considering all this upside, I think the FOMO feeling has to be this week to the upside.
Oh, no doubt about it. And with that big round number of 300 potentially on the horizon, huge moves here today of 9%. Another 10-ish or so percent from here will get right to 300. So I looked at a call calendar spread, Jenny, going towards that 300 strike. What I looked at for expirations was simply selling next week and buying the following. This is an expensive implied volatility stock at the moment where options are going to be trading at pretty big premiums just simply because the movement's been so great. With that anticipation of movement comes more expensive options, all things considered. So selling May 31st, buying June 7th, 300 strike calls, $250 debit, $250 in risk. Need a move higher. I would like for that move to run into a little bit of selling around 300. As you can see, that's the apex of that risk profile. That looks a lot like a mountaintop peak.
Yeah, and I think the good way to sort of play into this will also being more risk defined, because obviously if we just took the average price target among those that cover this name, you'd say there could be some downside from here. You know if that's the case.
Well, we know that sometimes too that those analysts can they're lagging, right? They don't all update them every single day. But if you just took the ones that updated it in the last 24 plus hours, 262 and 250, and they're both buying overweight. So
and 219 I saw also, which is even worse.
It's just running over the street right now. This stock is a powerhouse.
And who would have thought? Because gosh, not for solar, but the solar space needed this upside catalyst. But we will leave it there. And now I'd like to shift gears and look at some of the earnings we did get that we're seeing, unfortunately, some downside movement in reaction to their quarterly updates. I'd like to welcome in Jeff Pierce, Senior Manager of Derivatives Trading for Charles Schwab. So Jeff, let's start off with Intuit, which is actually the better of the two post-earnings moves. And better is putting it gently because it's still down 8%.
Yeah, I think if we look at the companies we're going to look at today, guidance is going to be the key that we're going to see across the board into it. And the guidance is a little bit disappointing, but they did at least raise their guidance from previous quarters. So just quickly on the report, the earnings per share did beat. Revenues rose 12% year over year, beating as well. Their largest group, which is that small business and self-employed group, those revenues were up 18% year over year. On the outlook side, they expect full fiscal year sales, at 16.16 billion to 16.2 billion. That would be a growth of around 13%. That's up from previous forecasts. They also raised their full year adjusted per share profit forecast to $16.79 to $16.84. That's about a 17% increase and better than what we had previously seen them forecast. However, we did see some of their users decline, including the users that use the system for free. We saw analysts come and weigh in. B of A, who lowered their price target by $30 to $730, talked about their projected 7 to 8% consumer tax growth for fiscal 2024. They were expecting closer to 9 to 10. We saw also Mizuho, a similar thing. You come across with some of the disappointment on their consumer revenue guidance. So I think that's part of the reaction we're seeing here today from investors.
Stocks and Workday, I see a pretty substantial sell-off, almost 15%. We just wiped out 3 years of gains in one day.
Yeah, and you can see it, especially in the outlook side of it, right? As I said, Intuit at least has raised their guidance. On the flip side here, for Workday, earnings per share did beat, revenue beat as well, up 18%. In fact, their subscription revenue was up 18.8%, and we saw the revenue backlog come in at about $6.6 billion, very similar to what we saw last quarter. But for full year, they now expect subscription revenue between 7.7 and 7.72 billion. Analysts were looking for 7.77. Prior subscription revenue forecast for them was about 7.72 to 7.77. So, not a big surprise here, but the CFO said their updated revenue guidance reflects those elevated sales scrutinies, which we've been seeing.
What do I think of the SPX?
We talked about their lower customer headcount.
When is Ruse Day?
They continue to experience that. That's the trend we've seen across these names.
Ruse Day
revenue growth has been slowing down as these
is a new game that I play.
Rein in the spending for a lot of these software companies.
Do you want to get Rousey?
Another report where it was a bit of a disappointment and the outlook did not help. The good news for a company like Salesforce, who's going to report next Wednesday after the close.
Oh, my sweetheart's here.
Bring down a little bit, which might make it a little bit easier for them to move if they have some
I love you.
in the report.
Yeah, and Jeff, I was just going to ask you about that. What we can expect from Salesforce now? I mean, would you say these are indicative? I have a hard time making that jump. I think maybe more Workday than Intuit is a bit of a reach, but Salesforce is like the overall CRM cloud king. So if they have disappointing results, we could actually see some of the overall market sort of perhaps crumble.
You had to throw the friend in there.
And I think there's some very individual stories in each one of these names, and I also think that Salesforce has done a good job of, setting a relatively low bar. We saw that in the guidance last quarter. That could certainly help with this report. The fact the stock has already pulled back on the reports coming out of Intuit and Workday can help as well. Expectation-wise, we're looking for about $2.98 a share. Revenue $9.14 billion. We have seen analysts weigh.
Well, it's getting ready to squeeze.
Companies reported.
If it holds the 200 SMA, if it doesn't hold the 200, we got a 1, 2, 3 down here at 53.61.
In Q1 results and a low bar set by guidance last quarter.
5,378.
Should make it easier to beat expectations. I think.
And that has to hold, or it's a knife.
2025 revenue number. That's what investors are going to be looking at, especially after what we saw the other reports.
Well, given the fact that we're more earnings light as far as news goes next week, I'm sure we'll all
I'd
be
wait.
talking a lot of Salesforce next week ahead of those numbers because we are right now scrapping at the bits for earnings.
Not enough traders to really pump it.
As always, Jeff Pierce. Now we'll shift gears. Coming up next, we're talking Burger King, which is taking a shot at McDonald's with more of its meal deals. We'll discuss more conversation that will.
They must really have some issues.
Coming up next.
How many people in here eat fast food? Do do do. You eat so fast. Doo-doo. Oh, oh. Doo-doo. Oh, doo-doo. Doo-doo. Doo-doo-doo. $1,700 Bitcoin today.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
My dad was a hard worker.
Oh, your dad sucks.
Side jobs, installing.
Windows. Mike, I'm going to send you a guy that I follow from New York. He was on Fox News, and he's from the Bronx. He was on He's named Lou. Yeah. Yep, I'm not too into. I think everybody's kind of relaxed from trading. They're off to their vacations. Got to get on the plane. The plane. See, this is me. I got 3 days off. If I wanted to take a trip, I wouldn't be here today. That gives me three nights and 4 days, which I used to take week off, but I ain't had a week vacation in 20 years. So the IRA, all my businesses will be closed on Monday. I'll probably get on here and do a live session. If anybody wants to learn how to talk stocks, or how to chart, how to go through a watch list, be here at noon, 1 Eastern time on Monday. You got that YouTube? Yay. snort. Oh, I'm gonna go grab me another strawberry and a tomato. Before I'd be eating chips. Going back to my boxing regimen. I should have 6-pack abs in about 3 months. Well, I was waiting for that laugh from Mike. It's coming, I know it is. How do you think I got the name Washboard?
9:30 time. Welcome back to Next Gen Investing. Joining us now, George Tillis, Senior Markets Correspondent for the Schwab Network, to discuss Lucid, as well as maybe some bonus on Tesla in the EV space. Let's start with Lucid, George. I'm sure that the conversation will get to Tesla. It always does. But layoffs announced.
Woo!
Yeah, I mean, Lucid just announced they're going to be laying off about 6% of their workforce because obviously I think there's some challenges that we've alluded to going on in the EV space. It seems like consumer intent on purchasing EVs seems to be, from an industry-wide standpoint, falling, or at least not growing
Restructuring.
maybe anticipated just going back maybe a year or a year and a half ago. I mean, obviously Tesla's facing some challenges as an automaker. We talked about Li Auto and XPEV and even NIO on this program. These are all Chinese auto manufacturers that are EV centric, and those companies have struggled. And even Rivian, I see Rivian's driving around a lot, and that company's stock is also struggling. Lucid is a very much a luxury automaker, much like Tesla. They seem to have more of a novelty component to their products. They're more expensive than certain Tesla models. I haven't seen any of these driving around. Maybe I have at least one or two, but I don't see as many of these products. But my point is obviously there's a lot of things going on in the EV space because of affordability issues, maybe tax credit issues. These are all sort of macro themes that these company stocks have been really pushed to the
What was I
upside
saying?
in the last 3 to 5 years.
Oh, yeah.
But I think there's some structural challenges.
Mike, you got yours on? Mike, you got your ears on. I sent you a video of my friend Lou from the Bronx. He, That's very rude. Just for that.
Production problem, because I don't necessarily see, I see basically a cap on their revenues because they can't produce enough cars. While at the same time they're actually producing more inefficiently. And what I mean by that is if you look at operating losses last year, with only 10 million more in revenues from 2022, they lost an additional $500 million to about $3 billion in operating losses compared to $2.6 billion going back to 2022. So they're not selling enough product, or they're not making enough product, and they're essentially, their expenses are ballooning up in the last couple of years. Therefore, the stock price has been falling. If you look at the last year, it's down 60 or so percent. Last 3 years, down 85%.
So George, I thought it was so fascinating the way that Rivian loses like 40,000, 43,000, I believe it is, per car, which we've always said is the way that they have to obviously be profitable. You have to figure that out. Lucid loses between $300,000 and $400,000 per car. So like, what are they doing wrong? I mean, like I've never heard of anything that's so disconnected from the price.
Well, that's the thing. I mean, that alone, it's like, if you think about that, obviously, somebody's going to make an assumption their products are over.
This makes Tesla so great. And one day, these idiots on CNBC will realize that Tesla is number one. I mean, why do he still makes profit on these cars. And he wants to lower it still for the consumer. They got people in China that can put them together for 10 to 12 grand. Joe Biden has screwed the auto industry. If you're a union worker and you still support that idiot, bye-bye. Say goodbye to your job. You still vote Democrat. I'll never understand.
A lot of money to make, and it wasn't sold for, I mean, they're still expensive, but just not make.
Now you got illegal immigrants coming up and taking your jobs from you.
Myself or Next Gen Investing for this whole week. Have a wonderful long weekend all. We have the watch list for full penalty news coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With investor...
Got a sending triangle on the video. We're going to tell you to build electric cars if you like it or not. Although I still will drive my Corvette. Yeah. I asked all my liberal friends, which is probably 99.9% of them, are you going to go out and buy an electric car? Are you happy that we spent hundreds of billions of dollars on wasted money for the unions? You've not been this straight in years? What'd you do? Not get stoned today? Hey, Randy. I'm with you, man. I haven't been stoned for about a month now. I think I'm just going to get healthy first. When I do get stoned, I want to munch, and I forget about exercise and I don't know. I don't know if I've smoked more than you or if you smoked more than I have, but I'm older than you. I think.
starting to pull back. And this might be a warning signal, Nicole, if you take a look at maybe that CapEx spend that companies
Workday.
are doing right now. Maybe they're not going into the legacy enterprise software companies like Workday, maybe Salesforce, we'll find out next week, and pushing more into their AI investments at this point. But pretty decent quarter on the top and bottom lines, but then again, all you have to do is say something bad about guidance and you're going to get hammered like they are today.
Look, unless you have a perfect report at this point, it sells off. And some of these moves seem so dramatic. I mean, 15% is not a small day. No. That's a big day. And on the other side of the coin, we have Deckers, which is up 13%. But, you know, to the point of NVIDIA, they knocked the cover off the ball and they were able to surge in the pricing. But unless you do really great, it's pretty hard to get an up arrow. How about Deckers? Tell us a little bit about that story.
Yeah, this is a blowout quarter for this company. Rebound in one of their key segments, and that's the Hoka brand. Now let's run through some of the numbers. EPS was $4.95. The consensus was only about $2.82. That EPS was a 43% increase year over year, and revenue came in at just under $960 million. They only expected about $887 million. As far as revenue goes, so a big beat there. Also, fiscal year 25 EPS $29.50 to $30. The consensus just above the $30 level. So guidance wasn't like really robust at this point, but you start breaking down the numbers here in their two major brands, and that's first Hoka. Sales accelerated 34% up to $533 million. That's ahead of the $506 million or 27% increase that the street expected. And if you looked at last quarter, that's Q3 of fiscal year 24, the Hoka brand sales slowed nearly 22%. So this is a big rebound here in their running shoe brand. And then if you look at the other segment, which is their big revenue driver, and that's UGG brand, the winter boots, the sheepskin lined slippers and stuff. Those sales increased 14.9% to $361 million, and they expected only an increase or a fall actually of 5.4% to $297 million. So still strength there in the UGG brand and a rebound in the Hoka brand. Fourth quarter sales overall pretty strong, and 18% net sales rise for this company compared to fiscal year 2023. One item of note with a company like this, and when you look at the stock and the massive rally that we're seeing today to all-time highs, is the fact that there's only a share float of about 25 million shares outstanding. This is a really high-priced stock. There's not a big share float, so that scarcity comes into play here when you beat earnings as well as they did, where maybe the shorts are getting squeezed also.
Yeah, well put. I'm glad you mentioned that about the float. And I did like your description of Uggs, right? I like those sheepskin lined things. They're super and nice and warm. Thank you so much. And of course, Hoka has become so popular so fast. Tom White, great to see you. Have a great weekend. Now let's take a look at the bigger picture. Darius Dale's with us, founder and CEO at 42 Macro. Darius, thank you for being here. Look, we're wrapping up a busy week. We have a 3-day weekend. Monday is a day off. People sometimes get out of their positions ahead of the weekend, but still holding on to some green here. Some of your market thoughts.
Thanks for having me, Nicole. It's always great to be here. So I'll start by saying that this is a very bewildering macro risk management environment to risk manage. You have a lot of divergences both domestically and globally. So I'll start with the big three. Number one, you have global growth diverging from U.S. growth, i.e. global growth is accelerating and U.S. growth is decelerating. Number two, you have a global policy divergence, particularly when you think about the likes of the Bank of Japan versus the other central banks in the world, which have much tighter monetary policy. And then lastly, which is arguably the most important divergence on a forward-looking basis heading into the third quarter, is the divergence between the Fed's ultra-dovish monetary policy versus the hawkish net financing policy pivot that we have seen and are about to feel from the U.S. Treasury.
So it's interesting you talk about the global growth picture, because there's already talk about the ECB cutting first and then maybe the Fed afterwards. Why is this also important to have maybe some central banks to be in sync?
Yeah, well, it's not necessarily important that they're in sync. It just makes the game a little bit more challenging for investors. right? It's a lot easier to make money when every central bank is pumping liquidity in asset markets, i.e. what they were doing in 2020 and 2021. It's
Oh, SMCI.
learned
Yep.
risk managed markets when you don't
It's
have
one I look at every day.
signals across global growth, global inflation, and global policy. And in our
We missed a good one there.
This is where the pros really separate themselves from the Joes. And in my opinion, it's a very difficult setup to risk manage.
As I'm looking, we just finished talking about Deckers and how.
Yeah, if I'd have saw that,
And, as I'm talking,
I would have took it at the 200
TJX is gonna likely
or
close at a
Head and
record
Shoulders.
high. It really just shows the resiliency of the consumer. And while those discounters seem to be doing even better because people are going maybe pinching the purse a little bit, but the big picture is that people are still feeling. I know sentiment came in was a little darker in May. That's what it says, right? Sentiment darkened in May, 69.1, but versus 77.2 in April. But the big picture is people are still out there spending, right?
Oh, absolutely, Nicole. This has been, so we've been in the view that the U.S. economy was going to remain resilient. We, in fact, authored the resilient U.S. economy theme back in the summer of 2022, and we continue to see evidence that consumer balance sheet dynamics and consumer income dynamics are supportive of a continued expansion of this business cycle, particularly through the lens of consumer spending. And so, we don't want to hang our hat on one data point here, particularly with last week's retail sales print or today's Michigan Consumer Confidence Report. The reality is the trend of consumer income and expenditure growth remains incredibly positive and supportive for the broader risk appetite in asset markets, and it's been one of the contributing factors to why we have been in a risk-on market regime since going back to November. And a lot, you see what typically happens in a risk-on market regime, which is risk assets significantly outperform defensive assets, and higher beta risk assets within that bucket tend to outperform the lower beta risk assets, and that's exactly what we've been calling for, and that's exactly what we've experienced in asset markets.
What's your advice to investors? What should they be doing? Buy, sell, hold? What should they do here?
Yeah, from a forward-looking perspective, the game gets really interesting heading into the summer, right? We have this policy divergence between the Treasury and the Fed. I'm not so sure how that's going to be resolved, but what I am sure in is that our risk management systems will keep us on the right side of market risk throughout. To me, it's a very difficult spot in asset markets to think about how to place chips on the table, the incremental bet on the table, because on one hand, we have very dovish monetary policy and a resilient economy that should support continued gains in asset markets. But on the other side, we have hawkish Treasury policy coming down the pike, and the positioning cycle, when you look at it through the lens of our positioning model, is very onerous from the perspective of forward-looking market risk, not necessarily on a 1 month, 2 month, or 3 month looking basis, but when you think about this on a 1 year forward type, multi-year type basis, it's very unlikely we can sustain these types of asset valuations, whether you look at equity multiples or credit spreads. So it's a tough spot.
And last but not least, I think I should leave it to you. What's the final thought here? What are we leaving out?
Yeah, my final thought is, so you take a multi-quarter investment horizon approach to this. We are still in a global liquidity cycle upturn. The Fed is still dovish. The economy is likely to remain resilient over the medium term. And as a function of all that, we should remain in a risk-on market regime. The problem with that is that the positioning cycle already anticipates that. And moreover, when you look at things like earnings growth expectations or GDP growth expectations or even inflation expectations, a lot of good news is already in the price. And so it makes the decision process you have to make as an investor very challenging. And the final piece of advice I will leave investors with is, this is not the time to be relying on your predictions of what's going to happen in the economy and asset markets to manage portfolio risk. This is the time to get away from your predictions and just start trusting your risk management process, start trusting the market signals, because again, those will lead you to the promised land.
Promised land.
All right. Thank you so much, Darius Dale, 42 Macro. Great to see you, Darius. Thank you.
Oh, here they go with that squawking shit.
To the state of inflation, how companies are reacting to consumer.
Don't do it there either.
Much more. Schwab Network. We'll be right back.
with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to the watch list. I'm Nicole Pedalides, live on the floor of the New York Stock Exchange. A look at some more movers in the market right now. NetEase, a Chinese gaming company, lower today after reporting earnings.
NTES.
Thursday, first quarter revenue grew by 7.2%.
Home Depot's got a head and shoulders on the weekly off the 200 SMA.
$9 billion. Despite the miss, NetEase CEO believes that the company is well positioned to extend its gaming experiences to audiences across the globe with its portfolio featuring premium quality games. BJ's Wholesale Club higher after reporting a positive start to the year. Membership fees highlighted its report rising 8.6%, hitting over $111 million.
BJ.
The company plans to open 11 new clubs in the second half of the year, expanding into new markets, while also investing in existing clubs. Analysts raised their price targets in the stock. Intuit sinking despite posting a 12% year-over-year increase in revenue.
We talked about this one the other day.
TurboTax software towards consumers facing complex tax scenarios, offering online expert tax.
Man, I tried that Intuit stuff. It didn't work for me.
Doing more with less investments thanks to AI. Bank of America Securities highlighting analyst price targets cuts, reducing
Too complicated.
target to
You have to have brain smarts to use that.
from $760. The change reflected concerns about potential risks associated with the company's consumer tax business. And then there's Ross Stores. Wow, well, that one rose today after the discount retailer impressive first quarter earnings. The report was highlighted by total sales increasing 8% to $4.96 billion. The company performance was driven by higher sales in accessories and children's merchandise. Ross Stores stated its focus on managing inventory expenses tightly and delivering value to its customers. And here's what Bitcoin right now, still below 70,000, 69,370, up 3.2%. Should have brought up Ether. That's going to be, Ethereum's going to be a big story in the next 10 days, obviously, as it moves forward and getting some positive comments from regulators. Anyhow, let's get back to the big picture here. And joining me right now, Will McGough is with us, and we are happy he's here, Director of Investments, Prime Capital Investment Advisors. Thank you for being here. So, the week's wrapping up. How do you feel about the week and the week ahead, too?
Well, it's kind of order of importance there. Hopefully everybody has a great weekend. Thanks for having me on, Nicole. It's been a hectic week in the markets. NVIDIA earnings, obviously everybody was focused on, rightfully so. One of the Mag 7 with the AI theme that's just driving the markets these days. They delivered. So it's what's next? What's going to drive the markets in the summer? And we're not really seeing a whole bunch of factors that are going to move us one way or the other. So the old adage, sell in May and go away. Maybe a good strategy this year so that everybody can have fun this summer, starting with Memorial Day, because when we come back after Labor Day, there's going to be a lot of volatility with the election that may drip over into the stock markets.
And also, what will the Fed do or not do? So you're a little concerned about the catalysts that may or may not exist for this market. Right now, you said NVIDIA, for example, was an exciting thing. But then yesterday, with the worst sell-off rate in a long time. That being said here, when you do like different areas, for example, you even like small cap value. I mean, that's something a little out of the norm.
Right, and so small caps, if you look at the style box, which there's 9 of them, small cap value is 1 of the 9, is the most undervalued from a price to earnings ratio perspective. So we see value in small cap, especially small cap value. There's also a good technical setup going on in the fact that it hasn't really done a whole bunch over the last 6 to 8 months. So it's been trading sideways and is looking to break out higher, which we like as well. And finally, on a rolling 20-year basis versus the S&P 500, small cap value is negative for the third time in history post World War II. The other 2 times this happened, the next couple of years saw small cap value outpace the S&P about 3% per year.
Oh.
So we see a confluence of factors that are giving us a little bit of comfort in knowing that small cap value is going to get a little bit more attention in our overall asset allocation.
Right, understood. So when you look at the different areas, that certainly seems to be one. What else do you like? I mean, do you like large cap growth? Is that still something you look at?
If you're allocating assets for any client or institution, you have to be in the Magnificent Seven, which are large cap growth names. So it's more just keeping serve with the S&P 500 and whatever our benchmark may be for a multi-asset portfolio that's going to have a large cap growth allocation. And it gets a little fuzzy with, S&P 500 and value and growth, and all the index providers out there have a little bit different methodology for categorizing growth and value. So there's a lot of bleed and blend and growth, which is really hard. A lot of active managers, mutual fund managers that have a hard time outperforming that space. It's so efficient, so driven by those top names. So we are essentially right on benchmark with our large cap growth allocation and see no reason to underweight large cap growth, given what we saw with NVIDIA this week, AI coming through everything. It's in the early innings of this trend, and it's going to take a while for it to percolate through the economy and hit all businesses. We've seen some of that hit already with utilities, getting a little bit from AI, but it's going to hit everything. Anything you can think that can be improved by artificial intelligence is going to be, and that's only going to make operating margins better, more efficient companies, which means earnings growth, and with earnings growth, you get stock market growth.
It's interesting because you went all the way back, I love to look at historical data. It doesn't prove anything will or will not happen, but you were looking all the way back to World War II and looking at this bull market, and comparatively, there's still some room to run, right?
That's correct. Yeah, if you look at just basic bull and bear markets, it's defined by 20% moves. Coming off of October of 2022, we're just under 50% return on the S&P, which is actually behind pace for all the other occasions at this point in time of a new bull market. So there's room to run. Statistically, the average bull should be up, about 60% of this time. So we've got a little bit of room to run there, which may help us get through the summer and get through the election. But that said, once the focus becomes on what Washington, D.C. is going to look like for the next 4 years, that's going to be baked into everybody's forecast earnings multiples, and we'll see the S&P potentially reprice with what's going to go on this fall.
Yeah, understood. What about something like short-term bonds? I mean, are you still in those at all?
That's a great question. We get a lot of questions about should we be in bonds, should we be in cash, clients see lucrative money market rates, and it really just gets back to figuring out what your need for that type of allocation is. If you have short-term needs, so call it anything under 2 years, 18 months, you're not going to see too much deviation between a money market investment and a short-term bond investment. But with short-term rates and the curve kind of being flattish, you have the potential in a negative scenario to get some price appreciation plus the yield if you're in bonds versus cash.
I also wanted to ask you, and I saw when I was sitting here one day that McDonald's was going to work on a $5 meal. Now you're talking about Burger King and Wendy's, and Target's been cutting prices. You tell me. I mean, what's going on here? Is this a good thing, a bad thing? What's happening here?
I think it's a good thing. And listening to your earnings wrap just a few minutes ago, like BJ's and Ross.
Double top.
So
1, 2, 3
is resilient. Companies are looking to get consumers back into their stores. Target cutting prices on thousands of items.
Oh God, please.
McDonald's are coming back. Burger King got in with the whopper of a deal today.
It's election time, man. We want to bring these prices down. We've sucked everything we could out of you for the last 3.5 years with a 30% inflation hike price. All of a sudden, we're going to be nice. and we want Biden back in office. So we're going to give you value meals at $5. Burger King. Everybody's dropping their prices all of a sudden. It's because they're going out of business. They've made enough money, except Target. But again, they get to write that off. Shrinkage. Tax-free. I got a story about shrinkage I'll tell you one day, working for Walmart. I was going to college. I had to have me a little job. So I started working at a grocery store, and then it ended up being Walmart. No, I was working at Walmart, and then I got my GED and went to college. Your dad and his windows. The hardest thing I ever had to do is write an essay at that test, the GED test. I forgot what I wrote it about.
Ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
I was trading with this other guy in another room that had a master's and a bachelor's degree in economics and accounting. So I put this alert on the video, falling wedge. And he said, no. And that was it. And so everybody was starting to back him up. And this other guy got a little mouthy. So I messaged the one that said no. I said, hey, I've traded with rookies before. I didn't know he had a bachelor's and a whatever degree in economics and accounting. And he spit off this number, 844. I went, what the heck? What's 844 mean? I still don't understand what he meant. But he was so technical that you miss all the other things that you're going that you could see take a good trade. And so it formed a falling wedge. It wasn't a falling, it was starting to be a falling wedge. And I was alerting, we're getting ready to have us a falling wedge and a breakout. No. I message him, I say, no. There ain't no falling wedge. And then it formed a falling wedge and broke out and made $1,000 a contract. And I messaged him and I said, hey, I've traded with rookies before. I'm used to this. He said, I ain't no rookie. I've been trading for 25 years. I got a bachelor's this and a blah, blah, that. And I worked for a big firm. And in my mind, I'm going, and that's the same guy with Mr. Wall Street that traded on Wall Street most of his life. Real smart, college educated, bachelor's, science degree, whatever it takes. And they lack street smarts. If that makes any sense. Nothing is never a clear picture when you're trading stocks. I'm going to show you a great example. NVIDIA today. So you got people looking at NVIDIA, and you don't see an ascending triangle here. But you do see, well, you do. You do see it. I guess you do. I should have rubbed that in her face. But there's an ascending triangle right there. But they thought this was an upper wedge, which, now that I look at it and I see this, I have to go back and say to them and say, no, man, that's definitely an ascending triangle. But I had to go to a bigger picture. You have this resistance here, and you have that top right there, and you have these three down here. 1, 2, 3, and we called this out first thing in the morning. That's an ascending triangle. But this is also an ascending triangle right here too. I don't see a wedge in there. This thing gets in the way to be a wedge. Yeah, I mean, there's no wedge there. I should go back and correct. I told him it was a wedge too, and an inverse head and shoulders. Or a head and shoulders. See the head and shoulders? There's your head, left shoulder, right shoulder, boom. Head and shoulder breakout. And then you got an ascending triangle. You got two of them. One right there. You got 1, 2, right it open. There's your ascending triangle. But I've had, there's your rising wedge. There it is. Yep, that's a rising wedge. That's a rising wedge. I'll accept it. I saw the rising wedge. It is. I'm glad I didn't make a fool of myself. So you got an inverse head and shoulders breakout. Then you got the 1, 2, 3, boom. 1, 2, 3, 4. But nothing's never perfect is my point I'm trying to make. You have to kind of fudge it a little bit. I had one of my best friends leave me because he didn't know what a double bottom was. He wanted to argue with me about it and yell at me and scream at me. And I'm going, what the heck? You know, why are you screaming at me? You don't know what a double bottom is. Double bottom is two bottoms. It doesn't matter if it's if I have to wait to call a double bottom all the way down here. I mean, I'm not going to be able to take the trade. Here, it's not a good example of a double, what I'd call a double bottom, but it's usually after the pattern, after the snake. And then anything after the snake, if it pulls back to a double bottom, I call it double bottom, high or low all the time. But it's once that channel is formed, and then you start a whole new era. And you're trading from that channel on. You're not trading from anything from the past. So you erase it all. Draw in the snake. So in this case, you got your left shoulder, your inverse head and shoulders, and your right shoulder. And I'd say, okay, we got us an inverse head and shoulders, and we got a high or low. There's the channels right here. But that's an inverse head and shoulders. That's not a double bottom. still a higher low, but I'm not sure. I would have called it. I might have called it there. I might would have called it there. I would have called it there. And then I'd come up and say, we got to break the 3. And if we break the 3, we break it, pull back, boom. Then we come back and retest the 200 to say safe. Where do you set a stop? At your entry price or your double bottom. So here you are. You got your snake, your inverse head and shoulders, your breakout, your pullback. It breaks out again, and then it comes back and retests a double bottom outside of that snake. There's a whole new thing. And then even that could come back and pull back and hit that again and bounce up. Snake, breakout, pull back, boom. Then it comes back and retests a double bottom. But everything starts after the pattern. And then, if you do take that and you look at that, you want to go and look at the previous stuff here and see if that correlates with a resistance level or which it does. You got another head and shoulders. So you could say, well, Jim, man, we're pulling back. We've got a nice little pullback right here with a beautiful candle. Hammer wanting to break out, but I don't know if I should take the trade yet. You sure? Let's draw. It looks to me like we got a head and shoulders right here. There's your head. Breaks out, pulls back, creates a right shoulder. Creates a right shoulder. Then you come back again and touch it, and then you get that hammer. Then you got a fallen wedge. So that's bullish. That's bullish. You got inverse head and shoulders. You got a fallen wedge. You got a hammer. Then you miss the trade. Was I looking at lift earlier? I guess I was. I don't think I was, but yeah. Oh, I moved the lift. Never mind. It doesn't matter what chart I look at. I can find a trade on it. Most of the time. Unless I have a mental breakdown like yesterday. Double top. Understand that volume slows down when people have they want to take a 4-day vacation. Many fat cats can afford to buy a jet and fly out of here and be gone. We usually went on a float trip. I got a picture of a Memorial float trip I'll show you. I got it still. Missouri's full of creeks and streams. Sure I had one. Might not. Nope. I have to go back and take a picture of one. If you ever get to go to a Trump rally, do it. They are a blast. No, I don't see it. VWAP. Spike could see the VWAP.
To 107. Here we are hanging out just towards the upper extreme of that middle of the range, but yeah, I mean, very much contained. And again, I think this has been supportive of the move up we've seen in stocks. It's helping investors focus on the positive, the negative, focus on earnings, and discount against some of the uncertainties that are out there right now.
All right, Ben, thank you so much.
/DX.
Great to see you. Have a nice weekend. Appreciate it. It's time for our spotlight, and right now we're taking the spotlight of Booz Allen Hamilton. Quartered its earnings, all-time highs. Really looking forward to this conversation with Horacio Rozanski, CEO, President of Booz Allen Hamilton. It's great to see you. Thank you for being on with us. And I'll tell you, as I read through the analyst reports, they are gung-ho on BAH, which right now, you know, we see these new highs. And when you talk about AI, cyber, IT modernization, I mean, they're going right to you. They love it, right?
Absolutely. Happy Friday, Nicole. Thank you for having me. You know, we just came off our best year ever, certainly the best year since our IPO. Record revenues, EBITDA grew 15%, revenues grew 15%. We guided very strongly into next year. And I think a lot of that is because, like you said, we are injecting new technology into the primary missions of our government clients. And that makes a difference for the nation, makes a difference for our clients, and we're seeing the returns.
Yeah, I mean, you are, from one of the analyst reports, let's say from William Blair, they said you are the go-to source to modernize the military. What kind of needs has the military needed from Booz Allen Hamilton?
You know, we've been around for a very long time. This year we celebrated 110 years in business. We started working actually with the U.S. Navy, helping them get ready for World War II, and we've been serving them ever since, and we've evolved with them and with the needs of our clients. And a lot of the needs right now are for digital technologies that will keep our warfighters safe, that will give them better information out there, and that's the type of work that we're doing. A lot of our business now is turned towards artificial intelligence, as you pointed out. AI is really now beginning to scale across the entirety of the government, not just the military. We have a roughly $600 million AI business that we think could be $1 billion in a couple of years, and we're very excited to bring those technologies into missions of really national importance.
So the IPO, from what I researched, tell me if it's wrong, 2010 was the IPO. I mean, I know it's a 100-year-old company, but 2010, and the stock offering was around $17, I believe, and we're at 157, and you noted that this, in fact, was the best fiscal year for the company since going public, you know, since 2010. What made this year different than all the other years?
Good
I think
question.
this year is the continuation of a trend line where we've really we've been growing certainly since the IPO strongly, but if you go back, I've been here for 30-some years.
God, you've been there way too long.
Intern, if you can believe that.
I don't believe it.
I've seen us grow from pretty much every year, and the reason for that is we help our clients. We make a difference, and they ask us for more. And I think this year in particular, what's really helped, there's been stable government budgets. Our clients are really focused on what they need to do, and we're supporting them every step of the way. And I think that's the secret to our growth. I mean, if you take our health business, for example, it's doubled in the last 5 years. Public health, Veterans Affairs, CDC. And a lot of that it's now a $2 billion business, and a lot of that is really the digital transformation that is necessary to evolve the public health infrastructure of our nation.
Still hiring too. I mean, you had an incredible hiring spree over the last year, prior, to the last 12 months, I think. But you're still hiring, right? I mean, tell us the lengths of hiring that you've been going through.
Our employee base grew 7% last year. We're hiring really thousands of people every year now. And a lot of those people are people in the technology field that come to Booz Allen attracted by the work that we do, the culture that we have as an institution. And it's really been great. Our attrition is down. People are staying longer. We spend a lot of time training people. We spent time this year. We trained over 10,000 people on at least the basics of artificial intelligence, so they know what they're doing. And we crossed last year the 34,000 teammate mark. And we're still going strong. We think we're going to add another mid-single digit to our workforce this year.
Yeah. When you think about peers or competition, does that include, it says like old standbys, Lockheed Martin, drone-focused Citadel Defense? I mean, are these some of your competitors? Is there room for everybody to do well, or what makes Booz Allen stand out?
I think what makes us different is we started as a consulting firm, so we really try to think deeply about how to solve the problem and then bring technology to that. I think that's really valued, because at the end of the day, lots of people can build a system, but the system has to work. It has to accomplish the mission, and that's what we're really good at. And it's a big market. There's a lot of room for a lot of people, but we've been growing and taking market share, as I said before, for the better part of 3 decades.
I like that name, Booz Allen Hamilton.
And I just want to go back to your incredible story, your personal story, that you were an intern for this company, and you sit in the CEO role, in the C-suite. A thought on just the leap that you took?
That is a good accomplishment.
Advice for a young person? Oh, you tell me.
Well, first of all, I always say there's a significant component of luck to every career, and certainly I've been very lucky to get opportunities to work with amazing people, to have joined a company that really cares about people and that cared about me. You can probably tell from my accent, I grew up in Argentina, came here to go to college, and joined Booz Allen, and never really looked back. And I always tell people...
Did you come here legally, sir?
I think one of the things that really helped me was to focus on learning. Every day that I come to work,
that's what I do.
Something new. I always say, if that ever stops, I'll probably stop showing up. But
I'm always here.
I'm at risk of that. As rapidly as the world is changing, as much as Booz Allen is changing.
That's how I got successful. I'm the only one in my family that has got a college education and is self-employed. And I started with a GED. Then I had to wake up one day and say, am I going to keep going this route, or do I need to make a change? And at 21, I decided to get my GED. Maybe it was like 32, 33, 34. I think I was 35. 35. 32, and I graduated at 35. But I had to make it. I had to grow up, and I haven't stopped learning since. But you have to show up. You have to show up. You got to give it your all. Just some can become successful. So what is success? Now, I've watched a series about what is success. Is it all material items, or is it just being a man, or just being a positive person, a positive woman, positive transsexual? But I had to show up, and I've not missed a day at this desk in 20 years.
I'm Nicole Penelides. Let's focus on the Magnificent Seven. Everybody has something from this group, right? Whether it's in your 401k, some index, and really doing well once again after that NVIDIA print. Pretty amazing. So let's get to our panel. Paul Marino, CRO, Granite Shares. Quint Tatro, Managing Director, Jewel Financial. Thank you both for being with us. So Paul, you had a lot to say about NVIDIA. I saw at least one guest on television today saying, adding to my position in NVIDIA, even though it's hitting some all-time highs this week, is there still some room for this kind of name that has already run up so much?
Yeah, I think there is. When you think about what Jensen Huang said, demand is just so strong. I'll take him at his word for that. And then if you look at the rest of the Magnificent Seven and all the CapEx spending that they're making into AI and the revolution, the next tech revolution that's happening, NVIDIA is going to be the big winner there, and you can see that in the numbers. Last year, people were skeptical about their prediction for growth, and they surpassed that. There's no reason with what's happening today and with AI and how it's growing that they won't be able to not only hit, but exceed the guidance prediction.
Yeah, and look, Jensen Huang talked about the demand, talked about the smooth transition to Blackwell. Quinn, quick thought on NVIDIA. Still some room to be the leader, to grow the stock, etc.?
Yeah, I mean, I would agree. The company just continues to fire on all cylinders, and it's clear that every time that analysts jump out and form some expectations, or investors do the same, they clearly understate that. So the company has just been amazing, and as the other guest said, I think what's interesting is so many people forget that if this was a gold rush, NVIDIA sells the pickaxes. So you have to look downstream to what else is coming due to this application, and I think that's where some undiscovered value can be.
I like that analogy with the gold rush and the pickaxes. Tell me about another name that you're following closely here in Tesla's on your radar, Quinn.
Yeah, I mean, I want to stay on the AI theme if we can for just a minute. I do like Tesla, and there is some AI component there, but one of the Mag 7 that I think is underrated from an AI standpoint is Google, or Alphabet, I should say. Still trading 20 times forward and have estimated to grow those EPS 30% this year. Obviously, almost no debt, $50 billion in cash. But I think people are underestimating this application, especially if they do this deal with the iPhone. And the AI aspect within Google, I think, or Alphabet, is massive. And I just don't think this has caught the euphoria that some of these other stocks have, and it's right in front of our eyes. So this is our top pick, sort of on the AI theme within Mag 7 behind NVIDIA.
All right, so Alphabet is the top pick on the AI theme, and obviously one that maybe has been overlooked a little bit. And so what do you think, Paul, when you look at a name like Alphabet or even Amazon when you're thinking about AI?
Yeah, I would agree with Quint. I mean, these companies are really firing on all cylinders. Let's take a look at Amazon, right? The stock didn't have the big jump after earnings, even though they crushed every metric that they needed to hit. When you think about cloud services growing faster than expected, advertising revenue growing faster than expected,
and they were seeing revenue come directly from their investments in AI. So there were a lot of macro factors that were happening around that with Fed statements, so on and so forth. We really have our eye on Amazon, and we think that this could be one of the big winners moving forward.
Yeah. How about another name that people may be excited about, and that may be Microsoft? Paul, your thoughts quickly?
Yeah, Microsoft again, just you know, an amazing company that is doing all of the things that they need to do, growing in every specific area that they need to grow in. And again, it's a stock that, as big as it is, can get bigger. When you talk about AI and their product, Copilot, I don't know about you guys, but I've been using it because we have the suite of Microsoft products. They've been offering it for free. I've been dabbling with it, and it's really an amazing tool to help me get through like lots of different things that I have to get through on a daily basis. So they've got the customer right at their desktop, and they're in a great position to really penetrate that market quickly.
All right, I'm going back with Tesla right now. It's at 179, up 3.5% today. Quint, you know, when it's under 200, do you think it's a buy? Is that sort of your way of looking at this one?
Yeah, it is, Nicole, and for a variety of reasons. But Tesla historically, I love when this stock gets hit and everybody just thinks Elon and his company is down. It's so fascinating to me if you look back, and every time this happens, they pull another rabbit out of their hat, and I think they'll do it again. This is a company with very little debt, $27 billion in cash, and doing all the right things in this environment for EVs. And they're cutting prices, pulling back on their employee base, et cetera. And obviously, they're getting help from the government imposing new tariffs.
Did you have
on,
too much helium?
from China. So ultimately, I think this is a company that when it's down and all eyes are focused on other Mag 7 names, you pick up shares. That's what I'm doing. Some of our clients.
Is he talking about
and
Tesla?
This is an opportunity to get into a great American brand with an unbelievable visionary entrepreneur at a very reasonable price here.
Who?
All right, Paul, Quint, so glad you were able to be with us on a Friday, a busy Friday of a busy week, and looking at the Mag 7 that everybody loves ahead of this Memorial Day weekend. Paul Marino, Quint Tatro, thank you both very much. Great to see you both.
If they were talking about Tesla, this is totally different. Listen to CNBC.
Memorial Day weekend, and I want to thank all our service members, and of course those who've made the ultimate sacrifice. So on Memorial Day, obviously saying a few extra prayers, but enjoy your weekend. Have a beautiful, blessed weekend, everybody, and thanks for being with me here on the watch list. I'm Nicole Petalides. Download our free Schwab Network app, available in the Apple App Store, 24/7, schwabnetwork.com. Keep it right here. Market on close. Oliver Rennick next.
Schwab Bank Investor Checking, the checking account built for investors.
Okay. Target. No, I don't want to trade Target. It's because they're pampering. Hello, Washington. This is Target. We want to let you know that we've cut prices on 5,000 items in our food department. What? You're losing margin? That's a sin. That's a sin. Swing low, sweet. Oliver.
We had a little bit of a tumble yesterday, but we're making up for it, moving along, not letting it bring us down. Fade yesterday after NVIDIA earnings were spectacular. Rest of the market had a little bit of a shock, a little wake-up call, but it seems like we're okay. A lot of it has eased as yesterday's bond sell-off is giving way to firmness in treasuries today. The dollar's down substantially. That was kind of the early tell yesterday and today. Russell up 80 bips, NASDAQ almost a full percent. Missing the Dow, but it's okay, it's the Dow. What matters is that we've got tech back on track and NVIDIA leading the way for chips and a good day for semiconductors. One of the things yesterday that was a bit of a wake-up was that the rest of the semiconductor group didn't really do much, and there were some real sell-offs and chips around NVIDIA, so it did, I think, put us on alert for the fact that there's a pretty major drop-off in earnings quality after NVIDIA. But today, we're back to our habit in buying up momentum. As you can see, the anti-beta fund down on the day. That's the one I pointed out yesterday as basically being your way to stay long stocks, but hedge for downside. And so when you've got it lower today, that basically tells you that everything that happened yesterday is basically being flipped on its head. So this is kind of like the opposite of yesterday. The only thing that's consistent is that NVIDIA is still up, but everything else looks very different. Dollars down instead of up. Yields are down instead of up. High beta stocks are up instead of down. And Bitcoin too gets a nice little bounce. First, I'll look at the NVIDIA chart because this is really important. The fact that we were able to break out, hold it, the momentum is picking up. The RSI there on the bottom panel, 14-day, now getting overbought. That's a good thing for a momentum asset. Look at how long NVIDIA stayed overbought at the beginning of the year. So, of course, hopes are running high, and they probably should because it's a long weekend ahead of us. And the fact that we're able to put on some risk and rally today back into the long weekend certainly shows some confidence. Now, as you look at the breakout for NVIDIA, it's rare and it's kind of on its own, but the implication would be that markets will follow, at least starting with the nearest cohort. Question is, does it really have any peers? I would argue no. It's in a galaxy of its own. Basically, Supermicro, the only one showing similar types of numbers. Okay, but that's all right. As long as we have peace and calm in the macro, then it seems we're able to take risks on the micro and buy the stocks and momentum. And so when it comes to the macro, today is so much different. You had a nice consumer sentiment that showed inflation expectations coming in a little bit. That pushed the dollar even further. And this morning we saw durable goods that were pretty good, but nothing too extravagant and nothing that caused any selling in bonds. So the dollar's cooled back off. Risk assets have come back up. Bitcoin too with a nice rally. Ethereum's at rally around the ETF. The last 48 hours kind of fizzled. Here's the catch though, again, if you're looking for signs of animal spirits, I don't think the Bitcoin chart shows it quite yet, given that we stalled out once again at 70,000, weren't able to punch through that level. Maybe it's just a matter of time. Maybe Bitcoin is still kind of ailing here post halving. We'll find out. That's basically all there is to say. You can look at this chart. You can say that it has come back, but you still have lower highs from the all-time record. And NVIDIA put its record in basically the same week as Bitcoin did back in March. So with NVIDIA breaking out, I think it very much points to good things for risk assets and crypto too, but just hasn't quite gotten there yet. BTC still a tiny bit sluggish this week. Last thing, look at the dollar chart real quick, because we do have something for next week to think about as we come back. We have unwound the CPI move from earlier this month, a couple weeks ago, when bonds rallied. They've given it up now since, but the dollar did really have a meaningful turnaround today. So there's a little bit of awkwardness in that gap between the yield and the dollar, probably going to close one way or another. Generally today it's closed by the 10-year yield coming down. That's what I pointed out this morning. If you wanted to know which way risk assets were going to go, watch that chart. If the dollar firmed up, it probably meant risk assets would come off. And if it was the yield that softened up, then risk assets rallied. It was the yield that softened up, and here we are going into the last hour with a good gain across the board. So we're still getting a lot of cues from watching how the dollar interplays with rates on any given day. Join the Jenny Horn, host of Next Gen Investing, here with me in studio. We're back on track, Jenny.
We are back on track. Now we're talking retail again.
We kind of
we started.
Yeah, we slipped a little bit yesterday. We came back. You know, you got Tesla ripping, you got Nvidia up, you got the chips up, and then on earnings too. You know, last night we lost a couple of tech companies with Intuit down and Workday down, but then we've got these big rallies in retailers. So we're finding a way through kind of a complicated week.
We are, and I think I think it was Ben earlier this morning said that does Nvidia really have the power to buoy the whole market? It does. I mean, how many times
just took a day.
It just took a whole day, and now we're back because to go figure, Nvidia's rallying. I mean, up another 1.4%. I mean, this name has been crushing it after it was able to top that really high bar. So I think that you just watch Nvidia, then the rest of the market seems to follow. But specifically, retail discount is all that matters right now in retail, it feels like. As far as expectations go, these companies that are able to say, hey, our consumers are still coming and flocking to our stores, and we're still able to even affirm our guidance.
Thank you for your service.
Well right now.
Yeah, the overall kind of shift down and spending has found its way into TJ, it's found its way into Ross. But also the brands too, Coke is going crazy at Decker. It's interesting to see the way Lulu dropped off this week, now down 40% on the year. And Decker and some
207.
Think about where you can get a lot of the Decker brands. You can get a lot of them in discounters. You can get a lot of them through.
I think we can drop more. It's the end of the, like I said, we got.
That is very true, and I think
actually
that's what almost Deckers has done.
People are done for the week.
They're the anti.
It's early.
Is that their brands are everywhere. Actually, we talked to Urban Outfitters earlier this week.
This is a holiday. 3-day weekend coming up. A lot of people that I know that are good traders don't even mess with this time. They're done. So you won't see much probably for the rest of the day. Not like a regular. And it's Friday. So you got half the team gone, preparing for the weekend. They probably came in and traded the first hour and a half and said, that's it. So I'm going to give you a thing.
Been there, done that. But it's the solar, the way that the solar trade right now is ramped up. I think
you people on YouTube,
for solar.
I'm going to give you something to study. You want to become a better trader. You want to follow me better. Take and copy paste this cheat sheet. I look for these patterns every day. That's all I do. These are continuation to the downside, continuation to the upside. Reversals to the downside, reversals to the upside. That's all you got to know. And I guarantee if you memorize every one of them over the weekend, there's only 16, you'll become a better trader. And you'll learn how to trade with me. All you got to do is learn how to count to 3. If you can count to 3, you can trade with me. If you can count to 4, you might make a little bit more. That's all you got to do, man. It's so simple. And you can make it real simple just by studying these 16 charts. I'm telling you. If you're not getting it, you'll get it. It didn't take me long to learn these charts. Didn't take long at all. But then when I started seeing them, I started saying, boop, boo. Winter chicken dinner. Have a cheat sheet. And then when you're looking at the candles of the squeeze, and you'll be looking at them candles, see if you get a doji or a shooting star or a dragonfly or a gravestone, long leg dojis, inverted hammers. Google what candlesticks reverse in a chart pattern. I'm telling you this all for nothing. And other rooms will charge you. Anybody that does this charges out the ass. They were charging $2,000 or $3,000 a month a lesson. I was offered to charge people $2,500 a lesson, and I turned it down. I said no. I don't need that. I'm telling you exactly how to do it. And they'll tell you the exact same thing. But they'll charge you $2,000 or $3,000. Head and Shoulders. Boom. Out of the trade on 1, 2, 3. Simple as that. You're done. SPX. Cup and handle. I mean, not a Head and Shoulders. Cup and handle. Boom. 1, 2, 3. You're out of the trade. You're off to the beach. You sat here. That's cup and handle. Triple top. If you look at that pattern. Triple top. 1, 2, 3. Out of the trade. Triple bottom. Out of the trade at a double top. Out of the trade at a triple top. Falling wedge. Call it out every day. 1, 2, 3. You can trade with me. 1, 2, 3, 4. You might get a little bit more. Boom. Inverse Head and Shoulders. Every single chart I pull up has a Head and Shoulders on it. Every single one. I can pull, you give me a chart, I'll find a Head and Shoulders on it. Continuation patterns. I talked about this one today, the symmetrical pennant flag. Coming from a downtrend, bullish wedge. Bull flag. Ascending triangle. Head and Shoulders. Rising wedge. Double top, triple top. Every day I talk about all the same patterns on every chart. When they squeeze, when it gets to the end, that's when I call the trade out. Study this here pattern, study this template. If you really want to learn how to trade, quit losing money, or you want to make money, study this and you can trade with me. Only if you can count to 3. There's the head, there's the right shoulder, there's the left shoulder, boom, out, 1, 2, 3, done. See you later. Left shoulder, head, right shoulder, boom. See you later. Triple bottom, 1, 2, 3, 4, boom. Inverse Head and Shoulders. You got coming up from the uptrend, you've got that symmetrical wedge. 1, 2, 3, boom. 1, 2, 3, 4, 5, 6, well, 1, 2, 3, 4, and then 5 with a higher low off the 200. Out of the trade, double top, triple top. I sold it out of the trade. Disney. I didn't even look at Disney today. Got a symmetrical flag ready to open. One, 2, 3, 4, boom. 1, 2, 3, boom. That's it. You're out of the trade. Double top. See you later. MSFT. Snake. Rising wedge. Ascending triangle. One, two, three, boom. You're out of the trade. It's that simple. I'm just pulling them out of my hat. Baba. Anything. Any ticker. Got a little snake here. Got an inverse head and shoulders. Snake. So you got a snake, breakout, pull back, inverse head and shoulders. Take the right shoulder, boom. You're out of the trade. Netflix, NFLX. I haven't looked at it today. Right off the gate, just plowed on up. Netflix is, was one after a day like yesterday. And you got Netflix on your watch list. You come in here and you say, Jim, you get a knock on the door. Like, damn it, man, Netflix. What do you mean, Netflix? I don't know if I should take this trade. I'm scared. Well, don't be scared. Just draw your snake. Recognize what kind of pattern it is. Cup and handle. Inverse head and shoulders. Then you come in the next day and you see a big gap up. Opened up with a gap. Followed all the way up to the 9. Then I get a knock on the door. Jim, I just recognized the inverse head and shoulders. Well, you did? Yeah. Left shoulder, left shoulder, left shoulder, head. Right shoulder, right shoulder. So you took the trade at 549. You got out at 552 on a double triple top. Maybe you got out right here at this triple top at 650. Next. Tesla. Tesla's on my watch list every day. So Tesla got a big upgrade by NVIDIA. The guy that owns NVIDIA says Tesla's number one. Tesla's way ahead of all these other car companies. You won't hear that from Brandon because he's not union. That's what sucks about Brandon. So you come in here in the morning, we got a double bottom. It's on that chart. Double bottom right there. So I look at Tesla. I say, get a knock on the door. Jim, we got a double bottom here in the morning. What do you think? Well, let's see if we can break resistance when the bell rings. What do you mean? Well, we got a resistance here. If we can build upon that resistance, pre-market resistance, we might have us a trade today. So I come in here and I open up with two big hammers. I get another knock on the door. Jim, is that an inverse head and shoulders? Yep. There's your head. There's your left shoulder and your right shoulder. That big engulfing candle. Take it in. I would have took it right here off the 200 SMA first thing in the morning. I would have had no questions of taking that trade with a tweezer bottom with 2 hammers off the 200 SMA on 2 minutes. I would have took that trade if I was watching it first thing in the morning. SPY. Where's it chart at? So I'm watching SPY this morning. I get a knock on the door. Jim, we've been snugging up against this 200, and I think we pulled back to an inverse head and shoulder. You gotta be kidding me. Left shoulder, left shoulder, left shoulder. Bam! Out of the trade. Off to the beach. Lulu. Big gap up. I get a knock on the door. Hey, Jim, I think we got a triple bottom here at open. What do you mean? Yeah, look, I'll draw it up for you. Yep, wick right there. And it matches up with the yin yang from the previous high right at open. We broke out, pulled back, and respected that yesterday's close. Yesterday's close. 1, 2, 3, boom, triple bottom. Where's that on the chart, Jim? It's right there. 1, 2, 3. But Jim, I don't know where to exit. Well, if you're just looking at this, you want to see if it breaks that resistance. And if you're still holding the 9, stay in it. Then we come back and respected it again, that trend line. Kind of had a little bit of difficulty and pulled back. So I took the triple bottom, run it up to a triple top, got out of the trade and went to the beach. Or you just go back in time, go to the 20-day 1 hour, and you run up and hit the 50 SMA, and you get out of the trade on 1 hour time frame. Tweezer top, goodbye. One that NVIDIA, we did NVIDIA, one that's real popular, Apple. So we had a big sell-off. We come in this morning, we turn it on the 1 minute. We respected the 200. The 200, the 200, the 200. We created what you call an ascending triangle. Breaks out, pulls back and hits the 200 and respects it. We get into the trade and when to exit. I have this resistance line up here for something. Maybe I would have got out of the trade right here off this ascending triangle that failed from yesterday. See, that's bullish. That's why I got tricked so bad yesterday. All of a sudden, just boom, the whole market went downtrend. Apple. Let me see another one. DE. John Deere. So we got a big snake here. We broke out and then we pulled back. We created an inverse head and shoulders. But I don't know when to take the trade, Jim. You know how to count to 3, right? So we got a triple bottom off that right shoulder line. There's the left shoulder. 1, 2, 3, up to the 200. I'm out of the trade. Goodbye. I'll see you later. Next one. Home Depot. Someone asked me about Home Depot today. So I didn't see a real good established pattern once they asked me, so I went back and I looked at the yearly, 3-year weekly. And I said, hey, set you an alert off the 200 right here. You got the 200 SMA with an inverse head and shoulders. There's your head. You got the 200 for a confirmation. Set your alert right above it. And wait for the trade to come to you. You know that's a head and shoulders. You're predicting the next move. It's going to come down and hit that right shoulder, and we're going to respect it, and we're going to come back up and get out at the 51, or maybe the 9, or we want to wait and see if it breaks the 9. But what? Jim, I see the exit idea. You do? Hell yeah, it's a head and shoulders. So when it comes back down here, I'm going to take it at 315, and I'm going to be getting out right at the 50 SMA on the weekly time frame. That's it. You're done. That's a head and shoulders. You look, well, I don't know what a head and shoulders is. Well, go back and look at it. It's a reversal pattern. You know to get out of that trade because it's going to come back down on top of you. So use that cheat sheet. It'll make you, I'm guaranteed, it'll make you a better trader. I've made more money in the last 2 to 3 years than I have the whole 17. I have nothing, no one but to thank but this room that I'm in right now. And I'm thankful for all of you. No matter what you're looking at, it doesn't matter. Another one off the top of my head. W. So I come in here and I'm looking at W. I get a knock on the door. Jim, I last night in my sleep, I was counting to 3. I said, are you serious? Yeah. I woke up this morning and I thought about taking Wayfair. The hell out of here. What do you mean? Well, it woke up and it created a symmetrical flag and I waited for the number 3. And when I counted to 3, 1, 2, 3, 1, 2, I jumped in the trade and I hoped it would break the 3, and it did. I can retire now because I got out at a double top. Bingo. Out of the trade. Come in the next morning, I want to look for that flag at open. If it doesn't have a flag, I don't want to take it unless it's a parabolic run. But I've got to look at the flag, man. I got to study that flag. Whatever comes out of that flag first, right when the bell rings, I'm waiting. I'm going to count to 3. And if I don't, and I'm going to go through my watch list, and I'm going to have it set at 1 minute time frame. or even at the whatever time frame I'm accustomed to. 1 minute is perfect for looking for flags. You have to trade different if you're using a different time frame. You have to use candlesticks. You need to study candlesticks if you want to use a 5 minute. Symmetrical flag, you got the up, that's a bullish pennant flag. You're coming from the upside. When you're coming down, that's a bearish flag, and it could cause you to come back down and have a double bottom. So if this was coming from up here and you formed a flag, you'd want to wait for it to find the bottom and then take the trade and run it back up to this upside. Example, I'll give it to you. I called this one out here a little bit ago. We're coming from the upside, and we formed a symmetrical flag. I counted to 3. 1, 2, 3, 1, 2. And the thing broke down on the third one. This is a bearish pennant flag. So it came down. Found trend. 1, 2, 3. 1, 2, 3. Boom. Look at it go. One of them, 2 bits, and a freebie. 1, 2, 3, 4. So we broke down out of the flag. This is a bearish pennant flag. Pennant, P-E-N-N-A-T. And it broke out of it. It's bearish because it's coming from the downside. But it's still bullish. It created a wedge. 1, 2, 3, boom. Then I get a knock on the door. Jim, I missed the trade. Oh, God. I try so hard. Don't worry, man. What do you mean, don't worry, Jim? So watch this. You a little snake here, a little fallen wedge. Yeah, don't take it too serious. Break out of the wedge, pull back into inverted head and shoulders. Boom. Damn, Jim, that was easy. Then you got 3 white soldiers. Continuation of a breakout. So I called this back. I'm having people that are telling me they're going to take the trade at 25, 24. But if you look at the chart, you'd make a lot more. If you pull up the yearly, and I had this resistance channel. Forgot what time frame it was on. So when they had the big breakout, I waited for the pullback to this channel right in here. This is a head and shoulders, 2-headed snake. And resistance was right up in here. So when it pulled back, it fell into that little resistance channel. Support channel, which was resistance, is now support. And then you get this. It's bearish, bearish, bearish. And then all of a sudden you see the flag. You count to 3, and you're out of the trade. In that channel. Snake breakout. Come in this morning. Get a knock on the door. Jim. What do you mean, Jim? I said, I'm looking at GME this morning. And I think I see an inverse head and shoulders. I said, are you serious? She said, yeah, look, I'll draw it out for you. There's your head. There's your neckline. So you got your two-headed snake. You got your left shoulder, comes up, pulls back and creates a right shoulder. You get out at the 200 SMA. We hit the 200, 200, 200. I'm done. I'm off to the beach. I took the trade at 117, took it off this big hammer. There you go, hammer. Right there, telling you to take the trade right there. And I run it up to the 200. I went from $18 all the way up to $8.50. Scalped it for $40 a contract. I bought them at $1. I bought 10 of them, spent $1,000, made $400. Thank you, Jim. Exit the 200 SMA. Next, Visa. I was watching Visa yesterday. You got your flag right there. Just draw that flag in. You go back, okay, what happened here? Well, we had a downtrend. We picked up a little bit and we opened high and we came back to a double bottom. Right there it opened. Created a little symmetrical flag. Kind of went down on us. So the exit idea would have been definitely where you got in at if it didn't break out and run up to the upside. So maybe that's not a good example. But that's one out of how many have I talked about? 25 trades that it could have been took this morning. So I go straight to my watch list. I come in this morning. I look for the biggest losers first thing. You got an inverse head and shoulders. Left shoulder, head, right shoulder, take the trade. So far you're okay. Then all of a sudden, boom, out of the trade. $5. Adobe. Started forming a fallen wedge. 1, 2, 3, 4, boom. Took the trade right there, right when it broke out. Started picking up volume. Hum. Not a good day for Hum. Or is it? No, not a good day for Hum. UPS didn't break the 200 and it came on down. Didn't hold the triple bottom. Fell on back, created inverse head and shoulders. I don't know if I'd have took that trade or not. Probably not. I haven't been trading it at all. That one I did. Lily. One we talk about every day. It didn't do much today, but yesterday, into close, snake with a triple bottom to the 200 into close. Coca-Cola. None of these are running very well. Target Might have took that off the 200. I don't know. I don't like trading target until it gets down to a certain point. I'll go to the 3-year. It's looking interesting off the 50. That's where we are. Yeah, that looks like a good trade to take. I have to keep it on watch. Although I think it could be worth a lot less. But we respected the 50 there. We should be able to respect it right here. Let's draw a trend line on there and see where that takes us. Off the 50 SMA. Yep, there it is. Right at earnings. That'd been a good trade to take. I would have took that and probably swung it. As much as I don't like it. But that's the 3-day rule. So that's maybe another reason why I wouldn't have took the trade. Reddit. Now this is a meme stock. Uber. I don't even know why I got this on here. It's going. I don't like Uber. Called QQQF this morning because of that huge sell-off. Then we had the upward trend. 1, 2, 3. Boom. We got an expansion pattern. The inverse head and shoulders. So that would have been a good trade to take today. Then we let out with them crows. The SPY this morning. I took this one. So we got the 200 SMA. We got a head and shoulders. Boom. That's why I like trading SPY. It's so easy. All these are IWM. Same thing with 200 SMA, head and shoulders. Comes down and hits that right shoulder off the 200. Boom, out of the trade. Snow. Off the 200 SMA, out at the double top. We have an ascending triangle. Snake, breakout, pull back, higher lows, ascending triangle, take the trade, boom. Lift. I got a real low price on this, and I think we're below it. I think we sure are. Not really. I have 1382, but then you got a gap. See, I don't know why I got that there. I should have seen this. I'll wait for that gap and take that trade. Have a double bottom. Double bottom. Apple, JP Morgan. I called this one out the other day. It might have been yesterday. Let me see. Oh, yeah. JP Morgan. Wonder where that all come from. We got like a bot in here. You crashing out? Yeah, that's it. Study them patterns.
Job launching products, but I really think that it was a failed endeavor. Ethereum, because Ethereum's only $3,700 right now, and the micro contract is a tenth of that. So we're talking like $300, and the margin on it's like $60. I mean, it's just you'd have to accumulate so many contracts in order to just get some movement. You're going to generate a lot of costs. You got bid offers to overcome. So we've really kind of shied away from the micro Ethereum, but micro Bitcoin at a tenth of that, it makes a little bit more sense. It's $6,000, $7,000 moving around on the account. So it's something that people can build and add to and things like that. So it's just not there, I mean, and you go back to the equity markets, we had a nice little recovery here today, nice little snapback here. Disappointing when NVIDIA came out, and then all of a sudden we start to sell off. That hotter PMI data really was kind of the knife in the side of the interest rate cuts this year. You're only going to price it in one at the moment. So we're really going to take this weekend to digest and try and find those commodities that have the strongest underlying fundamentals.
Yeah, what do you think the vibe's going to be or coming back after?
The most money I'd spend on Tesla.
For Memorial Day, to your point, it got a little bit messy with bonds again this week, but we're still able to bounce back. So it's not like it ruined the party.
Tesla. How much would I spend on Tesla was asked. I'd go to the option chain, and I'd do the same week, which would be next week, and I'd get as close as I could to the money, and I'd try to keep it below $500 per contract. But I want to get it as close as I can, and I'd watch it. Maybe today you could have got this at 191 for $2, but it was probably down here somewhere. So I wouldn't spend that much. I'd buy 3 contracts, 1,000, maybe $1,500. My average trade is no more than $1,500. If it's more than $1,500, I'm in trouble, and I got to whittle my way out of it. But my limit is 15. I want to keep my losses real minimum. You get stuck in a stock and you buy $10,000, $5,000 worth, you can be down $2,000 before you know it. If you're in a winning trade, you could be up, you spend $1,500, you could be up $1,000. And your only loss would be half of that, maybe $700 or $500 or wherever you set your stop loss at. $1,500 my average, though. Yippers.
from what I read. So, okay, all right, we'll see. June 1st. Shares already got pummeled yesterday, so they're just on a little break here today, I think. Thanks for that, Ken. Of course. All right, Boeing's going to take a shot at the stars. See if that works. Hopefully it does. Coming back, Joe Mazzola takes me into the bell as we discuss the big picture takeaways from the week and look forward. Be right back.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
I'm Nicole Petalides, live from the New York Stock Exchange. Catch me on Schwab Network, anytime, anywhere, on any device, for free. Schwab Network.
Let's talk about the big picture with Mr. Joe Mazzola, joining me, head trading and derivative strategist at Charles Schwab. Joe, good afternoon, sir. Good to see you on a Friday. So what do you think? Victory this week, despite a little hiccup yesterday?
Yeah, maybe. I think that's victory for the tech sector, for sure. I mean, if you look at where the relative strength was, it was clearly on the tech side, on the backs of NVIDIA's earnings. And you know, they held up fairly well. I think if you look at the industrials, you and Rena were just talking about Boeing, and Boeing was the biggest drag on the industrials and the Dow as a whole. So, you know, you saw some weakness there. I will say this, though, Oliver, it's, you know, we're very close to the all-time highs, but when you dig a little bit below the surface, and this is kind of what I like to do, you know, as we're looking at the breadth and we're looking at some of the indicators, advanced declines for the week were really interesting, I thought. Advanced declines were -3 to 1 in terms of decliners on the S&P 500. Same thing if you look at the kind of the broader NYSE stocks. Just, you know, it's just kind of showing you once again, you know, it's been the topic for the last, year and a half, 2 years, that you still have a few kind of generals that are leading the way, and the rest of the soldiers are just in step behind.
Yeah, the equal weight smacked this week. Russell. Sure. Rejected again. It seems like we keep attempting to get these moments of broadening out that fall short, the last one being right before April, when we started to turn lower.
That's right. And, you know, even go a little bit further, if you look at, say, value stocks versus growth stocks, kind of trading at some of the lowest levels that we've seen in terms of that divergence between the two. So, you know, the bid to value that's been really, you know, trying to accumulate going back to November when you saw that nice little move up, as you were mentioning, in the Russell and you know, particularly some of the value names where we saw some of that sector rotation, you know, really kind of lead into the end of the year and starting at the beginning of the year. We've had fits and starts really ever since. But if you're looking for kind of that longer term trend, it's still really just kind of it concentrated within a few names. And, you know, there's really one name at this point that's kind of leading the charge, and that's NVIDIA. And I think that the market collectively breathed a sigh of relief with those earnings, because it wasn't the earnings that mattered. It was the guidance going forward, because as we've talked about a few times, you've got about 80% earnings per share beat rate with the Q1 earnings, which is great. The difference was on the revenue side. The revenue beat rate was only around, you know, 52 to 53%. And when you looked at the performance of stocks on the day after, you know, beating those earnings expectations, it was actually anywhere between, you know, -1% to 0% relative to the S&P 500, meaning you weren't generating a lot of alpha holding those names relative to the S&P 500 because they weren't providing the revenue uptick and the guidance going forward that the market covets right now.
Yeah, good point. Okay, so the bench is pretty shallow, basically, when you get beyond some of the key names from the macro side and the minutes too. The fact that we moved on a few of the data points we did in the minutes, you know, was understandable, I guess, Joe, but it was also to me just kind of like, all right, what did you guys expect? I think it seemed to show again that some of the narrative was just really out of line the last couple of weeks on what the Fed's capable of or what they might do.
the last couple of weeks, about the last couple of months. I mean, let's go back to, in December when people were pricing in 5 to 6 rate cuts. I mean, Oliver and you and I've talked numerous times since then. I don't think anybody really expected that on our side. We might have been pricing in 2
Exactly.
to 3, maybe 4 if you saw a good amount of disinflation. But now I think if you look at the odds, it's 1, maybe 2, and the September probabilities shifted pretty dramatically from about 66%, 67% chance to a 2/3 chance of a cut in September to now about 50-50. And that's really just based upon two things that I saw, 2 items that I saw this week. You mentioned the minutes. I get what you're saying is that why was that surprising? I think what was surprising about the minutes was some of the conversation around, well, maybe we're just not restrictive enough. Traders heard that, and what does that mean? That means to them that not only are you higher for longer, but there might be that tail risk of a interest rate hike down the line. I doubt we'll see that, but I think traders, they jumped at that chance to kind of push interest rates up. You saw the 10-year trade back up around 4.5% before it be kind of trickling back towards the end of the week. But then that PMI data, to me, it wasn't necessarily the manufacturing that was that sent shivers down the spines of traders. It was really the services, because it's the services inflation that, boy, is keeping us. That's the sticky inflation that we're seeing. I get it, in terms of how much of that is built in the OER, the owner equivalent rents. We've been talking about that for a while. But until those come down, right, or until we, maybe at least start focusing or shifting our focus towards the PCE, which has a much less of a rent component built up into it, then you're going to see moves like this in terms of when you get that data. So, we got to keep an eye on the CPIs. We can't just push those aside and say, hey, we move past that. For every good print, we start to get a bad print, and we're just kind of chopping around in this higher for longer environment.
Good. Alrighty. NVIDIA's breaking out. All right. Well, I hope everybody had a good time today. Study your chart patterns. Don't drink and drive. If you do get a little too drunk, just don't drive. Call a cab or a friend. I've almost died because of drunk drivers. A couple times. One time I got hit, guy going 70 miles an hour in the wrong lane without his headlights on. And I was going down a bridge and I looked on both sides. I didn't see a thing. And I got right in the middle of the intersection and T-boned him. My truck went, brand new truck, brand new Toyota. And I went flying in the air and I wedged myself in between a telephone pole and a car. And I saw a big white cloud, and then when I got out, climbed out of the truck, there was this lady sitting there. You all right? I said, yeah, I just saw you T-bone this guy. I had to run see if you're okay. And I said, yeah, I'm okay. What happened? I didn't see the guy. Oh, I saw a white flash, and I grabbed my steering wheel, split second. So the cops came and the ambulances come and you been drinking? I said, nope, I'm going to work. So we got to take you down to the police station. I said, why? Because we got to test your alcohol content. I said, I ain't drinking. I ain't been drinking. I'm just going to work. Well, this wreck was so serious that we have to do it. We have to test you no matter what. So you'll be able to get out of it. I said, okay. Well, they took me down there. Tested me for alcohol. I just woke up, so I wasn't drunk. I didn't drink. It was on a weekday, and I had to get my work done. So I'll show you the truck. Where is it? I found the picture of the float trip. T-boned that sucker right there, boy. Brand new truck. Gave 24 grand for that thing back in 2003. I'll show you people on YouTube. I was lucky to survive that one. That's just one. I work nights, so I'm out with the drunks. I'm out with the criminals. I'm out with the bad elements. Here lately, I haven't seen that many bars, but back then there was bars to go to. Now you don't see that. We don't have too many bars. But that's just one. And then I was T-boned one time, just same, about a year later. Young kid with his learning permit driving down, ran a red light, T-boned me right on the side. My truck tripped over and I got knocked out. Had to go to the hospital. Broke my neck. Fractured my neck. So don't drink and drive. And that's it. Everybody have a pleasant weekend. Yippers, nice clothes on the video. Remember, Monday afternoon.